Hey there, this is the first video of the course. Welcome, thanks for joining us. My name is Colt. So this course is a little bit different than most in that we have two instructors. We're not splitting up sections or alternating videos. We're actually teaching together every single video of the entire course, except for one, which is this video. So after recording all these videos together, we somehow forgot to do the very first video. Yeah, so Kevin, my co-instructor, had tonsil surgery just a couple days ago and is unable to speak right now because his tonsils have been surgeried. So he's not here to record this video, but I do have a little message from him. Hey, Kevin.
Hi, Colt.
How are you feeling?
I'm feeling terrible.
I'm recording the intro, so say hi to the students.
Hi, students. I'm Kevin.
Okay.
I hope you enjoy our course.
All right, I'll take it from here. Feel better, Kevin. So here's a little bit of information about us. This is me. So I'm a developer, a teacher, blah, blah, blah. I've switched over the last couple of years to teach full-time on Udemy, or almost full-time. I still do some other work on the side. I have a couple of courses out there. This is obviously one of them. And I talk a lot about my two cats.
That's me. I'm Kevin Katz. I'm a software engineer, and I work in financial tech. I've been a blockchain developer since 2014, and I have two dogs, which are cuter than Colt's cats.
Now what I'd like to do is walk you through the course. Now what I'd like to do is a very quick rundown of the curriculum. I just want to highlight some of the really important videos, the things that I feel are highlights, or I think that you shouldn't miss. So first up is a video in this intro section. It's a very short section, but the last video is a super fast intro to Bitcoin where we just quickly overview how Bitcoin works and sort of the big ideas behind it. I definitely recommend watching that. Then we move on to a section all about money. And this kind of steps back from Bitcoin. It's really focused on the history of money and currencies, types of currencies, and other attempts at digital currencies and cryptocurrencies that predate Bitcoin. And it sets the stage for Bitcoin. But in there, we have a couple videos about creating our own fictional coin or currency called Rainbow Coin. I recommend you check those out because it helps us really understand the problems that Bitcoin solves. Then we move into Bitcoin. So we have a Bitcoin basics section, and this is where we actually show in one of the videos a real transaction. Kevin sends me a very tiny amount of Bitcoin, like $8 or something. But we actually show it on the screen, show our phones, and you can watch it live. Well, not live. You can watch it happen. Then we move on to cryptography and fingerprinting. So this is a bit of a shift in the course. After Intro to Bitcoin, we focus on cryptography in general and a technology called fingerprinting. And then we learn how it applies to Bitcoin, where we talk about blocks and the blockchain. So this is another very important section, and we have some nice slides that we're pretty proud of in this section. Some nice colors. Definitely recommend not skipping that as well. Then we move into mining, the mechanics of Bitcoin mining. We talk a little bit about some math in this section. We talk about what Bitcoin miners are doing. If you've never heard of miners, don't worry. And then in our very uncreatively titled second section on mining, more about mining, we just expand on some of the details and implications that stem from how Bitcoin mining works. Next, we go back to cryptography, but in a different way, we talk about something called public key cryptography. And we learn this on its own in isolation. Then we come back and learn how it relates to Bitcoin. It has to do with something called digital signing. So in these two sections, we do a lot of demonstrations. We actually show the cryptography. We don't skim over that. So for some of you, I think that will be exciting. Then we move on to Ethereum, which is a second cryptocurrency, separate from Bitcoin. Similar in some ways, but very different in others. And in this section, we spend a lot of time really talking about how Ethereum is unique and special. And then we also have a couple of transaction videos where Kevin sends me Ethereum, and also a video where I use Ethereum to purchase something called a CryptoKitty. Next, we have another very uncreatively titled section called More About Ethereum, where we expand on some of the inner workings of how it all works. And there's a lot of fun things there. Then we get to the appendix. And this section includes a lot of one-off videos that go into more detail that we didn't want to include in the regular part of the course. Very detailed things or more math-heavy videos, or very nuanced things that you don't really have to know. They're all in this section. So multiple times in the course, you'll see annotations pop up, or you might hear us say, for more information, watch this video in the appendix. So that's the appendix. And then finally, we have a video or a section at the very end called Getting Started, which I guess seems sort of paradoxical, but it's about getting started with Bitcoin and Ethereum and other cryptocurrencies, meaning the very concrete steps of if you want to get started, if you want to buy some, what do you need to do? What apps can you download? What exchanges can you look to? So the beginning of the course, most of the course is about how things work. We're not trying to get you buying or investing things right away. That's not really the focus or the goal of this course. It's a lot more about explaining how it all works. So that's a brief overview of what we cover. Next, we're going to dive into that super quick intro to Bitcoin video. All right, welcome back. So in this course, we start off by talking about decidedly non-Bitcoin specific topics. That's a terrible way of putting it. We talk about the history of money. We talk about
money
types of currencies and digital money and basically precursors to Bitcoin. And we think it's important enough that we do that early on. But the trade-off is that we don't quite get to the meat of Bitcoin. We don't get to Bitcoin itself for at least a couple videos. And this course isn't terribly long, so it's not that long of a wait, but we decided why not put a super short analogy, a very quick introduction to how Bitcoin or a single Bitcoin transaction works in like 2 minutes, 2 to 3 minutes. Don't hold us to it, but we're gonna try. So here we go. Okay, this is such a terrible slide if you have no context. It looks like we're talking about the company Dropbox, which we're not. There is an actual item in the world called a Dropbox.
Yeah, where you return videotapes, sort of like a mailbox.
Yeah, stuff goes in. Anybody can put something in there. Anybody can go to the library, put a book in, but only the librarian. There we
Library
go.
master.
The library master can unlock that box and take all the books out. It's a one-way system. So why do we have this here?
What's this have to do with Bitcoin? Suppose I'm going to send Colt some Bitcoin. What Colt is going to do is he's going to use an app on his phone to create a disposable Dropbox for me.
Okay, and what is it actually called in Bitcoin?
It's called an address, and that's really just a destination for me to send Bitcoin.
It's like if he was sending me a letter, he needs a place to send it to.
Yeah.
In this case, though, it's a really long string of numbers and letters that's impossible to remember.
So instead, it's pictured here as a QR code, and many Bitcoin applications use QR codes as a convenience layer on top of the underlying address.
Okay, so I make these, and here I actually have 3 of them because Kevin's going to send me Bitcoin, my mom's sending me Bitcoin, and my dog is sending me Bitcoin. And they each have a special place to send it to. Now, along with it, we have a key pictured. And that's because a lockbox or Dropbox like this is useless if nobody can get anything out of there.
Or if everybody can get it out of there. Yeah.
Or the opposite. But in our case, anyone can put something in, but only I, the creator who has the key, can unlock it. I basically tell Kevin, here's where I want you to send the Bitcoin to. Kevin's going to send me 10 million Bitcoin.
I'm going to send you 10 Bitcoin. 10 million would be half of all of the Bitcoin. I'll send you 10 Bitcoin.
I'm happy with 10 Bitcoin.
That's very generous.
That's still quite a bit of money today.
So I put the Bitcoin, we'll explain what this process is mathematically on a computer, but for the analogy, just imagine that there's an operation I can do where I put digital Bitcoin into this Dropbox. And as soon as it's in there, it's locked in place. I can't get it out.
Right.
Now, the next step and the next leap of understanding that you have to try and take before you'll have to take our word for it.
Yeah, this is the weirdest part.
Yeah, is that instead of me walking that Dropbox to Colt and saying, here's your Bitcoin, what I instead do is I take that locked Dropbox and put it in the middle of a public place. And that public place is called the blockchain.
It's a pile of a bunch of other transactions, a bunch of these other locked boxes that somebody has a key to each one. The idea is that they're all out. Everybody can see them. So everybody knows. So they don't actually, we'll get into this. It's anonymous. It doesn't show who sent what to who. But everybody knows that there's a transaction from one person to another person for 10 Bitcoin that happened at X time in the day.
Yeah. So imagine I put this Bitcoin into this Dropbox, and then by putting it into the blockchain, what I'm effectively doing is I'm leaving it in a public place. And it's as if I've taken this Dropbox and just left it in front of City Hall. But I'm confident that only Colt will be the one who can open this Dropbox. Nobody else can steal the Bitcoin inside of it.
So we'll get into the reasons why this is so important that it works this way. There are a lot of benefits of doing it, of having transactions be public like this. And actually, it's sort of necessitated by the way Bitcoin works. But we'll get there, and we spend a lot of time talking about the blockchain.
So when Colt wants to spend his Bitcoin, what he does is he goes to City Hall, he goes to the blockchain, where all the Dropboxes are stored, and he picks up the Dropbox that he knows he created.
And I have my key at home.
He has his key.
I'm the only person who has it. And I go and I unlock it, and I get my 10 Bitcoin, and I can spend them. I can exchange them for US dollars somewhere. I can do whatever I want.
And he can send them to the next person.
So to summarize, at the core of Bitcoin, there are two concepts really. One is this idea of a one-way transaction, what we're calling a Dropbox. In reality, it's called an address. Bitcoin can go in, but only one person can take it out. So everybody can put something into there, only one person can take it out.
So the second component is the notion of leaving that Dropbox in a public place. Instead of me manually delivering it to Colt and needing to see him in person or directly send him, for example, an email with the Bitcoin, I just leave that Dropbox in a public place. And I'm confident, and Colt is confident, that when he wants to spend that Bitcoin that's locked in that box, only he will be able to unlock it.
And now we're done. That's it.
Voila.
All right, welcome back. So as we've mentioned before, the first couple videos of the course actually aren't about Bitcoin exactly, at least. We're talking about money in general. We're talking about the history of currencies, the different classifications, in order to help us understand the context that Bitcoin exists in, why Bitcoin was created, and where it fits in. The first thing, and why it's valuable. And the first thing we're going to do is the very cliche thing. Kevin's going to read the definition of money.
Definition of money by Merriam-Webster. Money is defined as something generally accepted as a medium of exchange, a measure of value, or as a means of payment.
All right.
Bitcoin can be all three of these things.
Okay, so we'll get to that. But first, there are three general categories of money that most economists recognize. And we're going to run through these, and then at the end, we'll try and talk about where Bitcoin fits in. So the first is commodity money. This is probably the most, it's like the classic definition of a currency where there's actually an item of value. So if you're trading beaver pelts, for example, one of my favorite currencies of all time, except actually it's kind of sad because it drove beavers to extinction in North America, or the brink of extinction. Now they're back though. Anyway, the idea is that there's some rarity of whatever it is. Beavers are rare and they take a lot of work to get a pelt. So that's worth something. Gold, silver, they're intrinsically rare. You have to mine them. You don't just stumble across them. Salt also was used as currency, spices, all sorts of things. But the idea is that the item itself, whether it's a beaver pelt or an actual gold coin or a silver coin, it is rare and it's worth something on its own. So those aren't that common anymore, as far as I know.
No.
Then the next group.
Representative money. So representative money is a currency issued by a government that is backed by a physical commodity. So in this case, we've pictured here the gold certificate. So between the 1860s and the 1930s, the United States government issued these gold certificates, which could be exchanged for a given weight in gold coin. Then from the 1930s until the 1970s, the gold standard was continued, but it became more of a hypothetical. You couldn't actually go to Fort Knox and exchange a US dollar for gold, but the idea was that the US dollar was backed by gold.
So with representative money, there's some item that is rare or that's valuable on its own, a commodity behind the scenes, basically. And instead of lugging that around, instead of lugging a wallet full of gold, I can have a couple of bills or pieces of paper that the government says this is equivalent to X amount in gold or silver or even beaver pelts.
Yeah, and if you want to pay me, I trust that I can take those pieces of paper that you have, and I trust that they're valuable because hypothetically I could walk them back to the government and exchange them for their underlying commodity.
Right. Now, that leads us to the third type, which is fiat money. This is far and away the most common currency nowadays, and basically there's nothing intrinsically valuable about it at all. There's no commodity behind it, whether it's a piece of paper or a coin, whatever it is. The value basically comes from the fact that a government has declared that it's valuable, or some other group, but almost always a government.
And that we trust that value. We trust the government that backs it.
So it's all about the system working together. And the U.S. government in this example says a quarter is worth 25 cents. And it's not that a quarter is worth 25 cents of silver, for example, or of nickel or whatever it is. It's just the government says this is 25 cents and we're going to treat it that way. You need to treat it that way. And it works, but there's a couple shortcomings. And the first is that it all requires trust in one group, the government. And not to sound too conspiracy theorist. No, but that can be problematic. Yeah. And for some people, it's a matter of the government can print more money whenever they want. And politically, and depending on how people lean, that can be problematic.
Yeah, we can make an entire video on the
Okay, but we're not talking about that. But when people do talk about going back to the gold standard, which is a somewhat politically popular opinion these days, at least in some fringes in the US, the idea, or one of the ideas, is that it was more stable and that the government couldn't just print more gold at will, right? They had to have gold that was backing the piece of paper. With with fiat money, the government can decide tomorrow to print X amount of billion-dollar bills. I don't know if that's true.
Could they? Yeah, like if they
Actually,
wanted to.
I mean, I don't know who has to get approval by who. Anyway, so fiat money, to wrap that up, the three of them are commodity. We've got some actual item of value of scarcity, usually. Sugar, that would be my choice, actually. Beaver pelts, gold. Then we have representative. You have a piece of paper or a coin that corresponds to X amount of a commodity behind the scenes. And then fiat currency, things like pretty much every big currency these days, US dollars, euros, yens, rupees, where it's just a government declaring this currency is worth something and the people trusting that government.
One thing to note about all three of these types of money is that they're all difficult to counterfeit. So part of their value comes from the fact that you can't just arbitrarily create them out of thin air.
So in coming videos, we'll talk about where Bitcoin fits into all of this. It doesn't necessarily fit into one category all that neatly, and we'll see why in a little bit. All right, welcome back. So continuing on with our discussion of money, we're now going to introduce a fourth, I wouldn't say it's its own category, because as we'll talk about, it sort of fits in with some of the categories we already saw. It's sort of fuzzy where it actually fits in.
There's properties of almost all three.
Yeah, but we're going to talk about digital money. And so Bitcoin is a digital currency. It exists on your computer. There is no physical object. There's no dollar bill or anything. But there are other instances of digital money that actually became valuable. So Bitcoin is probably the most popular, the most valuable currently example. But there have been other examples, mainly actually stemming from video games. So we're going to talk about those for just a couple minutes here. So our first example is from, I hesitate to call it a game because I think the people who actually play it,
it's a game.
I don't think they like calling it a game. It's like a simulation. It's called Second Life, by the way.
It's a simulation that's also sort of a game, and it's really an online version of The Sims. So people can create an avatar. I
promise you, people who play it are going to be so angry at you for saying that. People take it pretty seriously.
I'm sorry in advance for calling this a game, but
because people build, so the idea is Second Life, as the title implies, you basically have a second life. You have an avatar, you can get married, you meet people, you can have a family, you can buy a house, you can have a job. And people who are very committed, like play with the same group of friends every day. They meet with them.
Yeah,
they have a
and
whole
they meet
life
new
on
people.
there. So why are we bringing it up, Kevin?
Because Second Life created its own digital economy. So pictured here is real estate that has actual real world value. So
it's a very nice piece of land in the game.
God, it really is nice, although it seems
a little flood prone.
A little sea level rise would be this would be problematic if there were any in-game global warming. But
But in the game, this is a very desirable plot. We assume, at least. I mean, we don't know.
People would pay real money for something like this, and
you're saying like not just in-game currency, but
no,
like
people would
money
buy this
outside the game
on eBay with US dollar actual fiat currency. And
right.
we pointed this as evidence that there can be things on a computer that have no tangible, no physical representation, but still real-world value.
Yeah. And this itself isn't a currency. It's just something that became valuable online that is purely digital, that has no real world equivalent.
Yeah. And so in that way, it's somewhere between a commodity and a fiat currency. It would be a commodity because it's valuable in and of itself. It's not particularly a fiat issue, a government issued currency.
It's rare in the game. The fact that it's scarce in the game, the nice properties, for example, oceanfront properties, there just aren't that many. So in that way, it's sort of like a commodity. But then at the same time, it's just a bunch of zeros and ones. and the developers at any point could just change the entire system and make every property oceanfront or delete all real estate.
And for that reason, we'd sort of compare this to a fiat in that it derives its values from our trust in the developers' stability in that ecosystem.
Right.
They're not going to just create these things out of thin air.
So next, there's another video game. This one is definitely called the game. It's called EVE Online. It's what's known as an MMORPG. What is it? Massively
multiplayer
online role-playing game. So this is a game, actually all of the things we're talking about here involve lots of people being online at the same time, which is pretty important to the development of any value of the currency. If you just play in single player mode, it doesn't really matter.
Yeah, I don't think people are going to be really buying. I guess people buy loot boxes in single player games, but these tend to be more valuable. So EVE Online has a type of currency called the Interstellar Credit, and this Interstellar Credit you can buy with actual fiat currency in the real world, and people do pay real money for in-game currency.
Right, and then in the game you would use it to like buy a better spaceship, for example.
And in this game, if somebody blows your spaceship up, you actually lose the thing. So in that way, there's a lot more risk in this world.
Yeah,
I don't think anybody can blow your house up in Second Life.
There's no going back and like undoing or reloading a previous save. If you spend thousands of US dollars equivalent in the in-game currency, what is it called again? ISK?
Interstellar Credit.
Credit with a K.
Yeah,
so if you spent a lot of money on that and then you got into a giant like ship battle, which happens in the game, if your ship is blown up, it's gone and that money is gone.
And you were telling me that you saw a friend in a battle that ended up destroying hundreds of thousands of dollars worth of in-game property?
Well, it was like a big battle with lots of people. It wasn't just like one person against one person. You can watch on YouTube these videos where, hundreds of thousands of dollars are destroyed.
So the border between digital money in the game and real world money is blurred.
Right.
And now the real blur is World of Warcraft Gold.
Yes, World of Warcraft. I have a very complicated relationship with this game when I was younger. I was never one of the people who spent real world money to buy gold in the game.
I would have if I could have.
Yes, I absolutely would have as well, but I just didn't have money or a credit card. So World of Warcraft is another MMORPG, very popular game. You probably have heard about it even if you don't play games. And in the game, there's a currency called gold. And gold is used to buy pretty much anything you want in the game. New armor, a better like horse mount to ride.
How to get a new mount.
All sorts of things. And what happened is that this game became so popular, and it's still so popular, people specialize in basically farming gold, on finding their own gold and then selling it on eBay or on third-party websites. And
this was a real economy where people had jobs, where all they did was go kill monsters that dropped gold and then sell that gold on eBay for real world money. So they could take something digital and really turn it into something that they could feed themselves in real life with.
And it's still going on. So Blizzard, the developer, was not very happy about that.
No, they've outlawed it, but people transfer this money in gray markets.
Well, we just had not to show it in this video, but just before recording this, I just Googled basically where to buy World of Warcraft gold.
How much it costs.
And it was, what was it? $7 roughly per.
What was the unit?
I don't remember if it was 100 gold or 1,000 gold.
Yeah, but basically people will pay real money
10,000,
with a real credit card for in-game gold.
Yeah.
And this is really the pinnacle of digital currency. And it goes back to last summer. We're recording this in 2018. In the summer of 2017, the Venezuelan bolivar crashed. So the currency in Venezuela crashed. And what ended up happening is 1 unit of gold in World of Warcraft became more valuable per exchange rate than the Venezuelan bolivar. And what that effectively means is that people trusted Blizzard, a game developer, more than they trusted the central bank of Venezuela. And that's really the essence of the blurred boundary in the 2000s between digital money and real money. The economy is now spilling into the digital world.
So that brings us to the main weakness, the primary weakness of all of these currencies we've mentioned, and not even just the digital ones, honestly. We're also including the US dollar or the euro or any
specifically
currency.
Fiat and representative. Commodities, gold, you don't really need a central authority.
Right. So if you have a stockpile of beaver pelts, even if the government that is, backing your beaver pelt disappears, you still have beaver pelts.
Yeah.
So you can stay warm for all winter. But with any of these digital currencies, for example, World of Warcraft Gold, if Blizzard just disappeared or they wanted to just change the currency entirely, all of a sudden they want to inflate the value.
Diamonds. Yeah. And now there's a separate currency that's more valuable, and they flood the market with diamonds and they dilute the value of gold. The people who currently have gold are really at the whim of that developer, that central authority. And this is what happened in Venezuela. This has happened in a few countries recently. Zimbabwe. In India recently, they banned the 500 rupee note. All of these currencies are subject to the whims of the government or the institution that backs them or that issues them. And from this, just a little bit of context and a spoiler, Bitcoin grew out of the 2008 financial crisis in the United States, or across, really, it was a world financial crisis, but the Bitcoin network began in 2009.
Right. And the other spoiler is that it is not a centralized currency.
No, the point is that it's decentralized.
Right.
And in some ways there are parties, there are institutions that are trying to take control of parts of it, but in general, the way the network works is, and the goal here with cryptocurrencies is to remove a central authority.
Okay, that's enough of a spoiler. Moving on. All right, welcome back. We're going to do a little thought experiment now that we've talked about currencies and digital money. We're going to make our own digital money. So it's back in 2009, after the crash of 2008. We've decided that we're going to start our own currency, our own digital money. We don't need government. We don't need capitalism. We don't need anything. We're going to start out on our own.
Yeah.
So we spend most of our time investing actually in designing a logo for our new currency, which we're going to call
Rainbow Coin.
And ignore the fact that it might look like the built-in Mac rainbow emoji.
Just a little bit.
Okay, anyway, so Rainbow Coin, the way that it works, it's very, very simple. So in our world, we're not even in it. There's only 3 people.
Yeah.
Billy, Montana, and Kilgore. So the most central thing to our entire currency is what, Kevin?
We have a ledger.
What's a ledger?
The ledger is our central store of books and records of Rainbow Coin.
Okay. So a ledger, just to be clear, is a word that has a meaning outside of currency or outside of digital currencies. Like when we talk about Bitcoin, we talk a lot about the ledger, but a ledger is just any sort of bookkeeping list, I guess is what you would say, right?
Yeah. And one important trait of a ledger is that it's in order from top to bottom, or it has some time ordering.
Yeah. So our ledger is going to be let's say it's an Excel spreadsheet, and I've created it. And all that I do is basically have a from column, a to column, and a quantity. So at the beginning, I'm just giving out this coin to 3 people. So there's no from. I guess I could start it out as from me. But we're just gifting them. So Billy gets 4 coins, Montana gets 7, and Kilgore gets 5. And so I write that down in this spreadsheet. And I need to keep this spreadsheet safe, of course, and that's something we'll talk about later. But I'm in charge of it. Someone has to be. It's like a bank. There has to be somebody who's monitoring things and making sure everything's kosher. So that's me.
So, suppose Billy has a hat and Kilgore wants to buy it from Billy, and
it's a glowing hat.
It's a glowing green hat. It's a nice hat. So Kilgore and Billy agree that the price of the hat should be 3 Rainbow Coin. So how do they exchange Rainbow Coin? There's no physical commodity that represents Rainbow Coin.
Yeah, there's nothing. There's no token to give them. There's no piece of paper.
Yeah, like World of Warcraft Gold or like Second Life Real Estate, it just exists on a computer. So when Kilgore wants to buy the hat, and Billy agrees on that price, all Kilgore does is tell Colt, I'd like to buy this hat. I'm going to transfer 3 Rainbow Coin to Billy. And what's that look like on the ledger?
So I add that in. He could send me an email. It could be through a text. It's sort of like you go to your bank or you start a wire. You have to say who you're sending it to and how much. And then your bank takes care of the rest. They keep track of it. So that's what I do. I write down that Kilgore gave Billy 3. Now notice that at no point is there a total balance for each user. For example, all we have is a list of transactions, but that's all that we need to figure out who has what.
Yeah, if we start at the top and work down, then we can figure out who has what when.
Right. So for example, Billy had 4. Now Billy has 3 more. So that means Billy has 7. Okay. So then what happens next? Well, Kilgore has that glowing hat. Looks great in it.
Now, Montana hears that Kilgore bought a hat with Rainbow Coin, so she knows that Rainbow Coin is sort of trustworthy. You can actually buy things with Rainbow Coin, and she decides she wants to buy more of it. So she reaches out to Billy. She knows Billy has Rainbow Coin and says, I'd like to buy some of your Rainbow Coin. They agree on an exchange rate. In this case, they agree $5 for 5 Rainbow Coin. Now, how do they make that transfer? Montana gives Billy $5. Billy gives Montana 5 Rainbow Coin.
And what does it mean to actually give it? Again, it means talking to me or emailing me and saying, hey, here's the transaction I want.
Cool.
And I go into my spreadsheet and I'm the bank. And I just write down, it's simple, right? I just write down Billy sent Montana 5 Rainbow Coin. remember through all of this, this is the weirdest part. I think we're so used to just money and physical objects. There is nothing. The only value is this spreadsheet.
Yeah. But this is happening, for example, if you used Venmo or PayPal, or you look at your debit card, if you look at your bank account, a lot of times people are engaging in transactions like this without ever holding a physical representation of the money that they're spending.
Right. The only thing is that there is nothing that we're representing here.
No,
it's just columns in a spreadsheet.
It's like a completely, at least at the bank, there's some it's representative currency. You could go exchange it for the US dollar that backs it.
When I Venmo you $15, for example, for the really terrible sound bath meditation class you made me go to a couple of weeks ago, I send you $15 on Venmo. There's still $15 in the real world that you were going to get eventually.
I can withdraw it from Venmo.
With Rainbow Coin, it's just words or numbers on a spreadsheet.
No, but it comes down to Montana, Billy, and Kilgore all trust the value of Rainbow Coin, and voila.
Well, yeah, why wouldn't they trust me?
Well, it looks like they are. Well, they're spending $5 on real Rainbow Coin. So we have our successful paracurrency.
Oh, and we have a little animation we forgot about. There we go. Look at that.
Good. Yeah.
So Montana's total increases to 12. Okay, so at the end of the day, here's what it looks like now.
Montana's killing it.
Montana has 12 Rainbow Coin. Billy has 2. Kilgore has 2. And again, we don't have that written down anywhere. We just have the history. But that's all that we need to figure it out.
So in the next video, we're going to talk about the problems with this, because there are quite a few.
There's nothing wrong with it. This is my perfect currency.
Rainbow Coin.
You're such a downer. All right, so as Kevin mentioned in the last video, all is not well in our Rainbow Coin world. There's a couple problems. And actually, all the problems come down to one person.
You.
Yeah. It all comes down to the fact that I'm in charge of everything. I'm the keeper of the spreadsheet.
Colt is the central authority.
So if this is our spreadsheet here, the ledger, this is my very ultra secure and safe clip art Parthenon.
Yeah, we represent the central authority with the little Parthenon clip art.
So imagine I actually, if I had a house and I had a backyard, in it, I might have a very secure vault that looks like this.
Yeah,
and inside of it, I put my laptop that has the spreadsheet on it. Nobody can get to it. That's the plan. I put it in there. But that's not good enough because I could be a terrible person. And I may be, but that's for another course. We're not doing any sort of psychoanalytical stuff right now.
We're not inventorying Colt right now, but he could give Billy 100 Rainbow Coin out of thin air.
Yeah, I could just falsify a transaction like this. And I noticed Billy's having a bad day. And I'm like, you know what? I'm going to give Billy 100 Rainbow Coin. That will really help. So I can do that. I'm issuing it. I issued it in the beginning. What's stopping me from issuing more? It's just like with World of Warcraft or with Second Life or any of those things. The developers could just decide that they need more currency in the game and just gift everybody however many coins.
Or gift one person, and then it's unfair to everybody else.
Yeah, so this is worse because now Montana and Kilgore are like,
broke.
What the heck? What happened? That my 5 is not worth anything anymore. Billy is a high roller now.
So what else could you do?
Well, I could also falsify a transaction from one person to another. So let's say that I've turned on Billy. I'm very angry. I don't know what happened, but
Billy
he did
was
something.
a jerk.
Yeah, he broke the circle of trust. And so I decide, you know what? I'm going to give 50 of your coin to Kilgore. And actually, in this example, Billy doesn't have 50 coins to give, but that doesn't matter.
So now his balance is what? Negative 47.
I can just go on to into the Parthenon, open up the computer, go to the spreadsheet, and do whatever I want.
And that's unfair to Billy because he didn't sanction that. And this is one of the inherent problems with a digital currency with the central authority, is that because there is no underlying tangible representation that Billy is holding, Colt can just do this out of thin air. If we were talking about gold, or if we said that marbles were the currency, Colt would have to go and take them from Billy.
Right.
In this case, Colt Central Authority can just create the new entry in the ledger unfairly.
Well, and in this case, like there's nothing. So even if we're talking about a representative currency for like the US dollar, yes, you could make more out of thin air, but it takes work. It's not easy to just counterfeit one, for example.
No.
Or gold, for example, a commodity. It takes a lot of work to go and get more gold. But here, it's just a couple keys that I press and hit return. So keep in mind that the reason we're doing this is to highlight some of the things that Bitcoin solves. And one of those things is that you can't just create Bitcoin out of thin air.
Mm-hmm.
even though it's digital. So another thing I could do if I'm feeling extra evil, I could change an old transaction. So there's nothing preventing me from going back in the past and cooking the books and erasing something or adding something in. Actually, I think on our next slide, yep, there we go.
It just deletes Montana from all of history.
Yeah, I was just really upset with her. There's a trend. I'm getting upset with everyone. So I could just remove her, wipe her off the entire rainbow coin earth. And this is another thing that is important to talk about, and we're bringing it up not just to be sort of humorous, but also because it relates to Bitcoin and the fact that one of the key innovations in Bitcoin is that there is a ledger, there is a list of these things, but no one can just go back and alter it. No one can go back and just delete some person's presence from the entire ledger.
No, and unlike a fiat currency issued by a government, you can't just seize somebody's Bitcoin in the traditional way. If you could go to them and take away their keys.
Okay, you're getting too far ahead.
We're not going to get that far.
You're jumping the gun.
In general, though, Bitcoin can't be seized by whatever central authority we have here.
Okay, so to summarize, if I'm a terrible person, but somehow everybody trusts me, which that sounds pretty accurate, honestly. It sounds like me. But in this context, everyone trusts me to manage Rainbow Coin. I can do whatever I want. It's sort of like if you had a bank, and who's ever heard of a bank doing something bad? I have never heard of that before.
No, never.
But this actually is a bit more disastrous because I can just issue currency out of thin air. I can edit old transactions. I can make new transactions. I can delete entire people.
Or somebody can hold Coldham hostage, and then they make the changes.
Yeah,
maybe Colt isn't a terrible person. Yeah, maybe it's somebody else doing this. Yeah, let's blame someone else. And the last but not least, amongst the other problems, there's only one copy of this ledger.
Yeah, so if my house burns down,
if he were to lose his laptop, if it were to be burnt down, if it were to be burnt in a fire, then everybody would lose their rainbow coin.
Yes. So these are all problems. We're being quite down with our rainbow coin currency. We're a bit exasperated at this point.
Down with the rainbow coin.
We've given up and we've gone back to using US dollars. But then, a little while later, Bitcoin came around.
Ah, voila. So in the next chapter, we're going to talk about attempts at solving these problems with digital money.
Yeah, decentralized currencies. Take it away, Kevin.
Welcome back.
There we go. That's your one time saying welcome back.
I wanted to say it.
Okay. So, welcome back. In the last video, we spent a lot of time trashing our poor rainbow coin. We went
critiquing.
We trashed it because we went from having such high hopes. We were idealists, but it all was undermined by one key shortcoming, which was me, the central authority. I couldn't be trusted. I'm a charlatan and a fraud.
No, you were held hostage in one of those scenarios.
Okay, whatever happened, the problem is there's a central authority.
Central authority.
It's a weakness, whether it's a government that you can't trust, or a government that collapses, or a bank that fails, or me storing my ledger on a computer, a single ledger on a single computer.
It's a single point of failure.
Yeah.
That's the issue.
So a sinkhole opens up, my Parthenon disappears along with my laptop. We're out of luck. The currency is done, right? Everything fails. And that's not good. So rather than having this single point of failure, what if we just took the ledger and instead distributed it across the globe? So in this case, we have 4 depicted on the map because that's all that fit while still looking reasonably okay. But in the case of Bitcoin, which Bitcoin does this, spoiler, it distributes it across 10,000 plus different computers across the globe.
10,000 public copies.
Yeah. And along with that, there are so many complications, as you can imagine, about keeping things in sync and making sure that, what if the ledgers disagree? And we'll talk that's what the meat of this course is about, is how it works. But the innovation or the idea is to spread out the ledger. So there's not a single point of failure. And you're not relying on, one person or one place. Instead, it's all spread out.
Yeah.
So Bitcoin wasn't the first to do these things, but it built upon previous innovations that are probably not as well known, but we're going to talk about them now.
Okay, so the 3 problems that a digital currency that forgoes a central authority needs to address
AKA
are number
decentralized.
1, decentralized. Number 1, it needs to be resistant to counterfeit. You can't be able to create it out of thin air. Number 2, you need to have a controlled supply. Also, you can't create it out of thin air. And number 3, it needs to be secure. So we shouldn't be able to create a transaction from Billy to Kilgore without Billy's permission. So these 3 problems were addressed on the next slide in these 3 earlier attempts at digital money.
So back in 1998, all the way back then.
All the way back in the day.
A long time ago.
I think Abraham Lincoln was president.
Be quiet. Back in 1998, this guy named Wei Dai
created
B money.
Yeah.
And so this is a while ago relative to how fast cryptocurrencies have developed. Bitcoin appeared in 2009-ish, 2008, 9, 10.
8 and 9.
8 and 9. B money has been around for a while.
10 years before that.
The thing is, though, it never took off. What it was
just a prototype.
Yeah, it was a prototype. It was a proof of concept, basically, and a demonstration of a lot of the core ideas in Bitcoin.
Yeah. So it's basically a fragile version of Bitcoin. And part of what made Bitcoin successful is that it's very robust software. And it runs without much maintenance. You don't have to worry about it breaking down. It hasn't broken down in the past 10 years, and it doesn't show any sign of doing that soon.
So it was a decentralized currency, though.
Wei Dai found a way to make digital scarcity. And using cryptography, which we're going to describe in much greater detail in later chapters in this course, but using cryptography, Wei Dai found a way that you can make something that's very difficult, or if not impossible, to counterfeit given modern technology.
Right. And unfortunately, so he actually implemented it. It was a real thing, unlike BitGold, which we'll talk about, which was just a theory or a paper. B-money existed, but it just didn't take off because it was a pretty fragile implementation.
It was basically fragile Bitcoin.
Yeah. So that brings us to BitGold, which also I think was in 1998.
Enter BitGold, 1998, written by someone named Nick Szabo. And Nick Szabo wrote this paper, or published this concept called BitGold. And Nick Szabo's innovation here was something called, I don't think he coined the name blockchain, but he basically came up with a way to distribute a ledger across many machines, across a network. And not only that, part of distributing a ledger is you want to make this ledger untamperable. He also used cryptography in a way that made it very difficult to edit the history.
And then comes the one with the catchiest, best title ever, Reusable Proof of Work.
RPOW.
Back in 2004, so more recent than the first two, which were in the 90s.
So written by someone named Hal Finney, who passed away a few years ago, but is still well known in the space. Hal Finney is actually the first person to receive Bitcoin from the creator of Bitcoin in 2009.
And some people theorize, it's a conspiracy, right? That he was
plenty
actually
of conspiracies
one
here.
of the creators, or if not the creator.
It could be any one of these
It
three
could be
people.
Nick Szabo as well. That's another popular option, right?
Yeah, and it could be a group of them. But so reusable proof of work was an iteration on B-money in that Hal Finney figured out a good way to use cryptography to create a stable supply of a digital currency. So the reason this is necessary with digital money is because if you're creating a decentralized digital money, and we're talking about something purely digital, you need to make something that you can't just copy and paste. If I was supposed to email my digital money to Colt, now there's two copies of my digital money. Colt has the copy in his inbox. I have the copy that's in my outbox. How do we make sure that only one of us spends it? So reusable proof of work, RPOW, was an iteration on Wei Dai's work, and Hal Finney figured out a good way to effectively create artificial scarcity on a digital currency, something you can't just copy and paste and make copies of, effectively making it uncounterfeitable. And when combined with concepts from the above two currencies, we get the next chapter.
Yeah, we're finally getting to Bitcoin. So all that we'll say about these aren't all that important that you actually understand what they did. And if you actually want to read details about them, it gets pretty complicated and hard to understand. But they were precursors, and that's important. We want to make sure that we're not giving you the idea that Bitcoin was the very first cryptocurrency ever to have the idea of a decentralized network or a decentralized ledger.
It was the first successful one.
Yeah, it's the first one that caught on. But for example, RPOW, I mean, it was intended to be a prototype as far as I know, but it could have caught on. And we might be in a different place. Or B-money could have caught on if it just didn't. Bitcoin came at the right time and built on solid innovation in the past.
So in our next video, we're finally going to talk about
Bitcoin. Okay, that's enough.
Real good, Colt.
And we have some demon children.
I feel like we're a radio lab right now. Oh, that's creepy. Okay, next video. Cut.
All right, welcome back. We finally have a video with Bitcoin in the title. So if you skip to this, well, you found the right video to skip to, I guess. But also,
I'm Kevin. This is Colt.
Yeah, we did talk about some important stuff in the past couple videos. We first talked about the different types of money, three different categories that most economists recognize. We talked about this weird sort of fourth gray area type of money, which is a digital currency, like the in-game currency in World of Warcraft, or the, what is it? Something?
Interstellar credits.
Space credit. Oh, just interstellar.
Space credits.
Yeah, and EVE
Space
Online.
money.
Anyway, and then there's another group that we're going to talk about, which are cryptocurrencies. And we've already talked about B-Money and BitGold briefly in the last video. Now we're going to really focus on Bitcoin. It's not the only cryptocurrency, but it's the one we're focusing on for the most part. We'll talk a little bit about Ethereum as well.
We're going to use them interchangeably in this course because most people are going to be most familiar with Bitcoin. But in general, when we say Bitcoin, a lot of these concepts extend to all cryptocurrencies.
Right, but we'll be pretty clear on what's specific to Bitcoin as well.
Yeah.
So what is a cryptocurrency?
A cryptocurrency uses cryptography to do two things. One is prove the integrity of its ledger, and two is to prove ownership.
So wait, we're getting ahead of ourselves. What is cryptography?
Cryptography is the science or the art of sending secret messages.
So the simplest form would be, using a decoder ring that you got in the back of a cereal box to encrypt a little message and send a note in the back of the classroom.
All the way up to RSA or the Enigma machine and different states of the art.
Well, and a lot of
encryption.
things that Bitcoin uses, actually.
Yeah.
Some of them are pretty complicated and force us to devote a lot of time to teach them.
But we're going to cover them. And
Okay.
we're going to hopefully cover them in a way that even if you know nothing about cryptography, will shed some light on what's going on here.
Yeah. So that's where the crypto part of cryptocurrency comes from. Okay, so we have another nice definition here to read out. Take it away, Kevin. You're so good at it.
Bitcoin. I'm good at reading. Bitcoin is a peer-to-peer payment network that is powered by its users and governed by a combination of cryptography and social consensus.
Okay.
Voila.
So peer-to-peer payment network is powered by its users and governed by a combination of cryptography and social consensus. That's basically a way of saying that there is no centralized authority. The authority is the consensus of 10,000 plus users agreeing on transactions in the history of what has happened.
And cryptography to actually reinforce that consensus.
That's the lock on it. A very fancy lock.
In October of 2008, this paper was pseudonymously published by someone, a group of people, one person, he, she, we're not sure, was anonymously published
it wasn't anonymous.
But sort of
Name.
anonymous.
The name given is Satoshi Nakamoto. If it was anonymous, they would say anonymous.
Okay.
It's a pseudonym. Kevin and I have been disagreeing on this.
By someone who went by the pen name Satoshi Nakamoto. That's October of 2008. Now, in January of 2009, the network described in this paper started running on Satoshi Nakamoto's computer. And on January 3rd, 2009, the first Bitcoin block was mined.
We haven't talked about what blocks are, what mining is, and we're not going to right now. But just know that happened in January 3rd.
Yeah, that's the first entry in the Bitcoin ledger was on January 3rd in 2009.
Basically, the first Bitcoin was created.
Yeah. On January 12th, 2009, was the first transaction between two people, or if Satoshi Nakamoto is an alien, we're not sure, between Satoshi Nakamoto and Hal Finney. 10 Bitcoin were sent from the address commonly associated with Satoshi and Hal Finney, and you might recognize the name Hal Finney. That's the person who invented reusable proof of work, the catchily named reusable proof of work.
That reusable proof of work
that we mentioned in the last video.
Okay, so that's the rough timeline for Bitcoin.
Mm-hmm.
So after the paper was published, after Bitcoin was created, it took a little bit for it to catch on and get any value.
Yeah, people started using it. There were people on forums online that were actually running Bitcoin nodes and creating and maintaining the Bitcoin network, but it didn't have any real value until May 22. So on May 22, 2010.
Okay, wait, I want to read this part.
Okay.
This is exactly
you gotta read it verbatim what I've written on this slide.
This is what we have written down. On May 22nd, 2010, a developer bought 2 pizzas using 10,000 units of a then little-known digital currency called, you'll never guess, it's called Bitcoin. Yeah.
My writing.
Okay, it's excellent writing, Kevin. So this was important because this is the first instance of somebody using Bitcoin for something real. And at the time, it was 10,000 Bitcoin, which Wow.
That would be at the height of Bitcoin as of 2018. That would have been $200 million.
So at that point, Bitcoin had an actual value. It still wasn't very high, but it took 10,000 units to buy 2 pizzas. But over time, I think around 2014 is when Bitcoin started to approach the $100 mark.
Yeah. Give or take.
Yeah. And then here's a chart of 2017 into 2018. Obviously, a lot of growth, and then also a
little bit of a crash.
Not so much growth over here, but at one point approaching $20,000 per Bitcoin. I mean, in that year, starting at under $2,000 to $20,000, it was a pretty crazy year.
Yeah, we're going to refrain from commenting on the actual value of Bitcoin here, and because in general, this course is more about the underlying implementation, the technology, what blockchain has to offer. Bitcoin may disappear, but the technology that it represents is likely here to stay. So we're just showing this slide. We're showing the price here to demonstrate that this is something digital and decentralized that does have real value. People are paying up to $20,000 per unit for this thing that was created based on this paper written in 2008.
Okay, so returning back to this definition that we have, peer-to-peer payment network that is powered by its users and governed by a combination of cryptography and social consensus. The social consensus part in particular is what we want to talk about now. So if we go back to a really simple example of Rainbow Coin, but we've implemented it like Bitcoin. It's decentralized, and we have 4 ledgers now. Here's a transaction. Kilgore wants to give Montana 1 Rainbow Coin. That's great. We can record it on a single ledger, the closest ledger to whoever Kilgore is, I guess.
You tell your nearest ledger keeper, I, Kilgore, would like to send 1 Rainbow Coin to Montana.
But the trick of all of this now is letting all the other ledger keepers know. And that can be difficult to make work and keep things in sync, but basically the goal is that everybody finds out about it.
Clip art arrows.
There we go.
More clip art arrows.
And everybody should agree on it, unless there's something fraudulent going on, and we could identify it at that point.
And we're going to cover the idiosyncrasies of this process, but what you're looking at here is effectively what goes on when you decentralize a ledger. You tell a nearby node, and then it propagates across the network.
Yep, and they're constantly communicating with one another. Basically, hey, did you hear about this one? Did you hear about that one?
Yeah.
Did you hear about that one last night?
So one thing to note about this picture is that this happens over time, and it's hard for people to grasp, but the idea of Bitcoin being governed by social consensus means that there's not a finite moment in which your transaction has happened. It's based on when most of the network agrees on your transaction. When you send it to a nearby miner, it's not necessarily immediately done. You have to wait until the network has accepted it. And hypothetically, more than 50%. In general, we look at more than 50% being the benchmark for when a transaction is complete.
And one really odd side note that we didn't have a good place to put.
There's nowhere to put this slide.
So we're putting this in this. It's not enough for its own video, but this is a slide that talks about the divisibility of a Bitcoin. So nowadays, a Bitcoin is, it's worth thousands of dollars. And most people aren't, in typical day-to-day transactions, aren't dealing on a scale that large.
Unless you're buying coffee in San Francisco.
Oh, that's a very funny joke, Kevin.
You're all weak.
Unfortunately, that's true. I'm stuck with you. So
1 Bitcoin is 100 million Satoshi.
Right.
So
and that's the smallest unit, which it's a little egotistical. I mean,
I don't know if he named it or they named it, but it's called a Satoshi. 1 unit of a Bitcoin is called a Satoshi. And what that means is if you want to buy Bitcoin, and we're not saying that you should do that, you should wait until a little bit later until you know a little bit more about what the implications of buying it are. But if you want to buy some, you don't just have to buy, it's not a minimum 1 Bitcoin. You can buy 100 millionth of a Bitcoin. The fees would be way bigger than what you would just bought. That'd be a terrible idea, but it's very easy to buy 0.1 or 0.01.
Right. And that's pretty much it for this slide. We just need to stick it somewhere.
Yeah. Voila, done.
Speaking of acquiring Bitcoin, in the next video, we're going to talk about some of the ways that you can go and do that. All right, welcome back. We talked about Bitcoin, we introduced it. What we're going to do now is talk about, in broad strokes, 3 different ways that you can acquire Bitcoin. And this is not going to be a tutorial, a step-by-step guide on what you need to do to buy your Bitcoin right this second. we will have more detailed instructions, but we're not going to give any investment advice, by the way.
No investment advice.
But we need to talk about this to understand how Bitcoin works, actually.
Mm-hmm.
So there's 3 ways we're going to introduce. And the first one is to purchase Bitcoin at an exchange.
Yeah, ranked in order of the easiest to most difficult. So
Right.
the easiest way is to just buy it at an exchange.
So what's an exchange?
What's an exchange? An exchange is a private organization that exchanges cryptocurrency for other currency: dollar, euro, yen, peso, etc.
Right. Well, and actually an exchange, there's plenty of exchanges that have nothing to do with cryptocurrencies.
Yeah, foreign currency exchange.
Yeah, you want to exchange your US dollars to pesos, for example, then you can do that online, you can do that in person. But with cryptocurrencies, there are many, I don't even know how many today there are.
Oh, there's a ton of them. Yeah.
Tons and tons of these organizations that you go onto their website or you download their app on your phone and you sign up for an account. You hook up a credit card or bank account or somehow deposit money from US dollars or euros or whatever currency you have into the exchange, and then they give you some amount of Bitcoin. And we're just going to talk about Bitcoin, but some of them support other types of cryptocurrencies.
Yeah, and they typically charge a fee.
Right. So it's super, super easy. It's as easy as, sometimes it's annoying. You have to get verified, or you have to, take a couple steps along the way. It's not as easy as just buying a book on Amazon, for example, but it's almost that easy. You put in some information and you get Bitcoin. So it's easy, but that comes at a cost.
So the risk here, and the problem with exchanges, is that they're not decentralized. That means that exchanges are subject to the regulation of the jurisdiction in which they run. They're much easier to trace. So when you're signing up, you're giving them typically your driver's license or some form of identification that associates you as a person with what you're buying. And they, last but not least, they lack the security guarantees of the Bitcoin protocol. Bitcoin itself is decentralized, but exchanges are private organizations. They're centralized and they're subject to all of the problems that we discussed when we talk about Rainbow Coin.
Yeah, so we want to be clear. It still is Bitcoin, right? The Bitcoin itself is not the problem. The problem is that if you buy it through a company, whatever the company is called, Kevin's Exchange.
Kevin's Exchange is a good one.
I create my account, I give him my money, he gives me the Bitcoin. By default, the Bitcoin is still held by Kevin, basically.
I'm going to hold this Bitcoin
and
for
he
you.
just says, this is yours. I know this is Kevin, or this is Colt's Bitcoin.
Mm-hmm.
But he still is the one who is in charge of it. And that's how most of these exchanges work. That's what makes them so easy. You don't have to do any setup or any of the difficult work to get it into your possession. You just create an account with them and they hold it for you. But that kind of gets back to the whole problem with Rainbow Coin, which is Kevin could be a charlatan, to go back to that word.
I'm a charlatan.
Kevin could be deceitful. He could be trying to scam us, or somebody could hack into Kevin's site and he could have the best intentions, but they could steal the Bitcoin.
I become the single point of failure.
Yes.
And so now we're going to discuss the cautionary tale that is Mt. Gox.
Okay.
So Mt. Gox was an exchange that was established in Tokyo in 2010. So this is about a year after Bitcoin was released. And by 2014, it was handling 70% of all Bitcoin transactions.
Yeah, it became massive. And in today's world, it's definitely more fractured. There isn't a single exchange that has such a massive share of the market.
No, there's no longer such a monopoly. But with that monopoly, in February 2014, 850,000 Bitcoin was stolen. And at the time, that was $450 million.
Nowadays,
that'd be what? If we think of Bitcoin, the stat we'll use is $10,000 per coin. That would be $8.5 billion.
Right.
It's a massive heist. And
this was all people's Bitcoin. Like they had bought it with their own money and the exchange was holding it for them and associating it with their accounts, and it disappeared overnight.
Yeah, so they would log into the website. It would say you still have the Bitcoin, but they just could no longer withdraw it. And this is the problem with Mt. Gox being that single point of failure. It was hacked, or it's still not certain. We're not going to comment on whether or not.
Some people think it's an inside job, and there have been ongoing legal proceedings about it.
Yeah, and if you're curious, Mt. Gox, MTGOX is the way that it's spelled. If you search that, there'll be tons of articles. But in March 2014, they declared bankruptcy, and this actually really tanked the price of Bitcoin. People really lost faith in Bitcoin, and this is a common misconception. People think that because Mt. Gox was hacked, that Bitcoin was hacked. They're entirely different things. Mt. Gox was just a custodian of the underlying cryptocurrency.
So now that we've talked about how terrible some exchanges can be or some of the shortcomings, we do want to mention, though, that it is a very accessible way of buying Bitcoin. It's how probably most people buy their first
Yeah, most entry-level people are going to buy Bitcoin this way.
And so exchanges are something that you want to have faith. You want to be able to trust. And there are so many of them out there. We're not going to endorse any particular exchange, but on bitcoin.org, if you go to...
So this is the Bitcoin Foundation's website. This isn't even necessarily Bitcoin itself, but many people look at bitcoin.org as the sort of de facto authority on Bitcoin.
Right. And so they have a list on here of recommended exchanges, but they still have a disclaimer: perform your own due diligence. And they tell you this note that we'll come back to: choose a wallet where you will keep your Bitcoin. So what they're telling you is use an exchange to buy it and then move it from that exchange into your control as soon as possible.
And we'll cover what a wallet is in the coming chapters. But if you look through this list, you'll also notice some of the well-known exchanges are not on here. And that's because bitcoin.org is engaged in the politics of Bitcoin. They've removed some of the exchanges that, in this case, I believe it's because there's a fork of Bitcoin. We'll describe that later. There's a faction of Bitcoin called Bitcoin Cash, and I believe that Bitcoin.org has removed any exchanges that support this other version of Bitcoin. So if you're interested in buying Bitcoin, it's important to do your due diligence. Just a few Google searches. If you can navigate the internet and do your best to not get phished, then you're probably well equipped enough to make a decision on where you want to spend your money and understand the risks.
So the next way, the next option of acquiring Bitcoin is to exchange it for something. So person to person, peer to peer. I sell coffee. I am a barista. Kevin comes in. He decides he wants to pay for it with Bitcoin. He can send it to me, not through an exchange, but through some sort of app. He can send it to me through an app on his phone or on a computer, pretty much anything these days, any electronic device that can connect to the internet. There's a way
that adheres to the Bitcoin protocol.
Yes.
Yeah.
And so we download an app. It doesn't really matter which one. We'll talk about them later on, but we both have an app. And I basically tell Kevin where to send a Bitcoin to, and then he inputs the address where I told him to send it to, how much to send, and he hits send. And that's kind of it. But there's actually a lot more behind the scenes, and we're going to do a whole video actually showcasing how this works, demonstrating it step by step. And Kevin's going to send me 10 Bitcoin.
Colt's going to send me 1 Bitcoin. 0.1 Bitcoin.
Okay, you're going to send it to me, though. Anyway, so that's one way of getting Bitcoin. So the third way of acquiring Bitcoin, definitely the least intuitive, the least approachable, is to generate Bitcoin to get it through mining. So mining is basically the way that new Bitcoin are created or found, just like with mining gold. A lot of people go out and they don't use pickaxes anymore, but
pan for
all
gold
sorts
in a
of
river.
Machines and crazy equipment, but they all mine, they try and find gold, and some people do, and they're rewarded for all that work. So in the world of Bitcoin, it's an analogous process, except rather than hitting a rock over and over and over, what are they actually doing? What's the point of it?
So we're gonna explain this in greater detail in the coming videos, but miners are the people who maintain the Bitcoin network. So the competition is quite complicated, but really what's going on is, for maintaining a copy of the ledger and for facilitating new transactions, you gradually earn Bitcoin.
Right. So computers are hard at work behind the scenes, and some of them are rewarded with new Bitcoin.
Yeah.
Okay, we'll get into a lot more detail. We have a whole section on mining later on.
Oh, there's plenty more there.
Okay, so those are the 3 ways of getting Bitcoin. Remember, the first one, an exchange, is the easiest, most approachable way, but it also has the main shortcoming of relying on a single point of failure. You can also exchange Bitcoin. So you could do something, someone could send you Bitcoin, or you can send Bitcoin to someone else. And then finally, you could get Bitcoin through mining. Welcome back. So now that we've talked a little bit more about Bitcoin, we're actually going to revisit the analogy that we did in the first couple videos of the course. It was a pretty quick, couple-minute analogy, basically meant to just quickly explain some stuff. So we're going to expand on that previous video in preparation for the next video when we actually make our first transaction. Okay, so back to this Dropbox envelope thingy. What we're talking about here is the idea of a one-way place where somebody can send Bitcoin to. It's called an address, and we're picturing it as this little envelope logo or clip art with this QR code, but in actuality, it looks something like this.
So that's a real address. Don't
And-
send anything to
Yeah.
it.
Well, I mean, it wouldn't
Or
be...
do, but you're
nothing
not gonna...
bad could happen except that you're going to
You
lose
can't
that
get
Bitcoin.
it out, yeah.
Right, that's the point, is that you send something to this address, it's in there, unless you are the owner, the creator of that address who has the private key, which we'll show in a second, to unlock it. We'll discuss how these are generated, what they mean later on, but all you need to know is that you can make these on all sorts of applications, a phone app, a computer app, at will, if you want someone to send you something. You just give this to them. So an address is used to receive the payments, and at the same time, when you generate a new address, you also generate a private key. So you don't really have to do anything, you just click a button most of the time, but you get these two things. And the private key is what you use to unlock the payments.
So on the left is the address we just saw, and on the right is an example private key. They don't correspond to one another.
Yeah, so this is
or
not...
maybe they do, but these are from the Bitcoin wiki.
Well, that would be a freak. I mean, I doubt it.
I doubt it, yeah.
But this is just an example of what a private key would look like. So both of these are very ugly. They're not very intuitive or memorable at all.
No, not user-friendly.
So most people use an app to manage this. But there's nothing, I mean, I could handwrite this and give it to Kevin and say, this is my address. Keep track of this, type this up. But most of the time we use an application that can scan a QR code or something to prevent, having to... It's hard enough to tell somebody your zip code or your phone number.
I don't even know what my zip code is.
What? Let alone trying to tell somebody this. I mean, it's just too confusing to try and read this out loud.
So the QR codes that you'll see in Bitcoin apps, those correspond to this number you see on the left, the addresses.
Okay, so here I have this same diagram of my phone. I'm creating these addresses at will. I make one anytime somebody wants to send me something. Now, technically, we'll get into this later. You could just have one address and have everybody send everything to that, but it's a better practice to make a new separate address every single time, and we'll talk about why.
Yeah, it still works, but there are some safety and anonymity guarantees that you get that you don't have when you're using the same address for every payment.
Yeah, long story short, it's harder to trace if you have a different, unique place where your money is being sent every single time, rather than the same place over and over and over. Just like if I was a drug dealer and I was getting shipments of cocaine from Colombia, I wouldn't ship them all to the exact same P.O. box. I would spread it out.
Yeah, good analogy, Cole. I hope we don't offend anybody with that.
Okay.
Can you actually say that in this?
Wait, why couldn't I say that? Okay, so Kevin's actually going to send me Bitcoin now. I make him an address, as we discussed. Most likely, I show him my phone. He scans a QR code, but I could also hand type the address out or read it to him over the phone, whatever it is. He finds a way, uses an application on his phone or computer to send however many Bitcoin he's going to send to me to that address. And what happens once that Bitcoin is in there? And what if you send the wrong amount?
So, if I were to type the wrong number in and hit send, confirm it, then I would be able to I would not be able to undo what I had just done.
It's locked.
I would have to go to you and say, Colt, please return my Bitcoin.
So, yeah, he puts it in there. Anybody can put Bitcoin in this address is the thing. So if I also sent it to everybody, all my friends, and I said, hey, please donate Bitcoin to this for my scholarship fund or something, anybody could send Bitcoin to that, but nobody can get it back out. And that's a good thing. That sounds very sinister, but that's important. I mean, it's just like a bank. You could transfer money to a bank account, but only the owner can decide where that money goes or transfer it out.
Yeah.
Okay.
So once I've put Bitcoin into the address, or once I've locked it into that Dropbox, what I do is I deposit that Dropbox onto the blockchain. I store that in a public place, and Colt just keeps an eye on the blockchain.
So what is the blockchain actually? When we talk about it, this is a diagram of colorful blocks, but it's just a list of transactions.
It's
right?
a big ledger. Yeah.
Yes, it's a giant ledger. Now, there is some sneaky, interesting math involved in the chain part of it. And, well, actually, the block and the chain components we'll discuss later on. But it's more than just a list of transactions. There's a special mathematical relationship between new transactions and old transactions. And there's a bunch of security benefits. And we'll talk about it.
It being a blockchain makes it tamper resistant.
But for now, all that we care about is that it is a place that stores a history of transactions. So on the blockchain, you can see every Bitcoin transaction in history. Ever since you can go back and see the very first transaction in January of 2009.
Mm-hmm.
So the thing is, there's not one single blockchain really. In actuality, there are copies of it across 10,000 plus computers across the world.
Yeah, all of the miners, the people we discussed earlier on in how to acquire Bitcoin, keep a full copy of the blockchain. So when I put Bitcoin into a Dropbox, I send it to a nearby miner, and they actually share that information with the other miners. And Colt can keep an eye on any individual miner or any individual subset of miners, and that will give him an indication of all of the incoming transactions towards addresses that he has created.
So as you can imagine, there's a lot of work involved in just keeping all 10,000 plus copies synced together and up to date and all of that.
And we're going to cover how that works.
Yes, but at the end of the day, to wrap up our analogy, which honestly has veered away from being an analogy to just
now we just went into it.
Yeah, just intro to Bitcoin. But this ledger, this idea of the blockchain that is distributed across all these different computers is huge to Bitcoin. That's the central building block that everything stems from. So once my transaction is on the blockchain and it spreads across the majority of the network, everybody agrees that this is a real transaction. It's not totally made up, or Kevin has the Bitcoin he's claiming to send me. All of that checks out. Then let's say, it could be a matter of the next day or an hour later, I want to spend it, or it could be 5 years later. I forgot that I had Bitcoin in this address. I forgot Kevin sent me Bitcoin. I forgot Kevin exists. I erased him from my life.
That's
and
hurtful.
Then a couple of years later, I see a news story on Bitcoin, and I'm like, oh
yeah,
I totally have some, don't I? And I go back and I have to find the private key. But if I do find that private key, I can go unlock this one transaction, this one address.
So when people say that they have Bitcoin, nobody actually has it in their possession. It just means that people have the private keys associated with transfers destined to them. It's all sitting on the blockchain, and you don't have to spend it immediately, but when you do want it, you know that you have the private key associated with your Dropboxes, with your addresses.
Yeah, it's pretty weird. There's nothing on your computer or on your phone or stored on your, in your data that actually means or signifies that the Bitcoin is yours. It's this public thing, and you just have to show proof that this one section is yours, or that you own this one little piece.
Yeah.
But you could, your house could burn down. I hope it doesn't. But if it did, and you lost all your electronics, as long as you have the private key somewhere, you somehow have managed to save it, whether it's in the cloud or you have it on a hard drive that you have buried in the backyard or something. If you have that private key, you can go to any computer. You can go to basically anywhere that has internet and prove that you own that Bitcoin.
So, and with this analogy, when we talk about how people have, or when you hear that people have had Bitcoin stolen from them, or when you hear that an exchange has been hacked, it usually means that the keys associated with an address have been stolen. Nothing physically has been taken. It's just this information has been leaked or taken.
Right. Okay. So that's it for now. I'm calling it quits on this video. This was
cut.
Yeah, this is pretty in depth. So next, we're actually going to show a transaction. Kevin is going to send me Bitcoin, and we're going to go through these steps, but in real life, not on slides with clip art. Real Bitcoin. So that's coming up next. All right. So we're finally going to do a real transaction. Kevin is going to send me 7,500 Bitcoin.
I got you, fam.
He's going to make me an overnight multimillionaire. No, he's going to send me a tiny little, what did we decide?
I'm going to send you a millibit, which is 1/1000th of a Bitcoin. No, not even that. I'm going to send you 1/10 of a millibit. I'm going to send you like $8.
Okay. So he's going to send me a tiny little piece of Bitcoin, but the same process would hold true if for some reason he wanted to send me thousands of Bitcoin. Yeah. All right. So really quickly recapping, the first thing we need to talk about, we're going to use iPhones to do this. We could do this from computers, from Android devices, from Windows phones. It doesn't matter. But we need to download an application to help us do this. And there is no official Bitcoin application. There are dozens and dozens of apps on the iPhone App Store, on the Google Play App Store, and so on, that all basically follow the same Bitcoin protocol. They follow the rules. And there's no one official app.
So they're all third party, which means Satoshi Nakamoto didn't make any of these. It's just people who built applications that adhere to the protocol.
Yeah. And so we're going to do a section later on about talking about picking out a wallet app and kind of getting up and running. For now, if you want, you can download the ones we're going to use, but we're not necessarily encouraging you to do that because there are so many out there. We're just using two that we have on our phone already. And so I also mentioned we're using two. Kevin has one on his phone that he's going to use to send me Bitcoin. And just to prove to you that they all work in the same way, I'm going to use a different app to receive the Bitcoin. We could use the same one, but we also didn't want to endorse one over the others. So I'm going to use the app to create an address or many addresses. and each address has an associated secret private key that I need to use, or the app needs to use, if I ever want to spend the Bitcoin. So an address looks like this.
So these are the three representations of an address that you'll see in our slides. On the far left is a real one. This is the base 58 encoding. It's the text encoding of an address.
Yep.
And you'll see this in the wallet app once we open it up. In the middle is a QR code, and the QR code is an easier to use camera scannable representation of what you see on the left.
Yes.
And then on the right is our analogy. It's the open Dropbox. It's an open envelope. And our thinking here is that this looks like something that you could put something in and then you could lock it. And then once somebody locks that Dropbox, only the person who created it can then open it.
Yep. So Kevin could type this in manually. There's nothing wrong with that, except that it's slow and annoying, especially on a tiny iPhone keyboard. And also, it's technically possible that he typed something wrong and it's actually someone else's address. And we'll talk about that. It's unlikely, but it's possible that he changes some characters and it's actually someone else's valid address. And the second thing that a wallet app will generate for you, along with your address, is a corresponding private key. And that private key is super important. You don't want to go sharing that with anybody. You want to keep that safe and secret. Most of the apps won't even show it to you because they kind of handle it all behind the scenes. But yes, it looks something like this. So it's just another long number, as you can see here. And this corresponds only to the address that it was generated along with. And we actually spend a lot of time talking about how these are generated and the math behind it later on in the course. Just know there's a special relationship. So this number unlocks that address, which, if that sounds crazy to you, just suspend your disbelief until we get to that section, because it's pretty mind-blowing how it works.
Here we go. Now we're going to show you an actual transaction.
Okay.
Much ado.
Switching over to screencasts. All right, so you should now be seeing two phones on your screen if I did my editing job correctly. The one on the left is Kevin's phone, and the one on the right is mine. So remember, Kevin is going to be sending me the Bitcoin. He already has Bitcoin. Let's not worry about how he got it. We're just going to focus on this transaction. So he has some Bitcoin, and he's going to send it to me. The first thing I need to do is give him a place to send it to. So the app I'm using, by the way, is called Blockchain, which is kind of confusing because blockchain is also a really important concept in Bitcoin, completely unrelated. Well, the name is related, but they have nothing to do with one another as a company or as a corporate entity.
Completely confusing.
Yes. Anyway, so I'm using this app. Kevin on the left is using a different app called BitPay. Now, we could be switched, and I could use this app to send him Bitcoin. He could use that app to receive it. It's not a one-way thing where you have to have one app to send, one app to receive, but we're just using two different ones just to show you that it works.
Yeah, both of them are our window onto the actual Bitcoin network.
Okay, so what I'm going to do now, I'm going to go to the request tab of my application. I already have it open, and it gave me a new address already. It generated it for me. So if I use this one, I'll actually show this later. Once I do use this, it will give me a new address, a different one. Anyway, so what I'm going to do now is share this address with Kevin. The private key is behind the scenes. It's associated with this address. It's kept secret, but it's in the phone. My app is keeping track of it for me. All right, so I could read this to Kevin. 1G15. Are you ready, Kevin?
Yeah, I am not about to type this. We're going to use a cool feature that says scan. So Colt's going to put his phone on the desk, and then I'm going to hit scan, and I just point it at Colt's phone. So you can see this is going to Colt's nice desk, and then I point it at Colt's phone. Voila.
All right.
Okay, so now I get to, this is Colt's address up here, and just to confirm, I'll ask Colt, hey Colt, does your address start with 1 capital G as in golf, 15, H as in hotel, K as in kilo, P as in
Okay, I'm going to stop you
potato?
there. Yes, it does, Kevin.
All right, then I'm going to send you 0.0001 Bitcoin.
All right.
98 cents. I got you. Send.
Okay.
Now, it's actually not sending yet. It's calculating a fee. Oh, and it says Bitcoin miner fees are unusually high. And this is because, oh, interesting, we have limited space on the Bitcoin network. So because the price is spiking right now, who knows where it'll be when you are watching this, it means that there are fewer spaces on the blockchain. And in order to get my transaction included into a block, I have to pay a little bit extra fee. What's that come down to? Oh, that's fine. 40 cents of a fee, I can live with that.
Yeah. So or you could wait and pay a lower fee, and it would eventually make it in. It's just that we're recording a video, so we need this to happen sooner rather than later.
Yeah, look at this. I can even tune how much fee. I can do urgent. That means I'm willing to pay way more. How much would that cost? Apply changes. I understand. Oh my God, $2 for an urgent transaction? Let's do it because we're doing this live.
Okay.
So we're paying $2 to send like 90 cents of Bitcoin.
As a side note, we have a video on this where we talk about block sizes and transaction fees and how that all works. So you can see now that it's a fact of life in Bitcoin, but as far as the network being overcrowded and what that means and how that relates to fees, we'll explain that later on in the course. So Kevin right now is having to type his password. So hopefully if I did my job right, again, we're editing that.
All right, so here goes nothing. Yeah, you could definitely see this. Can you just block half of it out?
I'll block it out.
Let's try this. Sending, signing, voila.
Okay. So Kevin typed his password in. It showed that it was sent. Okay, so you sent it. Does that mean I have it now? Is it mine?
You don't have it yet.
Are you sure? It says, I got a notification right here. Payment received, 0.0001 Bitcoin, 98 cents.
So that's just indicating that it sees an incoming transaction. You have to wait until that transaction is confirmed by the network. And let's go let's inspect the transaction.
Okay, so if I go over to my transactions, we can see that there's a new one here that said received, and it says down at the bottom, pending. So it shows my phone knows about it now. This app knows about it because it's basically out there on the network, but it hasn't been officially added to the blockchain. And you can see 0 out of 3 confirmations. What else? You can see who is sent from. So this was Kevin's. This was the Bitcoin address he had Bitcoin in that he sent it to me from. You can see the value when it was received, currently 98 cents. Who knows? It'll be different probably in an hour.
$1 million.
And also, there's this thing down here, viewonblockchain.info. So what this will do is if I click on it, it will take me to a website that will show me the blockchain, information about my transaction. So I'm going to do that. And if we look at what it says here, we can see the address that it was sent from, and we can see that it says unconfirmed transaction. So it's going to take a little bit. But eventually, we'll cut back to this and we'll see that it has been confirmed and that the Bitcoin is considered mine. Currently, it's not mine. It's sort of in the ether in this, well, I shouldn't say ether because there's Ethereum is a whole other currency. But it's out floating around waiting to be officially recognized because potentially Kevin doesn't have the Bitcoin or the network is down or something could happen where...
Yeah, we'll talk in a later video about what I, as the sender, could do to, in a way, steal it back. You typically, in the Bitcoin network, it's a rule of thumb that you don't spend your transaction, you don't consider it sent until it's confirmed.
Okay. All right, so let's cut now and we'll come back once it's finished. So it's about 10 minutes later. I guess the official times on the phone will actually tell how long it's been. But what we can see now is that my transaction is still pending down here at the status. I guess, I don't know if this is showing up where I'm clicking. Anyway, it says pending, but now there's 1 of 3 confirmations. So remember in the one video ago, we showed this where the transaction itself is added to something called the blockchain. It's just a list of transactions. Looks something like that in our animation. Well, what has happened now that I see 1 out of 3 confirmations, this tells me it is actually on the blockchain now.
So a note about confirmations. When you see confirmations in an app like this, what it means once it is confirmed is that my transaction is now on all of the miners' computers.
Yeah. So what I'm going to do, I could click on the phone and do this. And this is one website called blockchain.info that allows me to view the blockchain. Remember, it's a public thing. Anybody can build a website that interfaces with it. All it does is display information. It's not changing anything. It's just purely looking at this blockchain, this super long list of transactions, and just showing it to us.
Because it's all public.
So rather than doing this on the phone, where it's a small screen, I'm also going to show you that we can do the same thing on the computer. You could do this yourself and go back and look at this transaction in history if you wanted to, however many days or years later you're watching this. Okay, so what I can see on this website, if I scroll down, it tells me a bunch of information about the transaction. We're going to learn a lot more about this later. But what I want to point out is this little bit here, included in blocks, and then it gives us a unique number for a particular block. And we haven't really talked about blocks, but this is just a division of this chain of blocks. It's a division of this long chain of transactions, 521259. So I'm going to show that on my computer, I'm going to go to a different website. I could use this blockchain website, but I'm actually going to use a totally different website called btc.com. There's another one that's popular called the Blockchain Explorer. It doesn't matter. And I can see here a list of latest blocks. And I'm going to come down to this one, which matches that number we had talked about, 521259. And this is now going to load all the transactions. Did I click on it? This will now load all the transactions in that block. So you can see here that there are 2,115 transactions, just like mine, probably different amounts of money and different addresses, of course, but they're all in this one block.
And the number of transactions that fit in a block varies because transactions aren't all the same size. It's how many transactions fit into 1 megabyte, and in this case, 2115.
Yeah, we have a video on that coming up, but you can see some of them just look larger. There's more addresses in or more addresses out, but that's all we'll say about it for now. So what I could do, I could type my entire address up here and search for it, or I could do a Command F. All I'm going to do, I know that it starts with 1G1. This is not the most efficient way of finding it. This is not my address here. This also starts with 1G1. But what I'm going to do is just cut to it. We've already found it. I think it's on page 7 here. All right, here it is. We're on page 5. Took us a second. It would be easier, honestly, to just scan a QR code and view this on your phone, or type this in manually, or copy and paste the address if you really wanted to search for it. But we just did an old-fashioned Command F for 1G15. Here it is. So what you can see is this is Kevin's address right here, 19QPY. He sent me, what was it, 0.0001 Bitcoin. This is my address. Now, we'll talk about the second address later, but briefly, all that you need to know is that Kevin had other Bitcoin in this address he didn't send me. He had 0.0079 something Bitcoin. He only used 0.0001.
I unlocked that Dropbox, and instead of putting the change back into the original Dropbox, I actually create a new one. So to get my change back from this transaction, I just create a new destination.
Yeah, and his phone did all of that for him, his app. But this is Kevin's address up here. Both of these had to do with this transaction. This is the one I gave him to send me Bitcoin to, and this is his that was generated to hold his change. But that's all we'll say. But you can see it. It's now here on the blockchain. It's public. You could come visit this at any point. If you wanted to find this quicker, you could just search for this. This is a really long thing to search for, but this is our transaction. It has a unique identifier. You could go to this exact block number and just do what we did. You don't really have to spend time doing this anyway. It's not that interesting. But just to show you, you could see this. So once it has 3 confirmations, and we'll talk about what that is later, which if we cut to my phone, we can see it now does. It's officially confirmed, and I can consider that Bitcoin mine. Everything is kosher. There was no fraud involved. I have the possession of the Bitcoin, which really just means I have the private key on my phone to spend that Bitcoin. Everyone can see that that address has it, but nobody can spend it unless they have my secret private key.
So if I were buying coffee from Colt for Bitcoin, then it would be safe for Colt to give me the coffee now.
So that process, it takes a little bit of time, and that's actually one of the complaints people have about Bitcoin that other cryptocurrencies attempt to solve. We'll see that later in the course. But for now, this is what we're stuck with, and it works well. It just sometimes takes longer than you'd expect. As you saw, we had to pay a little bit of a fee as well. But it's done now. I have the Bitcoin, and this is the same process whether we're talking about 1,000 Bitcoin or 0.00001 Bitcoin. So what we're going to do now, we're back in the slides, is we're going to discuss basically what happened post-send. So in the previous transaction, Kevin sent me 0.001 Bitcoin. He hit send. It's not mine immediately, as we discussed. I get a little notification, and it says somebody is trying to send you this, but it's not confirmed, so you can keep an eye on it and check back in, essentially. So we're going to talk about what happens behind the scenes after he hit send until the time that it's considered mine.
So before we talk about what happened with our Bitcoin transaction, we're going to go over a little bit about how an actual normal application works. When we say normal, this is just the general way to build a networked application on a phone.
Okay.
And it's using something called a push architecture. So suppose I'm sending a text message. I have the purple phone. I'm on the left.
Okay. I really love color purple, so I kind of wish that was mine, but
It's a nice color.
okay. So he's going to send me a text.
Hey. So what my phone does is it sends a message. It sends the hey up to the cloud. And the cloud, in this case, let's pretend that it's WhatsApp. Okay. So hey hits the cloud, and then WhatsApp contacts the destination, contacts the white phone here, and pushes the information down to the white phone.
Yeah, it's like a mailman or woman coming to your door saying, "Hey, I got something for you.
Exactly.
Here is a delivery." It's the equivalent happening to my phone. The WhatsApp server is saying, "Hey, this is for you right now, just this second, from Kevin."
So that means the server knows about Colt's phone.
Yeah, it has to know because it has to be able to tell me.
Yeah. Now, in Bitcoin architecture, unlike a mailman arriving at your door, the way Bitcoin works is called a pull architecture. And this isn't exclusive to Bitcoin, but it's definitely not the standard way to build an application.
At least not nowadays.
Not nowadays. So with a pull application, I can send a text message. Suppose we're implementing a text messaging platform using a pull architecture. What would it look like? I would send the hey, and I would send it up to our network. Pictured here as a globe.
It could be a cloud, though. There's no reason it's not a cloud.
Cloud would be fine. I just want to do different clip art.
But it's a server somewhere, a computer somewhere that recognizes, oh, okay, there's a message here. I'm going to add it to my list of messages or something.
Yeah.
And it's for some person named Colt. But what it doesn't do is push the notification, doesn't push the data down to my phone. It leaves the responsibility to my phone or to any phone to check. So instead of a mailman, think of this as...
But like a P.O. box.
Okay, you could, sure. I was gonna say, as an annoying toddler, constantly asking, "Are we there yet? Are we there yet? Is there anything for me? Is there anything for me?" Over and over and over. That's what my phone is doing. My phone is gonna check. Is there any messages? Please, message, please. Any human contact.
Has Kevin texted me yet? So Colt's phone would look at the actual cloud, reach out to the network itself, and check whether or not there's a message. So in this case, it would see the message to Colt, and voila, hey.
Right.
So to the end user, it still looks like there was communication between the two phones, but there's a difference between the push and the pull. And that's really what's going on in the Bitcoin network. The cloud in Bitcoin, one distinction here is that this cloud right here doesn't need to keep constant track of where Colt's phone is. The cloud and the application just works in a way that you trust that the recipient will come get the message when they need it.
Yeah.
That's what's going on in the Bitcoin network.
So revisiting our transaction. In this case, well, you're sending me 1.5 Bitcoin apparently.
Yeah, and I had 8 Bitcoin in this case.
Wow, that would be nice here.
Feeling generous.
So he scans my QR code. This is the transaction happening, right? Then what happens? He clicks send. Then that is not the end of the transaction, as we've discussed. That's just the very beginning, honestly. That's kind of like the request for the transaction. And the first thing that happens is that Kevin's phone broadcasts the transaction to nearby miners. That's what the app does. It says, hey, Kevin, nearby miners, this address, which is Kevin's address, wants to send 1.5 Bitcoin to Colt's address. Of course, it doesn't say Kevin and Colt, but that's easier to talk about. So that would look something like this. Goes to the nearest miner that we can find. The app, these apps may go to more than one miner. I don't know exactly how they work,
I think in
honestly.
general, they try to connect to 8.
Okay, so they connect to some number saying, here's the initial thing, go tell all your friends. And so that's the second part. Miners then relay the transaction to more miners. So here we go. Propagation, our favorite word.
I worked very hard on these. I like these a lot.
That's nice.
It's a good color,
it.
purple.
Yeah, purple's great. Okay, so this transaction now, it's spread across the globe. And unlike that game of like telephone or something where things mutate, you know what I'm talking about, where you whisper or something?
Yeah.
The point is here that these are computers and it shouldn't change. It should be the same across all of them.
I think it's pretty accurate.
So then the final part, and this is important, this takes some time. When a majority of the network accepts the transaction and saves the block, what that actually means to accept it and save the block, we'll get into much later not much later, into much more detail later in the course. But just know that there's some conditions that have to be met and some work that has to be done. But once the majority of the network does that, the receiver considers the transaction complete. But I never get any sort of notification or anything that appears on my phone that just from the network saying, okay, you're done now. Like that transaction is done. It's up to my phone to check, to pull, yeah, and say, hey, did that transaction, is it by any chance considered done yet? Is it still pending? Was there a problem? Is Kevin an absolute liar and he doesn't have those funds? What's going on? It's up to the phone to check, or it doesn't have to be a phone, but it's up to the individual person to check. And we have a little slide to show that. I got ahead of the slides, but you can see the phone is broadcasting up. Hello, is there anyone out there? Do I have a transaction that finished for 1.5 Bitcoin to me? And you can see that the total updates. I now have 1.5 Bitcoin because, yes, the transaction was considered finished. Okay, so then a common question. Does my phone need to be on?
No, it doesn't. That's because sending Bitcoin is just adding a line to this ledger, and it's really up to the recipient to check when they need it.
Right.
So in our Dropbox analogy, ultimately, somebody puts the Bitcoin into your Dropbox, and regardless of whether or not you're there to see it deposited at town hall, town center, or onto the blockchain, it's still there. And it belongs to you. Nobody can take it. So your phone can be off. You could be hiding in a cave. It's still going to be yours. You're the only person who can claim it when you do ultimately want it.
Remember, nothing is actually sent to my phone. The app doesn't receive anything. All the app is doing is looking to this public list and just checking, hey, is it on there yet? Is it good? Which
is it good?
Yeah,
is it
it's
yet?
really, it's kind of a weird concept when you think about it, that there's nothing actually being sent to my app itself. I'm just adding it to this public list that anybody can look at, including my app. All right, so that's a rough overview of what happens behind the scenes between the time Kevin hit send and then the time where I actually consider the transaction done. All right, welcome back. So far in the course, we've talked about the terms mining/miners. We've mentioned that they exist, mainly in this context. We've shown you a picture of a map with a couple of different ledgers, and we've talked about how rather than having one single centralized ledger, we spread it out across the globe. We have these different people, these miners is what we call them, these machines that are in charge of maintaining the ledger and keeping it in sync. So the picture actually looks something more like this. Currently, there are, 10,494 nodes that this website called BitNodes is recognizing on the network. So each one of these is a miner. So, what island is this on? Oh, Bermuda. Okay. So there's one on Bermuda, for example. And then in certain areas, that you would expect probably, like in the denser parts of Europe, there's a bunch of miners and they're all pretty close together. But generally you can see they're distributed, well, actually I wouldn't say it's very, very evenly across the globe, but they are all over the place overall. There's miners in every continent. Well, actually, I guess not every continent. I doubt there's not one in Antarctica. Nope.
Not yet.
Okay, so every other continent. Okay, so that's all that I'll show you on this webpage. There's a bunch of miners. You can explore them if you're curious. So we've seen that there's a ton of them. What do they actually do, Kevin?
So Bitcoin miners have three main responsibilities. The first, which we've gone over, is storing the ledger. So that means storing the entire history of all Bitcoin transactions.
All the way back to 2009.
All the way back to the first one.
How many transactions is that roughly?
So as of April 2018, there's about 300 million, and that means that the entire ledger is about 170 gigabytes. So it's quite large.
Okay, so they store the ledger, and all that really means is that as a new transaction comes in, this is the slowest animation. No, it's not good. Okay, so this is obviously a simplification of what the ledger looks like. There aren't people's names on there, remember. It's just these addresses that are much uglier and scarier looking. But at the end of the day, it's the same idea. It's a bunch of transactions. 170 something gigs, you said, right?
170 gigs, yeah.
Okay, so they're responsible for not only keeping it, but also telling each other about transactions.
So the second responsibility is to relay transactions. And that means when somebody broadcasts a transaction on the Bitcoin network, it'll probably hit just a few miners, and each miner on average is connected to about 8 others. And that means when a miner sees a new transaction, they broadcast that to the 8 miners that they are connected to.
And do we have a slide on that? There we go.
So what's that look like? So this bottom left is a wallet app sending Bitcoin. It hits a nearby miner, that hits a nearby miner, and voila, it propagates across the network.
Across the entire network.
That takes usually 10 to 15 seconds.
Right. To get to all 10,000, whatever it is, 490 something right now?
Yeah, minus a few stragglers.
Right. Well, and also, we haven't talked about what happens if they disagree or there's a problem.
Oh, we'll spend plenty of time on that.
So it's not always smooth sailing. It's not always that everybody just fully agrees on something.
But in general, most of the network is accepting the same transactions. They're all running basically the same software, adhering to the same protocol.
Right.
It's not that often that the miners
disagree. An interesting thing would be, so you said it takes 10 to 15 seconds roughly to propagate. Imagine that I'm on one side of the world, and I somehow am on the other side of the world too. I have 2 devices, and I'm spending Bitcoin from the same address.
Yeah, that's called a double spend.
And I'm spending all that Bitcoin, and I'm close to, let's say, Japan, and then I'm close to somewhere in the middle of the U.S. Well, the nearest miner in Japan is going to start telling all the other miners, hey, Colt just spent all of his Bitcoin from this address. But then the miners closest to me in the U.S. are going to say, hey, Colt just spent all of his Bitcoin sending it to this place. And then they're going to meet in the middle somewhere and try and tell each other about them. And there's going to be a problem.
Yeah, so what miners will do is they will just respect the first transaction they see.
Okay, so we will talk a lot more about what happens when there is a disagreement.
Yeah,
but that's one of the responsibilities.
That case is called a double spend, and we're gonna cover how the network actually deals with that and how that's prevented.
Okay, so along with storing and relaying the transactions, one of the main responsibilities is verifying the transaction. So That means things like, does the sender have sufficient funds? And how would we know that? Well, if we have a ledger, remember, even if it's just a history of transactions, it never has the full balance for a given user, we can still calculate it. So if a miner has the ledger of 1.7 or 170 something gigs of transactions, we could easily just go through and total up all the transactions to and from a given address, like we could here, right? We can see
simple example
here. Who is this? Kilgore starts with 5, sends 5 to Billy, then Billy sends 3 to Montana.
At which point Billy has 2, Montana has 3, then lastly Montana sends 2 to Kilgore. So just from the information in the ledger, you can derive the balances of every account, of every address.
So what the miners are actually doing is slightly different, but the idea is the same. They can verify that a given address has the Bitcoin it's supposed to have that it's trying to send, right? So I can't just say, oh yeah, I'm going to send Kevin 10,000 Bitcoin when I only have 0.5 Bitcoin in a given address. And that brings us to the second way that miners verify transactions. They check if the transaction is authentic. So what does that mean?
So when a miner receives a transaction, they need to verify whether or not the actual sender has sanctioned the transaction. And back to our Dropbox analogy, a miner needs to verify that the sender actually has the key to unlock the Dropbox. Remember that everyone on the network can see what's in each Dropbox.
Right.
It's just a question of whether or not the creator of that Dropbox has actually given permission to release the Bitcoin associated with it. The miners actually perform that verification. If you send a false transaction, if I say, for example, try to spend Colt's Bitcoin, I won't be able to produce a valid key for his Dropbox. The miners are going to see that invalid key and signature, which we'll describe later, and they're going to reject my attempted transaction.
Right. Yeah, remember that an address is something that anybody has access to. You can look at the blockchain. We can see, and we could go back and find an address that has a crazy amount, 19,000 Bitcoins in it, for example. We were just looking at one a couple minutes ago. You can see that address. So there's nothing stopping me from trying to spend that Bitcoin. I can say, oh, I'm sending, remember that a transaction is basically just an address from and an address to and an amount. So I could try and falsify a transaction and say, oh, this is mine, this address, copy that over, pretend to send it to Kevin, but that's not going to fly because miners are going to very quickly realize, yeah, you don't have the private key for that. And so that's a really important thing that miners are doing, obviously, because if you could just spend anyone's Bitcoin all over the place, that would not be good.
No, sir.
Okay, so then the last thing we should mention, this seems like basically it's kind of a lot of work on if you have a computer running. I mean, just honestly for me, just storing 170 gigs on my computer, that's precious real estate. and that's not to mention the fact that these miners are running nonstop, and they're actually doing more than we told you about. We'll explain later. But it all comes with a potential reward, which we've already introduced earlier on. The third way of getting Bitcoin is by being a miner and earning it.
Yeah, they're rewarded for doing these 3 responsibilities you get paid for.
Right.
And the question that a lot of people have is, oh, can I start mining? And
you could.
Anyone can mine, but to be honest, it's a little bit late. Because as of right now, if you were to run a 2018 grade laptop all year, 24 hours a day, then you would probably earn less than a penny. And that's in a year. And that's because what's going on is there's now specialized hardware that does exactly these 3 things. And it's much more efficient at performing the actual tasks that a miner has to do than, say, a general purpose laptop.
Yeah, there are these massive warehouses, and I've at least seen some photos of the ones in China.
Yeah.
Where they're like, it looks like they're like half a mile long of just computers, these servers that are, all they're doing is mining and making a lot of money because they are specifically made to mine and nothing else. They're not made to browse the internet. They're not made to play games on. They just mine.
No, it's an economy of scale. The people who are buying these devices, they're called ASICs, A-S-I-C. The people who are buying these devices are buying many of them. And they're expensive if you buy just a couple. But if you buy 1,000 or 10,000 of them, they get cheaper. The price goes down as you get more of them. And also, if you have access to cheap energy, these devices consume a lot of power. If you have access to cheap energy, for example, in China compared to in San Francisco, then you're going to run a more efficient mining operation.
Right. Anyway, So we actually have a lot of content on mining, on how it works, how miners are rewarded, how it's determined who gets a reward, all of that stuff. We even have a couple slides on ASICs and some of the things that we already brought up. But all of that is to say that, yes, you could get into it today, but it would not be very lucrative unless you're already in a very solid financial situation. You have a lot of resources at your disposal, in which case, you could totally make money doing mining if you're a billionaire.
Yeah, there's also mining opportunities in the other currencies.
Yes, absolutely. So what's happened with Bitcoin, I think, has been a bit of a cautionary tale, and people are not. It was never intended for there to be these conglomerations, these massive warehouses of
devices
miners.
that are specific.
It's supposed to be spread across the world, and it's supposed to be not concentrated. There's not supposed to be any sort of centralized, group, and it's not. It still isn't centralized. But mining itself has become sort of an industry, and there are other cryptocurrencies that have attempted to solve that. We'll talk about later, but they make it harder to game the system and to spend a lot of money in order to make more money.
Yeah.
All right, so that's a rough overview of mining. Next, we're going to dive into cryptography, figure out where that crypto part comes from in cryptocurrency. All right, welcome back. So this video and this section marks a pretty radical shift in the content of this course, because we started out, and I guess that sounds scarier than it should be, but we started out talking about the general terms, money, the history of money, types of currencies, setting the stage for Bitcoin. Then we just wrapped up a quick intro to Bitcoin section where we basically talked about it at a high level. We showed an actual real world transaction. Now we're moving into the nitty gritty. We're going to talk about the underpinnings of Bitcoin, what actually makes it work.
And why we trust it.
Yes. And so this section is all focused on cryptography, the crypto part of cryptocurrency. So why do we care? Well, let's imagine we have 5 miners. We have a very small Bitcoin network here, and these miners are all in charge of maintaining the ledger. Now, if the ledger was just a text file or an Excel spreadsheet that anyone could go and just update at will, you could go back and edit something in the past. For example, let's say 3 of them decide we're going to get rid of that pink transaction. Whoever that was, we're erasing
That's
it.
Montana's.
Okay, sure, it's Montana.
We're deleting Montana's transaction.
So these 3 miners could get together and do that. And this is in the past, right? This has happened long ago. On our diagram, it doesn't look that long ago, but imagine this was 6 months ago. There's nothing stopping them unless there's some sort of cryptography involved. So how does cryptography relate to Bitcoin? How does it help us secure the ledger? How does it help us ensure integrity of our transactions? That's what we're talking about in this section. It's quite complicated, but pretty fascinating stuff. But let's start with a simple definition. What is cryptography, Kevin?
I don't know if this is a definition, but this is the etymological root of cryptography. It's Greek for secret writing.
Okay. Well, my dumb definition that I like is that it is the art and science of secure communication in the presence of an adversary.
It's a good one.
So basically, it means, I like to think of it as just really fascinating and challenging word puzzles and games, because a lot of the cryptography stuff that we'll talk about is pretty interesting. It's cool stuff, but it's developed and its roots are in war most of the time, in wartime.
War or politics.
Or politics, being able to write a message in the presence of an adversary and get it to some ally somewhere and have them be able to understand it without, somebody intercepting it shouldn't be able to understand it or read it right away or make sense of it.
So let's get into a simple example. So the one that you might intuitively know if you were to come up with cryptography on your own is called a Caesar cipher. And this is the one, Julius Caesar was credited with inventing this. I'm not sure if he did, but it's been around for a long time. And it's basically, you have this thing called a cipher. And this is a code right here. So we can take an input message and we're going to map the characters in it based on the left side and turn them into the characters on the right. And then when you get a coded message, you can convert them in by going backwards, the inverse, from right to left.
So let's say that I live in one city and Kevin lives up in the mountains somewhere, and
the woods.
Yeah, I need to communicate with him, and we're doing it by
secret.
Raven. Yeah, so I'm gonna go to my Ravenry and collect my strongest bird, and I'm gonna send a message, hello, and I'm gonna encrypt this message by following my ciphers. So H becomes this V. E becomes a G, L becomes, where are you?
T.
L, a T, and so on. So we end up with VGTTX, Vigitix. And I send this to Kevin via Raven. He receives
it to that poor little Raven, and then...
And he has this cipher on his end, so he can make sense of this. That's the only way it makes sense. So he can figure out that I was actually wasting this poor raven on sending him the message, hello.
Like, what? Hi?
Yeah,
Hi,
and
hi, Colt.
he can do the same thing. He sends me his response
I'm
back.
going to send you goodbye.
Is goodbye. Okay.
So
So this is obviously not a very good approach. This is not a very secure way of communicating because it's very easy. Well, first of all, if somebody just happens to find our cipher, our cover's blown. It's very easy to figure out what we're saying. But second of all, we don't even need to, somebody doesn't need to intercept this cipher. They could just work backwards from this.
Yeah, there are patterns to find here.
Yeah, and if we're looking, if we were trying to do this, most basic, let's look at a paragraph of code. We'd look at the single letter words maybe. In English, we might look at, A and I. Those are pretty much the only two single letter words.
Or O if it's the 1700s.
Sure. So we look at those, and then we can work backwards and figure out, okay, so this is probably I, and then we can plug that in and look, where are all the other I's? Where are all the other A's? Or vowels are the most common by far, or S's often come at the end of words, for example, and you could write code very quickly to figure this out. It's
double
not
T's
secure.
and double L's, yeah.
So this is good for sending like messages behind your teachers back in middle school, but that's about it.
The next step, or after a few steps, came a much more advanced version that you might have heard of, and this form of cryptography is called the Enigma code. And to code a message in the Enigma code, you use an Enigma machine.
And this was back in
World War II.
Pre-World War II and World War II. I think work started a little bit before. This is all, if you've seen the movie, The Imitation Game, this is basically what we're talking about here. Really good movie, by the way, if you haven't seen it.
It's a good movie.
So it's this much more complicated algorithm, a much more complicated way of encrypting a message, but it's the same idea. You have some message. In this case, it was developed by the Germans mainly to be able to communicate during World War II. They would basically type the message into this machine. There's a bunch of settings, different dials you would change, different settings that would rotate on a schedule, as far as I remember. Mm-hmm. And you would type the message in, and then it would light up to show you what the actual message that you are going to send is. So you would hit H, for example, and it would light up some other color, or light up another letter.
So you broadcast that on the radio, and then your U-boat captains will get the message and then plug it into their Enigma machine with the same settings, and out comes a German message.
Now, part of what makes this so hard to break is that if the Caesar cipher, you type in the letter H, for example, it's always going to be, let's say, V in our cipher. It's always V over and over. But if I type a message here, this is an online version that allows me to encode and decode. So these would be like the different dials, the rotors that we could alter. So I'm just going to leave it with these default settings. If I type hello, notice what my output is. There are two L's, the same letter, but they're not showing up here as the same letter. Or if I just type the letter P over and over and over, I'm just hitting P like 10, 20, 30 times, look at this output. It's pretty crazy. So to work backwards from this is much, much harder. Now, it's actually not that sophisticated compared to the algorithms we have today, but back then this was a monumental effort to overcome. That's what the entire movie, by the way, there's a sponsored link up here, just notice that. That's what The Imitation Game is about this really gifted mathematician and cryptographer, computer scientist named Alan Turing.
Played by Cumberbatch.
No. Benedict Cumberbatch, Kevin. So as I was saying, with computers the way that they are today compared to World War II, the Enigma machine, the Enigma cipher would be much easier to, well, I'm actually just assuming that, but I do know that the algorithms and the things we're going to learn are currently unbroken. So what I mean by that is that the things that Bitcoin relies on, for example, to secure the ledger, there currently is no way of breaking them. So they're much more secure, they're much more advanced. Now, maybe 10, 50, 100 years down the line, that won't be the case. But currently, the cryptography that's used in Bitcoin is rock solid.
Yeah, there's a lot of people trying very hard to subvert these algorithms, and so far, so good.
So to wrap all of this up, cryptography, aside from being fascinating and cool and The Imitation being a good movie that you should see, on top of all of that, cryptography is used inside of Bitcoin, and we'll talk about how and why, and we're going to learn the specific algorithms, but just know that cryptography is what allows Bitcoin to be secure, and it's what allows miners to verify the authenticity of the ledger, to make sure things haven't been changed, to make sure that I have the Bitcoin that I say I have. It's a really integral part of the whole system.
Benedict Cumberbatch.
Oh my God. Welcome back. So one of the really important building blocks of cryptography that Bitcoin relies on all the time is called a one-way function. So a one-way function is actually a pretty basic concept, and we're going to just briefly introduce it in this video, but we'll build upon this and we'll see eventually how it relates to Bitcoin.
So first, what's a function?
Okay, well, a function is, okay, this is going to be a kind of a wishy-washy definition, but it takes a set of inputs and relates it to a set of outputs. So if we think back to like algebra, think of a function like x squared. So you plug in an input, like let's say 3, and it goes into x squared. What is the output? We would get 9. Right? That's the right math, yes.
Yeah.
3 times 3, we get 9.
So if you plug in 4, you get 16.
Yes. Okay, so that's an idea, or that's an example of a function.
So the
Take
function,
some input and we get an output.
Yeah, the function there is x squared.
Right. So what we have here are some emoji functions. So we have one called color, and we pass in the input is an emoji, and it spits out a corresponding output that just describes the main color of that emoji. So here we have a water droplet, and we get blue. Or we have the green apple emoji, and we get green as the output. So Kevin, what is a one-way function though?
So imagine we try to work backwards.
Okay.
So in the next slide, we just have a question mark, and we have the output of red. So given the output of this one-way function, the color function, you can't necessarily determine the input. Unlike x squared, where if you have 9, you know plus or minus 3, your input on the color function can't be determined just from the output. So for the color of red, you can't determine whether or not which emojis are red. Strawberry, tomato. You don't know
there's
which
like
one.
a red circle, a red X or something.
Like those devil faces.
Oh yeah.
Yeah.
And the angry, like pouting face.
And this is a unique property of this type of function in that you can't determine the input from the output, but it's very easy to determine the output from the input.
So, okay, let's contrast this with something that is not a one-way function.
The
like
plus
this,
one.
plus 1. So this function, plus 1, you take a number and as the input, and it just adds 1 and gives that as the output. So for example, you plug in 5, we add 1, we get 6. You plug in 0, we add 1 to 0, we get 1. So if we have 6, for example, we can work backwards and figure out the input. We know that, okay, if plus 1 generated 6, we subtract 1, and we know that the input was 5. So this is not a one-way function. Here's another example. This is a one-way function. Shape is another function that takes an emoji. This time, we pass in what is this object? I haven't seen one of these in a while. A shiny circle.
I think it's a VHS.
Okay.
It's a floppy disk.
Okay. Yeah, that's our attempt at being funny.
We try.
So we pass in the CD-ROM, and we get the output is circle. But of course, there's a ton of circular emoji. Every single face emoji, happy face, slightly smiling face, all of those are circular.
You wouldn't be able to work backwards from the right side. Also here, given the is even function.
Yeah, so we're not only working with emoji. Here's another example.
So 5 is not even, so out comes no. If we plug in 6, it's going to give us yes. But given just a yes or a no, we don't know what the input was.
Right, we can't just say, oh, my answer is yes. What was the input? I mean, there's infinite even or odd numbers.
So one more function, my favorite of all of these, is the number of legs function. So you plug in an octopus, 8.
Okay, there are only 4 legs on this emoji.
It's not an anatomically correct octopus.
So
but
you're just assuming that there's 4 more?
I think it's just the idea of an octopus. And the same way, the idea of a dolphin. This emoji is anatomically accurate. But in this way, number of legs, it's a one-way function. If you give me 8, although, you couldn't guess octopus just from the number of legs.
You could guess any spider, right?
Could be spider, yeah.
Arachnid or something.
Number of legs, dolphin, 0. That would be much harder one to guess. Could be
a snake.
A snake,
is it a dolphin?
A jellyfish.
Sure, jellyfish.
Does a jellyfish have legs?
No, absolutely not. You think those are legs?
Yes.
No.
So, yes.
So to summarize, jellyfish definitely do not have legs. But also,
Sort of.
one-way functions. What do you mean sort of? They don't. There is no chance that they have legs. They have tentacles. They don't even have like a digestive system. They don't have a real nervous system. They're sacks of water, and you think that they have legs?
There could be jellyfish watching this right now. Be sensitive.
Oh my gosh. Okay, I apologize. Anyway, back to one-way functions. All that we would like for you to take away from this is that there's an idea of a function, take an input, and you get some sort of output related to that input. A one-way function is a special case where you cannot work backwards. So if you only have the output, you can't figure out what the input was. And this is going to be a really important concept once we talk about cryptography and how it relates to one-way functions and how that relates to Bitcoin. I think will make more sense. But all that will say, Bitcoin makes use of some very special one-way functions.
Yeah, we'll see why that's valuable in some of the coming videos. Welcome back. So in this video, we're going to talk about a sort of intuitive application of one-way functions, and it's a function that you might be familiar with. It's called a thumbprint. So a thumbprint function takes as its input a human being, and as its output, it provides the thumbprint. Thumbprint function isn't a real thing, it's just a concept. It's a relation between an input and an output.
Okay.
So,
and for our purposes, are thumbprints all unique?
yeah, for the purposes of this video, let's just pretend that all thumbprints, each person has a unique thumbprint.
Okay.
I think it's 1 in 50,000, but in general, for the course of this video, let's consider them all unique.
Okay. So, for example, this green woman is the input, and this output over here, we have this, I used to know the name for these shapes. I took a forensics class. I think it's a whorl.
For the world.
Yeah. Anyway, there's whorls and arches and something else.
So this is a one-way function, though, because given just a fingerprint, you can't produce the actual human being that it came from. So we're going to begin with a little story.
Yeah, this is a harsh transition to a slide of a knife.
A knife. So there's been a crime, and we're at a wedding. Someone stabbed the wedding cake, and someone cut the cake too early.
Yeah, I was going to say, that's the point, right?
Yeah, no,
stabbing a cake is just serving it.
The bride or the groom did.
Okay.
But there's a clue, and you'll see on that knife there is a fingerprint.
Okay, a bright orange fingerprint.
A bright orange fingerprint, yeah, colored for visibility.
Oh, there we go. There's a zoom in on that.
So we look at the fingerprint, and we want to determine whose fingerprint it is. And if we determine whose fingerprint it is, then we can determine who stabbed the cake, who cut the cake too early.
Yeah, and for our purpose, how many guests are at our wedding?
There are 4 of them.
Including one massive baby.
Colorful.
Huge
one
baby.
person has a hammer and a hard hat and a large baby.
Yes.
And we want to determine which of these 4 people actually cut the cake. And we're going to use our one-way function to do that.
So wait, why is this a one-way function? How does that?
We have the output of a one-way function, and we can't work backwards from that fingerprint. We can't determine what the person actually looks like with just their thumbprint.
Right. You can't just stare at the thumbprint and say, "Oh, I know who this is."
Yeah, this person has blue eyes. This person has red hair.
Right.
So we're going to take this fingerprint, and the way we can actually use a one-way function to determine who cut the cake is by plugging everybody into the actual thumbprint function.
So that just means thumbprinting everybody.
We're going to fingerprint
right?
everyone.
We're going to go around and we're going to, check against these people's fingers. We're going to compare each thumbprint. I guess technically we don't know that it was only a thumb. It could have been any fingerprint, but let's just say
let's pretend we know it's
you
a
only
thumbprint.
have one finger.
And at this point, the wedding is ruined because we're thumbprinting everyone. And right now, the attention is on finding a criminal amongst us. So we've plugged our fingerprints. We plugged everybody into our fingerprint function, and we compare the output, and we see that there's a match. It's this person on top. And we've color-coded it, which makes it even easier to see. But the fingerprints match. And now we've determined, we haven't worked backwards from the fingerprint to create a person, but we've plugged all the guests into the thumbprint function and compared their outputs with the actual clue that we had.
Right. So that's what this slide shows.
Yeah.
We don't go from the fingerprint back to the person. We have to go from the person to the fingerprint.
Mm-hmm.
So it's a one-way function. So another maybe actually real-world example that makes a little more sense is a lot of modern phones have thumbprint or fingerprint scanners. So, you verify who you are, your identity, by scanning your fingerprint to unlock the phone. But that only works because when you set the phone up, you had to go through and scan your fingers and, do them one by one or set up individual prints. But you had to go through and basically show what your fingerprint looked like.
So the thinking here is that your phone, instead of scanning your whole body cell for cell, your phone just trusts that the fingerprint function on you will output something that's unique to you. And that way it can detect an imposter. It can detect that it's looking at the real you.
The reason we're doing any of this is that it actually does relate to Bitcoin, and fingerprinting in general is something that, so we've been talking about thumbprints in the real world, and I actually think it's kind of confusing because what we're now going to transition to is talking about something called fingerprint functions, which are real functions that your computer can run code that will basically take some sort of input and return some sort of unique output.
Yeah, so in the same way that you fingerprint a person, you can also fingerprint data on a computer. So pictured here is Ubuntu, the operating system, as a file. You can take the fingerprint of that file to detect that you're looking at the real file. We're going to explain that in greater detail in the next video.
And as a small teaser of how this relates to Bitcoin, fingerprint functions are used to secure the data in the blockchain to make sure that things haven't been changed or tweaked.
So on the blockchain, we should be able to detect imposter blocks or imposter edits to the blockchain.
Okay, we're getting ahead of ourselves. Next, fingerprint functions. Welcome back. So in the last video, we briefly touched at the very end on the idea of fingerprinting a file or a piece of data. This is something that's really commonly done. We're not talking about human fingerprints anymore. We're talking about files, images, pieces of data, parts of the blockchain, where anything on your computer, really, any piece of data you could take and run it through a fingerprint function and get some sort of unique output, something that corresponds to that one input. So first, we need to talk about a little bit of terminology. So there's two terms, hashes and fingerprints, or hashing functions.
There's actually a third term called message digest, and we're going to all use these interchangeably in this course. Technically, the output of a hash function is a fingerprint. So the way we would look at our thumbprint example from the previous chapter, our hash function would be the actual thumbprinting process. The fingerprint would be your fingerprint on the piece of paper.
Okay.
But so in this course, we're going to use them interchangeably. You can be comfortable doing that too. Unless you're talking to a mathematician, it's safe to use them interchangeably.
Okay, so returning to this slide, what we're showing now is that we have any file. We're using, if you're not familiar with Ubuntu, it's a very odd sounding term and it doesn't really matter. Just replace this with any file, a contract you've signed, a PDF, a Word document, a text file, it doesn't matter. So any file, you plug it in to one of these fingerprint functions, and we're going to show some specific examples on the next slide. And their only job is to return some sort of output, usually a really long string of numbers and letters, that corresponds to whatever you fed it, whatever the input was.
And although it's long, it's not going to be as long as the input.
Of course, yes.
In the same way that your thumbprint is not informationally as large as your whole body, this fingerprint right here is not informationally as dense or is not as large as the actual input file.
Well, if we were to look at this file itself, not what it looks like as an icon, not the text, not the title, but the actual data behind it would be, I don't know how many pages and pages of code of zeros and ones or of a long string of numbers. We're talking hundreds of thousands of characters or millions of characters. But if we take a fingerprint of that massive, massive piece of data, we can distill it down to basically 64 characters, depending on the fingerprint function we use. But we can slim it down to get this unique identifier that corresponds to that long string, but it's only a couple, 32, 64, roughly number of characters, much shorter. So there are a bunch of, you can probably imagine this is hard to do, to write the algorithm, the logic to do that, but there are three famous or commonly known examples of these fingerprint functions that we're going to discuss.
We're going to cover them really quickly. The first one is the MD5 function, and that was written in 1992. That's a fingerprint function that's very widely used. The problem with it is that in 2004, computer scientists discovered a way to cheat it. And that we'll describe what that actually means, how you would cheat a fingerprint function, but it makes it less valuable as a tool to determine whether or not something is unique or verify its authenticity. The second one is called SHA-2.
So in 2002, SHA-2 came along, so these are all created by, this isn't, as far as I know, these aren't individual people working away. This is organizations.
Yeah, they're groups.
So
very often governmental.
For SHA-2, the group that put this together was called the National Institute of Standards and Technology, NIST, apparently. And this fixed some of the problems that were present in MD5. A lot of the security issues were patched or changed in SHA-2. So in today's world, SHA-2 is really widely used, especially online for internet security. And an important note, I guess we didn't star this, but we should highlight this because SHA-2 is what Bitcoin actually uses, and we'll go into that and explain it. But out of these three, SHA-2 is the one that Bitcoin is built with.
And Bitcoin really relies on the security and the soundness of that algorithm. If it were to be broken in the same way that MD5 has been broken, it wouldn't just be Bitcoin that has problems, it would be virtually all of the internet application infrastructure.
Right.
You'll definitely hear about it in the news if that ever happens. But we also mention a third iteration called SHA-3, Ketchak.
Well, yeah, I don't actually know if it's pronounced. I mean, Kevin thinks it's Ketchak. It might be Ketchak.
Ketchup, right?
Kekak.
Kekak.
Anyways, it's this family of algorithms of hash functions.
So SHA-3 is another family of hash functions, and it was developed in 2009. It's faster than SHA-2, and it's more secure than SHA-2, and a lot of technologies are moving into SHA-3. That doesn't mean SHA-2 is obsolete, but if you're building a new application, very often people are going to err on the side of this newer version, SHA-3.
And along with that, newer cryptocurrencies that we haven't really talked about, but things that have popped up after Bitcoin, many of them rely on SHA-3.
So hint, Ethereum uses SHA-3 for its internal hashing mechanism.
Right. Okay, but we're going to talk about SHA-2 right now because that's what Bitcoin uses.
So SHA-2 is actually a family of hash functions. You can actually, there are some parameters when you plug it in. And pictured here are SHA-256, SHA-384, and SHA-512. These specify the size of the output in bits.
Right.
So very often you're going to encounter SHA-256, but there is a more complex version that outputs twice as much information, twice as much entropy. In the case of Bitcoin, we're going to be using the 256-bit. That means every time you use SHA-256, the output is 256 zeros and ones.
So, remind us a bit. You just said what I was going to ask you.
It's
a bit is a 0 or a 1. And so imagine we have 1,000 characters, a piece of data that is 1,000 bits. We run it through SHA-256. It's going to slim it down to 256 ones and zeros. If we ran it through SHA-512, it slims it down to 512 ones and zeros. So we plug in something and we get an output. And what Bitcoin does is it uses SHA-256. So the output is going to be 256 bits. But that's ones and zeros. And we'll see that actually we can display that in a slightly better format where we use characters, base 10 or base 56.
Things that are easier to read.
All right, welcome back. So in the last video, we introduced the idea of a fingerprint or a hash function, which basically is a function, some very fancy code, a long algorithm that takes some input file or some input string of data or even just a character of text. It really doesn't matter, but some input on your computer, and it spits out something that looks like this potentially. So this is SHA-256, one of the algorithms we talked about. Remember, there was also MD5 and SHA-3, Ketchak, whatever we want to call it. So we pass in some piece of data. This is imagine it's the equivalent of a human. We take a human and we take their fingerprint, a thumbprint. So regardless of the size of the input, whether we're talking about hello, which is just a couple characters, or it's an entire operating system file, it's the entire Bitcoin, blockchain, whatever it is, the input doesn't really matter as far as the size of the output. It doesn't change it. The size of the output of SHA-256 is always 256 bits. So this isn't 256 ones and zeros. What we're looking at here is hexadecimal, which is base 16 instead of base 2, which is binary. It's it's a tangent, but all you should know if you are unfamiliar with either of those terms, this is a more condensed format for displaying it. But this converts into 256 ones and zeros. So whether we take hello or goodbye or some of the other things we'll show, we'll do it with an image, we'll do it with an actual file on my computer, you'll see we always get 256 bits at the end.
Let's first talk about a few properties of hash functions before we show you a demo. The first property is determinism. So that means given the same input conditions, you'll always get the same output. So regardless of where you run your SHA-256, if you plug hello in, you're going to get the same output.
Okay. So on this slide, we actually have 3 examples, 3 different hash functions in their output. So we have MD5, we have SHA-2, and then SHA-3. The outputs are all very different based off of the same input. But every time, let's say we're working with MD5, if I run hello through MD5 on my computer or on Kevin's machine or on somebody's computer on the other side of the globe, we'll always get this output.
Yeah, regardless of when and where you run it.
Unless something was changed with the input. But assuming the input is always the same, we reliably get the same output. So we're talking about SHA-256, so our output looks something like this. We would always get this whenever we run hello as the input.
So per our analogy, your thumbprint tends not to change throughout the course of your life. If you actually hold a knife and cut a cake, you leave a thumbprint. And then when you're fingerprinted, when you are thumbprinted later on, you're going to have the same fingerprint. That is the determinism in our analogy.
So the next property is that whatever the output is, it should be quick to compute. So these functions are used all the time. Like we talked about how they're used in internet communications. You don't want to have to wait 10 minutes for something to run in between you viewing a web page, for example.
And in the same way, you can thumbprint someone very quickly. You just put their finger in ink and then on a piece of paper.
Right. Unless they're being unruly. Then you tranquilize them and you fingerprint them while they're passed out. Anyway.
Okay, property 3. They should be infeasible to reverse. So this is going back to it being a one-way function.
Right. So these are supposed to be one-way functions, which means we know what the input is and we can figure out what the output will be, but we shouldn't be able to take the output only and figure out the input. And obviously, us as humans looking at this, if I covered the left side of the screen, there's no way any of us could guess what generated this result. But even computers shouldn't be able to sit and crunch this for decades and decades and figure it out. They shouldn't be able to go from this and reverse it. Now, I mean, what you could do, if you could run SHA-256 on every word in the English language and then compare the result, but you couldn't work backwards. You would have to do this crazy brute force approach.
Yeah, so this is like finding the culprit at the wedding.
Yeah. Well, we only had 4 people there.
Yeah, in this case, you would have to hash every single possible string that you could provide to SHA-256.
Yes, and we're talking about
feasible.
We're talking about tiny words here, but when we talk about actual, like how it relates to Bitcoin, we're going to work with much larger pieces of data where it's impossible.
Big data.
Next, a hash function needs to be infeasible to collide. So what does that mean?
So this is going to prove very important in actual Bitcoin mining explanation. For hash functions, it should be very difficult to find 2 inputs that give you the same output. So if you're looking at all these numbers here, you'll see how wildly different hello and goodbye are. It should be the important property is that it's extremely difficult to find. For example, if we look at the right side of hello, it'd be very difficult to find another word or another piece of data that gave us exactly that.
Yeah, it's just infeasible is, I guess we should mention it's different rather than impossible.
Yeah,
it is possible that you could have a collision, but it's supposed to be the way these algorithms are written. And again, the actual code behind them is crazy, the logic that it goes into it.
Yeah.
But it should be very, very, very unlikely for you to have one file and another file, no matter what's in the files. And if you hash them with SHA-256, for example, they should be nothing alike.
So if, back to our thumbprint example, if you have somebody with a thumbprint, which many of us do, it should be, and it is very difficult to find somebody else with an identical thumbprint. It's possible.
Yeah, that kind of falls short,
there.
though, because that's like 1 in 50,000 or so.
Yeah.
When we're talking about collisions here, we're talking about 1 in like trillions and trillions.
Bajillion.
Yeah, sure. I'm going to need to see a source for that, Kevin, on the bajillion. So finally, with the hash function, a small change in the input should lead to a big change in the output. For example, if you take a look at the bottom half here, if we have goodbye, we've highlighted the end, the last, 6 characters. Just focus on those. And I'm going to just make a slight change to goodbye. I'm just going to add an extra E. And look at that massive difference. Everything changed in there. And one more E, another very strong difference, large difference. However, when we're talking about changing a single character out of the word goodbye, that's actually kind of a big change because goodbye is only, 7 characters?
7.
Yeah, so changing 1 out of 7, that's a pretty big change. So let's do something that's a much smaller change. Here we're taking an image. So remember that behind every image is a bunch of numbers, 1s and 0s. So imagine we change 1 pixel on this image. So this is the first input. This is what we get. Again, we've highlighted it here. But we change...
Yeah, just look at the bottom right.
Yeah, it's just too much to try and analyze this whole thing. So we change 1 tiny pixel right there, and our output is completely different. It's not like there's been a slight change. It's completely radically different. They're not at all related. And that's important. That's how it's supposed to work, that a small change in the input leads to a large change in the output.
Yeah, if you were to do, here they are side by side, if you were to take all of Moby Dick and take the fingerprint of it, and then you were to take all of Moby Dick and remove 1 period or add 1 stray apostrophe, the fingerprint would be entirely different.
We should do that as an example.
Okay, let's do that.
Okay, we're going to do that next. Real quick, before we wrap up, this is another thing that we didn't, it's not enough to make a whole video on, but it's important to cover. So we talked about how the output, like if we take a look at one of these outputs, it is a mix of letters and numbers, But actually what it is, it's a very large number, but we're not displaying it in base 10. We're not using the normal number system we're used to as humans to count, at least in the Western world. Some other places use other bases to count, but in the Western world, we use base 10. What we have are also the letters A through F, which are actually numbers. So when we talk about hexadecimal, it's base 16. So the numbers no longer go from 0 up to 9 that you could have. If we're talking about a single digit, the largest single digit number we can have in base 10 is 9. When we talk about base 16, you actually go past 9, but we don't have a number to show that in our counting system, so we use A to mean 10, B is 11, all the way up to F, which means 15. So every single digit in this number ranges from 0 up until 15. So for example, this is a 14, this is a 15, right? Then this is a 8 and a 4. So these are large numbers that are just displayed in a shorter, more compact format so they could fit on this slide easier, basically.
So the last thing we're going to do is we're going to add a layer of convenience for our slides. It's very difficult to look at hash outputs. Whenever we're referring to hashes, or not always, but sometimes when we need to compare the difference, a lot of the time, Colt and I are just going to compress it into an emoji.
Yeah.
So instead of showing you a long string of hexadecimal digits, we're going to actually just do an emoji. So on the top, SHA-256 is actually SHA emoji. Take the rainbow picture, out comes the unicorn. Although those are somewhat related, disregard the connection there. And if we were to change one pixel, we would get flan. I think that's flan, right?
Yeah, it's flan. Or some sort of custardy thing, whatever that is. Actually, I think in Europe it's called a creme caramel.
Creme caramel.
Anyways, so whatever it is, we get two radically different outputs, and we're using emoji rather than this and trying to, show that this is different, because this is much harder to talk about compared to nice little emoji. Okay, so that's a rough intro to hash functions. Okay, welcome back. We're now going to do an actual demo of SHA-256. So this is not something, we want to be really clear about this, not something you need to do. You can absolutely follow along if you want to, but this is not important to actually, being able to work with Bitcoin. It's just a matter of understanding hash functions and how SHA-256 works. We're going to see some cool results that we get. So we actually went and downloaded Moby Dick as a text file, mobydick.txt. You can find it online. It's really long. It's like 15,000 or so lines. Yes, 15,604 lines of text. So we're going to hash this file, but we're going to actually start with something even simpler. I'm just going to hash like my name or a piece of text. So the command that we're going to do, and this is not the only way of doing it, and I don't want anyone to get hung up on the syntax, but I'm going to do this right here. I'm going to put a string that we're going to hash, so hello. And then here's the actual part where I'm going to tell it to use SHA-256. So again, not what the course is about. This command, I'm in the command line, the terminal. If you're not familiar with that, it's okay. We're not worrying about that. So I'm going to hit enter now. And you can see I get an output. Just let's look at the beginning, 2CF, and then it ends with 824. Okay, so let's do the same thing, but change this slightly. Let's capitalize the H. Now I get something completely different. So every time I run this with that capital H, I'm always going to get that same output. All these times, I should get the exact same thing, whether my computer restarts, whether I'm doing it on someone else's computer.
And that's the deterministic output.
Right. And we're talking about every time I do SHA-256. Now, if I'm doing some other, like MD5, for example, or something in the SHA-3 family, I would get a different output, but should be the same output every time I run that particular algorithm. So now let's talk about Moby Dick. So over here, I have a file. It's called mobydick.txt. So I'm on my desktop here where that file is. If I were to look at that Moby Dick file, I just printed it out in my terminal. So here it is. It's called mobydick.txt. Now I'm going to run that exact same command. Now the syntax to use SHA-256 with a file is slightly different, but I'm just going to write it out. Again, we're not really, this isn't the point to explain all of this, but SHA-256 and then the file name, which is mobydick.txt.
And this will run quickly.
Yeah, so you could see that was a long file, although it's only text, which is pretty easy. If we're talking about, a video file or something, that's a really big file. That
takes
gigs.
longer, yeah.
But it goes relatively quick. Okay, so here's the output here, D688. Every time I run it on that file, I get the same thing. Now what I'm going to do is go change let's do a single period right here. Sure.
Let's just capitalize a letter.
Okay, how about...
Capitalize the L in lungs.
There we go, and I'm going to save it. Command S on my Mac. So it's now saved. And I'm going to go back and rerun the same command. And there we go. Look at that. Not even close. I mean, we have 900B44, completely different. This is pretty cool stuff, in my opinion. I mean, just imagine trying to make this work yourself. If somebody was just like, okay, you need to take any string of data and you need to turn it into a unique or relatively unique tiny string of data of ones and zeros or of base 16 hexadecimal. How would you do that? It's pretty crazy. And that tiny change, just changing that case of that L, actually, let's just show that it's reversible too. If I go back, I've saved it, and then run it again, we get what we got before. Pretty cool stuff. So that's a really quick intro to SHA-256. That's all we want to demonstrate is that it works in the properties that we described are real. Every time you run the same hash with the same input, you get the same output. You change something small, it leads to a large change. In the output, it should be quick to compute and so on. Don't worry about the syntax, but try it out if you'd like. If you don't know how to use a command line and any of that, I wouldn't try and go learn it just to do this, because we've got a lot of stuff to talk about after this. So next, we're going to learn how Bitcoin actually incorporates SHA-256 and what it has to do with Bitcoin. All right, welcome back. So for some reason, this is called hash functions in U. What should it actually be called, Kevin?
It probably should be called hash functions and safely downloading a file, but that's not as catchy and it wouldn't really fit with our typeface.
So what we're going to do is show that you can run SHA-256 on a file, much in the way that you could do it on an image here. And remember, one tiny pixel of difference leads to a very serious difference in output.
Flan.
I mean, yes, they're actually hashes, they're numbers like this, but our emojis are radically different. We're going to see the same thing with files. So what we're going to do is download a file, and this is going to be an operating system. It's called Ubuntu. I never know how it's actually supposed to be pronounced.
I think Ubuntu.
And the reason we're using this as an example is that it's an operating system, a low-level operating system, which in some ways makes it much worse if it were to be compromised in any way.
Yeah, as opposed to just an application, which might steal, I don't know, a password or two. If you were to download a compromised operating system, it could, for example, turn your camera on without your permission. It could
or
steal
just like log
everything
every
you type.
stroke you ever type.
Yeah, it could turn the microphone on without your permission. If you were an evildoer, this is how you would want to take over someone's computer.
Sounds like a great time. If you're a hacker and you have access to that, you could do so much fun stuff.
Yeah.
Anyway, so it's something you definitely want to trust that you're getting the right copy of. You're not getting an intercepted version or an altered version. So what we do is when we actually go to the website for Ubuntu and we click on the download link, we select a version, there's a little note that I'll show you in just a second that says compare to our SHA-256 file.
Yeah, so when you download the file, it says, hey, take a fingerprint of this file and you should see exactly this output. Right. And the thinking is if somebody were to have taken over the website or taken over the download, then they wouldn't be able to produce a file with the same fingerprint. They would have modified the file and the output fingerprint would be totally different. Just like this. Now imagine instead of an image, it's a full operating system. Even one character of bad code or of some sort of bug or hack in there, that's a way oversimplification, but even one character could lead to two radically different fingerprints. So I'm on ubuntu.com and I'm going to go over to downloads. And then you could do this for any of them. We're going to do Ubuntu Core. It actually doesn't really matter at this point. I'm pretty sure all of them offer it, right? Yeah, all of them will have fingerprints. And we're going to do Raspberry Pi. Again, what we're actually downloading doesn't matter. All that matters is that it's something you absolutely want to trust. You don't want to get a bad copy of. So if you look at the installation instructions, first we're going to do, what did we decide? Raspberry Pi 3? Yeah, Raspberry Pi 3 for Raspberry Pi 3 Here, let me make this a bit bigger. Yeah, Ubuntu Core 16 image. Okay, so this is what we're going to download. Now, notice down here, you can verify the integrity of the files using the SHA-256 sum. So I'm going to open that, and I'm also going to start this download. And we'll see you in a second once that finishes. So now I'm looking at the SHA-256 sum file that they linked, that they said verify the integrity of your files against this. So we have, it's a really simple file. There's 6 different versions and 6 different checksums. And 6 different results. Yeah. Oh, checksum is also another term. So you can use these all interchangeably in this case. Checksum, message digest, hash, and fingerprint. They all mean the same thing in this context.
Yeah, it's just the output of SHA-256 on these files. So if what we downloaded, as you can see, it's still going, is the Raspberry Ubuntu Core 16 Pi 3, right? So that's right here. So we're going to look to make sure when we fingerprint that file, the download that we just finished, that we get this result. So let's just remember this for now, 3072. Just focus on that, 3072. Okay, so I'm going to use my terminal here to actually do this. If you're not familiar with navigating in the command line, we're not going to teach it right now, but here's the file itself. So this is the download Ubuntu Core 16 Pi 3.img.xz. So we're going to, before we open this up and install it and basically, unleash whatever is in there, good or bad, we're going to double check that it is what it's supposed to be, that nobody intercepted it along the way or added some bad code into it, because that would radically alter the fingerprint. Okay, so one way of doing this, there are many different ways of actually running SHA-256, but we're going to do what we did earlier. So OpenSSL DGST SHA-256, and then the name of the file. There we go. I just did tab to autocomplete.
And this will happen pretty quickly.
Yep. So you're going to hit enter, and
This is a pretty big file. I think it's, 200 megabytes?
Okay, here we go. All right, we can tell already it's right, 3072. But if we wanted to just double check, I'm going to copy this. So here's what we got as a result, and this is what we were looking for. So we compare them side by side, perfect match. So that tells us that no changes were made to the file. Now, it's possible that somebody did intercept it along the way, but they didn't do anything to it, because we would get a very different output if there was even a single space. Remember what happened with Moby Dick? A single, what did we delete?
Apostrophe?
No, we capitalized the letter.
We capitalized the letter.
And that changed the entire hash, the entire output. So if anything happened, we would see a massive difference. Not to mention the fact that really any malicious code is going to be more than a single character. That it takes more work to really do anything damaging. So we'd see a radically different output. And we don't. So we can trust this now and go ahead and install it. Except I have no use for Ubuntu and I don't have a Raspberry Pi, so I'm not going to.
And a side note, for those of you who have also noticed that there's a possibility that someone could have intercepted the actual fingerprint on the website. So somebody could have taken over the website and changed both the file and the fingerprint. There is a way, using concepts that we'll describe in this course, to prove or to indicate that the actual fingerprint was created by the real Ubuntu developers using something called a digital signature.
Okay, you're scaring everyone, Kevin. So what Kevin's alluding to, yes, somebody could actually intercept the Ubuntu website or fake the Ubuntu website and put their own fingerprint up there and say, oh, this is what you're supposed to get when you download the file. But somebody could actually be, have hacked the original download, changed it, put malicious code in there, and then also taken the fingerprint of that, then put that on their fake website, and then confuse you, and we're now being completely hoodwinked into thinking that everything's good.
Down the rabbit hole.
Yes. So we're going to see how to actually verify that it was Ubuntu who posted that in the first place later on. All right, welcome back. What are we talking about, Kevin?
This one is called hash functions and passwords.
Yeah, we can read. What are we actually talking about?
We're going to talk about hash functions and passwords. We're going to talk about how you can use fingerprints, hash functions, to secure passwords when you store them in a database.
Okay, and when you say when you store them, we also are talking about when you sign up for a website, any website that takes security at all, I mean, not even seriously, that just even acknowledges the existence. The bare minimum that any website needs to do is not store your password as plain text.
Mm-hmm.
But that's still, it comes up every so often. You hear about certain websites that do it. I think nowadays it's so shameful that you don't hear about it. So let's talk about why that would be a problem first.
Well, if a website did store your password as just plain text, then the developers at the website and somebody who hypothetically broke into a website would be able to just look at the database and see your email address, which would be your username, and then see that your password was ABC123.
Right.
And that'd be sort of useful to a hacker or an evildoer, because they could just go to another website and try your email and password combination. Most of the time it wouldn't work, assuming you have a different password at each website, but many people don't.
Right. Yeah, it's just, that would be terrible. So rather than storing your password as text, most developers with a brain are going to hash your password, most likely with some variant of SHA-2 or SHA-3, take the result, like we have over here, and store that in the database. So we might have something like this in our database. If somebody, well, first we have a user or a username or an email or some unique identifier on the left, and then on the right, we have the result of hashing their password. And once again, we just highlighted the last couple digits to make it clearer, but these are all unique. So first of all, this is an improvement already, because if someone gets access, they hack the database, it's compromised, they get every single row in there, all that they see are the results of hashing the password. They don't actually know the password. And remember, it's a one-way function. That's like the whole point of it. So you can't work backwards from this.
And you can't go to Facebook and type in Montana and the hash of a password, because Facebook is going to in turn hash what you provide. It'll become the hash of a hash.
Right. So let's go through that process. But rather than saying that we have some malicious actor, let's say that Montana is trying to log in, and Montana just can't remember her password.
She forgot her password.
And she uses like 3 or 4 different ones. She's just going to guess them. So the first thing she does is type her password ABC. Now, there's no password length limit on our website, or minimum password length. So that's actually not a good idea, because it does make it easier to guess, and we'll talk about why. But let's just say that she can have a 3-digit password. So she guesses ABC. That's one of her favorite passwords. Well, what we do is we hash it. We use the same SHA-256. We get the results, and we're going to compare that to what we have stored in the database for her password. So we're basically hashing both and then comparing. And this is not a match, is it?
Nope.
Okay, so what's she do next?
She types in her next password. Her next favorite is DEF.
Very creative.
So this one outputs C2717B.
At the end, at least.
So the fingerprint there does not match the fingerprint in the database. So we know
can't log in.
We know the input doesn't match. We reject her password. Next one, HIG, her third favorite password, 10A1BO. That's a negative, doesn't match.
Okay, she's getting, let's say there's only 4 attempts on our website. She's going to lock her out.
She's getting frustrated, and her last guess, KLM, 4D2 3C4. And what does that say to us? It's a match. What that shows us is that when she signed up and we fingerprinted her first password, her original password, we saved 4D2 3C4. When she tried to log in just now and we fingerprinted her attempt, we get 42 3C4 also,
right?
Which indicates the same input, independent of really any meaning of the output.
Right. Oh, Kevin, we forgot. We have a little...
Oh, isn't that nice?
We have a highlight there. So one thing that we haven't discussed is that just storing a hash password on its own is not enough to prevent someone from ever getting in, because especially if we're talking about super short passwords, like let's say a website allows you to have a 3-digit password, all that a hacker has to do is figure out what hashing algorithm you're using, and most of the time it's going to be SHA-2 or SHA-3, some variant of that, and basically write code. I mean, there's some more sophisticated ways of doing this, but the dumbest way would be to just write code that takes every combination of 3 letters to start, if that's the minimum. And it just runs that through SHA-256 and compares it to what it got in the database.
AAB, AAC, all the way up to ZZZ.
And it keeps going. So this only works if the hacker has the password hash. But if they know what they're aiming for, they could just have a computer going for days on end, potentially, trying to guess it. But then there's optimizations that can be made, because there are, more common passwords. There are patterns people like to type, certain numbers people use, things that, there's just words, for example, that are used rather than random letters. So this is why it's always better to have a longer password, why sites force you to use numbers and special characters and things that are harder to guess. You couldn't just hook up a simple, password guesser. There's some really, if you go on GitHub, you can find some simple examples. But anyway, the point is, storing a password hash is much, much, much better than just storing plain text, but it doesn't necessarily guarantee that nobody could ever guess the password. It just makes it a lot harder.
Yeah, and if you are using this information towards building your own website, there's also some other sort of safety mitigations on top of using hash. There's something called assault, and that's not in the scope of this course, but it's important to include that because it is possible to work backwards if you allow, for example, 3-character passwords.
Right.
Or if you permit people to choose their password as some simple single word, all lowercase.
Or a really common thing is to not allow people to use any part of their username inside of the password, because then that's going to be most hackers' first guess. If you allow that, they have the username, let's just try a variant of that. Anyway, we are not security consultants, so this is purely educational. Don't sue us if you get hacked, please. Alrighty, welcome back. So we've spent a good amount of time talking about hashing functions, SHA-256. Basically, outside the context of Bitcoin, we learned about SHA-256 on its own. We did some demos. We saw how to use it to store passwords safe-ish. And we also talked about using SHA-256 to verify the integrity of downloaded files and all sorts of things. We did all of that for a reason, because SHA-256 plays a super, super important role in Bitcoin. In particular, when we talk about blocks and the blockchain, which is what we're going to do now. So the next couple of videos are all focused on those two things, blocks and the blockchain. But first,
let's talk about databases.
Database.
So this is a database, and you might have encountered one of these before if you've ever used Microsoft Excel, or you've used Google Sheets,
or like a real database
like MySQL.
It's MySQL.
Yeah,
you can trust me. I'm not allowed to mention I have courses on things. I do not have a course on MySQL, and you should not look at it.
No, and if he did, it would have terrible ratings.
Okay, anyway, whatever database if you've ever worked with one, this is a silly example. It's trivial, but we're storing things in different columns. We have a date added, a name, and a favorite color. Some good colors. Yeah, turquoise. That's a great color too. No purple though. Very suspicious. Purple should be on here.
Yeah.
Anyway, Bitcoin has a very important database called the ledger.
It's distributed ledger, and this is a simple ledger here. This extends our rainbow coin example, where we have Felix and Kilgore and Billy in Montana, and they are exchanging something. Let's pretend this is just rainbow coin. Now, Bitcoin's looks quite similar. However, the actual contents of the from in the two fields aren't names. They are addresses. Addresses?
Anyway, it looks like this. Instead of a person's name, to and from, and a quantity, we still have a quantity, but we have one address on the from and another address on the to. And you actually saw this when Kevin sent me 0.00 whatever Bitcoin that he sent. We showed the addresses, and we actually showed what it looked like in the block itself at the end of the day. So this is what's stored. It never says Kevin sent Colt. It says 1NSZ sent 1ZQN 0.5 Bitcoin.
Now, back to sort of our pictorial analogy, we use these envelope icons. Each one is a transaction.
Right. So each envelope is a from, a to, address, and a quantity.
Yeah.
And we're just simplifying it because our next slide shows that there's a ton of transactions together to make up the ledger.
Isn't it colorful?
Yeah. Yeah. All these colors just go great together, Kevin.
Now,
you really coordinated them.
So this is a tiny window on the sides of the ledger. The actual Bitcoin ledger is 300 million little envelopes. We couldn't fit that onto one slide.
So we put a ... there.
It's
the same thing. So this thing goes on really, really further than we could ever show on the screen. It would take hours to scroll through.
And all the way back to 2009. And this goes, if you remember our discussion of how do you keep an Excel spreadsheet secure, it's quite difficult. How do you prevent somebody from going in and changing one of those values? What would that look like here? Somebody could swap out this pink one for a teal one. Teal?
There we go. Yeah, so what that would actually mean, let's say that they're changing the quantity that was sent. Instead of 2 Bitcoin, it was 20 Bitcoin now that's being sent from one person to another. And remember, in Bitcoin, there is no physical object. All that matters is what the ledger says. And if the ledger says X person from X address to X address sent 20 Bitcoin, if everyone agrees on that, of course, then that's true. You have 20 Bitcoin in that address. So it's important to prevent people from changing things on the ledger, whether it's 10 years, well, not quite, actually, I guess almost 10 years ago, whether it was 8 years ago when the first transactions or yesterday. It doesn't matter, but you shouldn't allow anybody to change it. So I have an idea, Kevin, on how we can fix this whole thing.
To prevent someone from tampering with it?
Yes, we talked about fingerprinting. You could have a file like we did with our Ubuntu download. If anyone changed a single character, I fingerprint it and I can tell immediately. So we just spent a lot of time talking about fingerprinting. Why don't we fingerprint the ledger?
So if you remember how long it took to fingerprint our 200 megabyte operating system, Ubuntu, imagine needing to SHA-256 fingerprint something that is about 200 gigabytes, so something 1,000 times larger than that.
Right. And not only, we wouldn't just do it once, we would do it anytime transactions were added, right?
Yeah,
we need to keep doing it to make sure over time nothing was changed.
Yeah, keep it up to date. So what does the Bitcoin network do? They break it into blocks, hence the blockchain.
Okay. Instead of trying to fingerprint all of those transactions all at once, 300 million plus, instead, we break them into chunks, and this is not an actual representation of the number of transactions in a block. We'll talk about how that's determined, but it is not, 15? It's not 15.
Yeah, it's in general up to 2,400 per block. It's about 1 megabyte per block.
Right. But remember, a transaction is just a couple pieces of information, so it's really easy to fingerprint a block. There isn't much space. It's just a couple. It's an address, another address, and a number, a quantity. So that's what we do. We take individual fingerprints of the blocks, and we have a painstaking animation.
This is good.
So transactions come in.
Accumulate, more and more and more. And then when we fill a block, we save a fingerprint.
Right.
Then more transactions come in.
Oh, there we go.
And then when we fill a block, actually every about 10 minutes, new fingerprint. We save a checkpoint. And we keep going. More transactions. And then we get a full block, or we reach 10 minutes, and voila, another fingerprint. And this is what, we have a history of these fingerprints. And if somebody wants to go back and modify an old block, then they would have to fix one of these fingerprints. We're going to talk about the process in which these fingerprints sort of accumulate on top of one another.
Right. So we're really just focusing on the concept of individual blocks right now. There's also the blockchain, which we're kind of showing you here by chaining multiple blocks together, but we have a whole other video on that. So for now, the key concept is instead of one massive ledger, we break up the ledger into chunks roughly every 10 minutes of transactions, 2,400 transactions roughly, into a block. And then we fingerprint those individually rather than trying to fingerprint 300 million transactions together. I don't know why I have this analogy in my head. Like at a sausage factory, you have this long pipe, this super long tube.
That's a good analogy.
Like I guess intestines is what it used to be. Now I think it's often cellulose.
Just plastic.
And you're filling it with meat. Those are the transactions. But you don't just make one massive sausage. You twist it off into smaller sausages.
That's a fantastic analogy.
Every X number of or I don't know how many inches or whatever it is. There's some metric that makes it divided into a chain of sausage links.
So every 10 minutes, the miners tie off a sausage.
Yeah.
That's great.
So imagine that we have these two blocks, or one block, and the original, what it's supposed to be, is on the left, but some bad actor changes one of the transactions.
Bad guy, Hans Gruber.
Yeah. So there's something bad. I don't know. Deleted a transaction or falsified information, changed the character, whatever it is. Well, we wouldn't spot that probably as humans, looking at the numbers. Like we're not going to go through and compare line by line each transaction. But when we fingerprint those blocks, suddenly we can see the discrepancy, because remember that one of the key things of these hashing functions, a small change in the input has a large effect on the output. You change one number, you add a zero, instead of 10 Bitcoin, it's 100 Bitcoin in that transaction. That's going to radically alter the output of SHA-256. So when you fingerprint this block, even though it's only one tiny transaction out of 2,400 or so, and it's only a single zero that's changed, it still has a huge
completely
change.
Different. Yeah. And it is miners' responsibility to make sure that these fingerprints are correct. And instead of actual fingerprints, it is these guys, SHA-256 hashes.
Right. So SHA-256 already, there's actually more we haven't talked about when we talk about the blockchain. We'll get there. But you can see that SHA-256 plays a really big role in keeping Bitcoin secure. All right, we finally made it to one of the buzzwords, the trendiest keywords of the year.
It's hip,
the blockchain. So we've been building up to this for a little bit. We basically had to start by covering the basics of a currency, talk about the existence of a ledger, talk about addresses. Then we had to talk about fingerprinting, individual pieces of the ledger, which are blocks. Now we take it one step further. We talk about the blockchain. So where should we start, Kevin?
What is a blockchain?
So blockchain, according to whatever definition we sourced here, a community-maintained database of transactions which grows but cannot be modified. So the keywords here are community-maintained, meaning that it's distributed, many copies of it, and then also it cannot be modified. So let's compare that to a traditional database, which is, you could have a database of transactions which grows. That's not unique. What makes something a blockchain?
So on the left, we have database. So this would be the traditional way of organizing, say, Rainbow Coin. And then on the right, we have blockchain. So a database is modifiable. You can change whatever you want in it, and there's no indication that something has changed.
I think of just a spreadsheet when we say database, or Kevin says database.
A database.
Anyways, whatever we call it, think of on the left a spreadsheet, Google, Excel or Google Doc, and on the right, blockchain, which is, we're going to get into some diagrams of that in just a moment.
Now, the database on the left is also typically centrally maintained, so it's maintained on one computer. Maybe there's a couple of backups, but the blockchain, the innovation there is that it's maintained on many computers. There are tens of thousands of copies of it, as opposed to the database where it's really up to the database maintainer to keep a couple of copies, and there's no enforced comparison between those copies and the master copy.
Right. Okay. So other than that, though, I mean, a blockchain is basically just a growing list of transactions. You could do that in a spreadsheet. The two things that we already mentioned, that it's not modifiable in the past, at least. We're constantly adding to it, so it is being modified in that way, but you can't update or delete previous values or change things that have already been cemented in the past.
So you're going to see this slide a few more times in this course, but we show this to divide the two uses of cryptography in Bitcoin. So what we've been focusing on, fingerprints, hash functions, is really the first half of Bitcoin's use of cryptography, proving the integrity of its ledger, making sure that nobody tampers with it. And that involves fingerprinting it over time, and that's what's called the blockchain. This is just one-way hash functions.
So in the last video, we talked about how Bitcoin takes advantage of SHA-256. It splits up the massive ledger into smaller sub-pieces called blocks, and it fingerprints each individual block. And that's great. That adds some security, and it's also easier to fingerprint individual blocks rather than the entire ledger. But it's important to note that it's not continuously rehashing every single block in history, right? So something's hashed 5 years ago, let's say, and the block is done. Somebody between then and now could go back and change it. And if Bitcoin worked the way that we've described it to you so far, we would have to continuously rehash that block from 5 years ago and just check. Is it the same? Is it the same?
Is it the same? Yeah.
And that's difficult and time intensive and computer intensive.
So instead, one of the huge innovations in Bitcoin is the notion of chaining the blocks into one another. So right here in our diagram, we've replaced the top left transaction with, instead of a transaction, which is just a little piece of data, with the fingerprint of the previous block. And we're going to spend the next several videos talking about why this is so useful, why this reinforces the security of the blockchain so much.
Yeah. So we've kind of been, I won't say lying, but we've been omitting the fact.
We've
just been saying that a block is a bunch of transactions. And we're not showing the full picture to you yet.
But we'll get there.
One really important piece is that it contains a hash, a fingerprint of the previous block. So rather than the actual fingerprint, it looks something like this. So we have all the transactions plus the hash of the previous block. And then we would hash this block when it's done, which includes the hash of the previous block. So then the next block has a reference to this block, and it keeps going on and on and on.
So as we fingerprint each block, we're including in the data that we're fingerprinting the actual fingerprint of the previous block. And this is going to be hard to digest right here. It'll be easier once you see in examples when we show the full diagram. But really, what we're trying to drive here is that in each block, you can include information about the previous block. And that's going to really reinforce the history, the historic security of the blockchain.
Yeah, because if every single fingerprint you take of a block is based off of every block that came before it, if somebody changed something 5 years ago, then all that difference is that change is going to cascade all the way down to modern day to today,
to now. And get these hashes off the screen.
Okay.
We need emoji.
So here's a couple of
much
examples.
better.
What we're going to show is that if you just, what we've been doing before, we're replacing the actual hash, the results of SHA-256 with emoji just to show and visualize. If we have the exact same transaction, so the envelopes stay the same color, but the previous block, the emoji representation of it changes, it leads to a very different fingerprint of this entire block when we include this piece in there. So then let's say somebody alters something in the past, and just the last block. Well, now the hash of that last block is different. It's now a purple umbrella, which I wish I had a purple umbrella. And then we take the fingerprint of this entire block. The transactions are the same. No colors have changed, just the previous block's hash changed. So now the fingerprint is totally different. Just like changing adding a period to the entire text of Moby Dick, massive difference. In this case, going from a peach to an ice skate. Wait, we have a couple more. All right, I'll fast forward through these. But anyway, you can see, you change the emoji, you change the fingerprint, you change the entire block's fingerprint.
So what's it look like when we chain them together? we actually have a reference to the previous block in every single block. So that means if somebody wants to go in and tamper with maybe even just the last block, that's going to change the fingerprint of the current block. So here's the emoji version.
There we
Much
go.
better.
Okay, so you can see that this first one has a rainbow emoji as the previous block. So we hash that with its transactions and we get the peach emoji. So then we take the peach emoji.
Looks like a butt.
Yeah, Kevin, this is a PG rated course.
The butt.
I'm offended. I am really offended. Okay, so we have a peach. We put that in the next block as a reference, and we say, okay, if everything goes to plan, nothing has been changed, the previous block's hash is a peach. Then we hash that with the next block, and we get a purple umbrella, and then we would put that into the next block in the future and say, hey, the last thing was a purple umbrella.
So zooming out, pretend that we have 3 blocks in all of our history. We've crunched it down. We just have a little tiny network, but we want to make sure that nobody can tamper with any of the old transactions. Mm-hmm. The first hash was a rainbow, and you'll see in the top right of that block was what color was that?
That's blue.
That's a different color than blue. It's like a cobalt.
Okay, that's blue. In general, it's a blue.
I think it's a warm cobalt.
It's a blue envelope, and somebody tampers with it, and they change some value in there. They delete a transaction.
They change it to an orange.
There we go.
Now, the fingerprint of that entire block becomes a taco.
Yep.
Which is just, remember, these are just representations of the underlying SHA-256.
Yeah, now it's 37077 instead of 2BA7.
1.
Yeah. Anyway, so we're using emoji.
Yeah, so what happens to the next block? If you want to have a valid blockchain, you need the previous block, this little rainbow in the top left of the middle one, to reference the first one. So you would update that guy. But then when you update that guy, the butt emoji would become a hand emoji, which is the punch somebody hand emoji.
Punch somebody? Isn't that okay?
When you go like this, doesn't it mean I'm going to punch?
Ow!
Then, I think that's the A-OK emoji, or the punch somebody emoji, would propagate out to this block. We update this guy, and now the umbrella that most miners are looking at right now doesn't make sense. Because the hash of the current block doesn't give us an umbrella. And that
gives us a pufferfish.
Pufferfish.
Which is still...
I like that pufferfish.
I do like pufferfish. So what we're trying to say is that if you're a hacker, you're trying to change something in the past, and let's say we have more than 3 blocks, let's say we have thousands of blocks, and you're trying to change some transaction in the past, you're going to have to update every single block. And not only that, you're going to have to convince everybody else that they're all wrong, and that instead of a purple umbrella, they should actually be getting a pufferfish, which is really difficult to do because the key takeaway of this is that as time moves on and there are more and more blocks, it's harder and harder to change things in the past. Things get cemented under further layers of security. So we are not done with the blockchain. That's not our only explanation of it. We have a visualization we'll get to, but first we have to talk a little bit more about what else is in a block. And then we're going to actually show you a sort of an interactive demo, and we're actually going to look at the blockchain and see how you can take the hash from the previous block and actually look at it in a current block. So we'll get there. Hey, welcome back. So what we're going to do now, I think it's kind of cool. We're actually going to show you the blockchain, or at least a visualizer for it. This isn't the actual blockchain itself. This is just using the data from the blockchain, a company called Blockchain. It's very confusing.
This is the wallet we used earlier on.
Yeah, it's a private company called Blockchain. Very confusing. But they create this visualizer for us that we can go and explore and look at transactions. But it's not an official thing. It's not part of Bitcoin. It's just using the data that any miner has access to, just putting it online and making it clickable. So what we're going to do here is, first, I just wanted to show you, these are all the blocks mined today. And you could go back in time. You could keep clicking previous forever and go all the way back to 2009. You can also search for a block up here, or using a particular transaction, you could search up here.
But now what we're going to do is look at the most recent block. So if you look up top, it's listed by height.
What's height?
Why is it called height? So in our diagrams, we've been growing a blockchain horizontally, and that's just because the slides fit better that way.
Yes.
The blockchain is described as having a height because as new blocks are added, as new transactions are added, they're stacked at the bottom of the list, or the top of the list. I think it's easier to think of it growing downwards.
So we're basically at transaction or block number 520,093.
Yeah, so since 2009, there have been 520,000 blocks, and people are working on the 520,094th block right now. But 13 minutes ago, 520,093 was mined.
Okay.
So let's look at it.
Okay, so here we are looking at block number 520,093, or is it 94? We started at 0, right?
Depends. There is a bug in the code. Yeah, so we can call this, I think right now they're based on 0, so that this is the 520,094th block.
Okay. So if we skip the headers for just a moment, you can see these are all the transactions. I think, look at my scroll bar over here. There's a lot of transactions here. It's going to take a while to scroll through them, and I'm going to give up. But roughly, we can see that there is a from address and a to address, or addresses.
Yeah, there's two addresses.
And before we talk about that, there's also the amount.
Yeah.
So why are there 2 addresses?
So when you create a new transaction, you actually don't keep any of the Bitcoin in the Dropbox that you open. You effectively throw out that Dropbox and create a new one for yourself. Remember that you can create as many as you want. So the secure way to move Bitcoin when you open a Dropbox is to actually split it up. You send what you want to send to your destination, and then you send the change, you send the leftover, to somewhere, to a new address that you own. We'll describe that in greater detail later.
So let's just say this is you. It's not. Let's say this is you, and then this is me.
Yeah,
and
so
you're
sending 3.39.
Yeah.
Yeah.
And then you have some left over in that first address. It gets sent to this.
Yeah.
Okay, so that's actually not what we're trying to talk about here. That's just something we felt we should mention because it is confusing that there's 2 addresses. But let's go back to the top. What we want to focus on are these little lines right here. So you can see there's number of transactions. There's, what else do we have in here? Timestamp, and the size of the block, and a couple other things. But what we're going to focus on are the rightmost pieces of data here, the hash and the previous block. So let's start with the hash.
So the hash is the hash of the transactions in the current block.
Right.
It's a bit of a simplification. The hash is actually the hash of the header, and we'll describe what that bottom hash, the Merkle root, is, but you can think of the top hash as the hash of the current block.
Okay.
And the previous block down below it is a reference to the block before it, the hash of all of the information in the previous block.
And before we click on it, let's just look at the last little bit.
Sure.
159CF. All right. And I could click on this it would take me there. But to be clearer, we're going to go and just make sure we're clicking the previous block here, 520092. Now let's look at the hash of it. There we go.
59CF.
59CF. And we could do that one more time. This time, let's look at the hash of the previous block is supposed to be A04D. And we're at 520091. And we look at the hash, A04D. So,
and this continues all the way down. Turtles all the way down to the beginning of time.
Yes. And if we were to change something, then that would alter the hash, right? We saw that in Moby Dick, we capitalized one letter, an L, it changed the hash entirely. So if we were to change a number, an address, a transaction amount, any of that, or insert a transaction, for example, or delete one, that's going to change the hash, which means that in the next block, the reference to the previous block is going to be wrong.
All right, so to demonstrate that, we have a simplified blockchain right here, and we've inserted some fake data in these data fields.
Very simplified.
We've got one transaction per block. Each one of these rectangles is a block.
Okay.
And each one of them has data.
Instead of, what was the last one we looked at, 2600?
Yeah, these each have one.
Okay.
And we're just bringing up this page to show you what happens. See how if you look down here, we have the previous hash of each block that references the previous and the current hash.
Right.
And if we go to the left, we go to the beginning of time. Left is oldest. If we were to change the Kevin to Colt, if Colt was to feel like a jerk and somehow want to change this to a 10 Bitcoin transaction, what would it do to the rest of the blockchain?
Well, all of the future blocks, there's only 4 other ones, but those 4 blocks ahead of it are referencing this previous block. And then this one is referencing this previous block. And so if something goes wrong here, you'll just see what happens. It's going to cascade across, and it's not good. Oh,
Danger.
No.
Red.
So now everything's red.
Yeah. So the chain of hashes is now invalid, is now changed.
Yes.
And that's a good indication to anybody looking at the front of the blockchain with, say, a wallet or a cell phone or a simple mining rig that something has gone awry.
Okay, so we fixed it. So we're back one more time. We have the correct data again, but I'm just going to show that if we pick one, let's say in the middle, and I change this, Colt to Kilgore is now going to be 21 instead of 2.1.
Why would you do that to yourself?
Not 2/1.
21.
I had one job. Delete that period. I couldn't do it. So you can see that the previous transactions are not at all red, and red in this case represents just
something's wrong.
Yeah, something is messed up. But going forward, everything from that point forward is wrong because they reference the previous block, and then this is hashed, and this references that hash, and so on. And remember that you change one tiny thing, so the reference to the previous block changed, the entire hash changes because it's hashed in there together.
And if you're having trouble with this, if you're having trouble following these little hashes, don't be too worried. We're going to really dive deeper into this, and we have way better emoji-based diagrams on this in the coming chapters.
And then we'll also learn what the heck this mine button is actually doing.
We will revisit this.
Yes, this is just a quick visualization. Hey, welcome back. So this marks a new section that's focused on mining. So we're still talking about the blockchain, but so far all we've really talked about is the fact that there are a bunch of blocks and they're linked to one another. They're referencing, each block references the previous block, and that is true. But there's this whole side of things we haven't talked about, which is mining. We mentioned that it's a way potentially to earn Bitcoin, although it's pretty hard to do these days unless you're really rich already, but it's still an option. What we're going to talk about is what those miners are actually doing and get really into detail. We've said things so far like, oh, miners store the ledger, they relay transactions, they verify transactions.
So that's great, but what are they actually doing? What are the computers doing that is using so much energy? And why would anyone choose to do that?
Well, really quick preview roughly of what they're doing. If we go back to this demonstration, if you didn't watch the last couple videos, this is just a super simple blockchain visualization, not real data. Here's a block. I'm going to change this. So Kevin sends me 0.1 Bitcoin or whatever this is, and it turns red. But I'm just going to show you this mine button. This is not actually mining Bitcoin. This is purely a conceptual thing. But I click this button and you'll see that this thing called nonce that we haven't talked about at all is going to change. And this hash down here is going to change. You'll see it might take a little bit. No, that wasn't actually that slow. Okay, so this changed up here. This changed down here. Let's try it one more time. And yeah, this one's taking a little longer. So what we're going to do in this section, and not just in this video, it's going to take a couple videos, is explain what the heck that was. What happened? This is a microcosm of what miners are actually doing on the Bitcoin blockchain. I don't know, thousands of times, millions of times per second.
I think it's like quintillions of times every block.
To wrap that up, there is something going on with the hash down here, something going on with this nonce that we haven't talked about at all. That's just to set us up for this section. So we'll leave it at that. There's a lot of work that these computers are doing. Why would they do this?
Because they are rewarded.
Aha. Well, we've already talked about that a lot of times, so it shouldn't be a surprise at this point. But there's a chance to make some Bitcoin. So do all miners get paid, Kevin?
Not necessarily. And it's a question of who gets paid and how often. And it comes down to a concept called proof of work.
All right.
And this is the meat of the next few videos. So the definition...
You're vegan, Kevin. Can't say meat. I'm so offended for you.
So proof of work is loose. I think I wrote this, or someone else did. I don't want to take credit.
Oh, that narrows it down.
Someone wrote this.
It's either me or literally anybody else.
Yeah, or it came from the internet.
Okay.
I forgot. Proof of work is an economic measure that requires a service requester to perform some work to prevent spam. And why would we want to do this? Well, before we talk about it, let's talk about a type of proof of work that we might be familiar with, and that's CAPTCHAs. So you might have experience with filling out these not so annoying little like number and letter puzzles that would be, the reason they're here is because they're hard for a computer to solve.
Yeah, so if somebody, this is chess.com apparently, if somebody wanted to, for some reason, create 1 million chess.com accounts, they could write a bot,
or they could write a bot to ask for the forgotten password of every account on the site.
Yes, so if someone wanted to just try and basically do something that automate something with code to log into the site repeatedly or attempt to log in, they would need to write code that could also, use some computer vision, look at these letters and numbers, read them or figure out what they are, parse them, which is it's actually become a lot easier. It used to be
it's
basically
doable
impossible.
now. Yeah, but
Now
it's difficult nonetheless.
Yes. So it's supposed to, at the very least, make a computer work for spamming or to get through. And captures nowadays are actually much more complicated. You've probably seen them where they involve, actually from a human's perspective, some of them are very simple. They involve just clicking something that says, I'm not a robot. Or what's the other one I've seen? Clicking on like Google or on
Little
street
tiles.
signs and little tiles to identify images.
Yeah.
Things that are easy for humans but hard for computers to do. Anyway, what does this have to do with Bitcoin, Kevin?
So Bitcoin takes proof of work to the next level. Bitcoin uses a much more complicated proof of work challenge that isn't just guessing the letters and numbers on a page. It's actually solving a very difficult math problem. And why do they do that? Well, we're going to go into much greater detail over the next few chapters. What Bitcoin's trying to do is Bitcoin's trying to make it difficult for any one person or any one entity to take over the blockchain by consecutively adding their own blocks. They're trying to distribute the actual additions to the blockchain to make it neutral, because this is a distributed network. So suppose there are 10,000 miners, and suppose for whatever reason there's a bug in the system, and one of those miners doesn't have to do proof of work, doesn't have to show proof of work to add a block to the blockchain. They could just add block after block after block.
They would always be the first one.
They could ignore who they wanted in terms of which transactions they add. They could shut down the network if they felt like it. They would really get to politically take over this peer-to-peer neutral distributed network.
Right. So instead, there's this really hard math problem that levels the playing field because all 10,000 miners are doing the same thing, trying to find the right answer. One of them is going to find it first, but then the next block, it will be someone totally different. It would be highly unlikely for it to be the same person, one after another. So that's what this whole section is about. What is that math problem, that challenge they're doing over and over? But first, let's finish talking about why you would do it. It seems like a pain.
So proof of work in Bitcoin is a difficult math problem based on the current pending block. And miners compete to solve that math problem, that very difficult CAPTCHA, because the first one to solve it is awarded Bitcoin. As of 2016, it's 12.5. And we'll talk about why that incentive structure is changing over time. In 2021, the reward will be cut in half. But all you really need to consider for right now is that miners are incentivized to attempt to solve this very difficult problem in order to keep the network neutral.
Yeah, so it's not just about being the first to mine a block to have bragging rights. You could make a lot of money. I mean, even though it's not 50 Bitcoin anymore, 12.5 Bitcoin in today's prices is over $100,000 roughly. So it is worth it for for anyone really, it would be worth it if you were able to win. The problem is that it's not that easy to win. All right, welcome back. So we're continuing on with our discussion of mining and proof of work, the hard math problem that these miners are trying to solve. And in order for us to explain what they're doing, we have to introduce one other part of a block we haven't really talked about. We've skirted around it. It's called the nonce.
And caveat, you were the one who told me this meant something other than number used once.
Yeah, that's what it stands for, number used once in Bitcoin, but at least in the UK, apparently it's it
means something else.
Yeah, it's slang for a pedophile. So anyway, if you're British,
that's unfortunate.
We're not. Yeah. We didn't choose this.
It's a cryptographic term for number used once, and unfortunately, there's some overlap. So you might recognize that term from being the second row on our blockchain diagram.
And yeah, remember we changed something. We clicked that mine button,
and you'll notice that nonce changes.
And you'll also notice that somewhere on the Blockchain Explorer, where are you? There we go, nonce. So it's a little longer here, but there's some number that is in this block. We're looking at 520.091. There's a nonce there. Every block has that. So what is this and why does it matter?
Well, let's see. So back to our slides. This is what we've been looking at so far. There's actually another piece of data inside of the block that gets hashed, and that is
surprise. We just talked about it.
Surprise, surprise, random number, and that is the nonce. So as we replace these envelopes in this diagram, at the top left, we have the fingerprint of the previous block. At the top right, now we have a random number, and that random number is actually used for the challenge.
Yes.
So let's look closer at the actual anatomy of a block header.
First, we have to get something out of the way. We've been lying to you a little bit.
We're sorry.
We've been saying that when a block is mined or solidified, the entire thing is hashed. All the transactions are hashed, plus the time, the previous header of the previous hash from the previous block. All that's hashed together. It's technicnically slightly different. How is it different?
Now, why is that? It's because the way that SHA-256 works. So it's much faster to hash something tiny than hash something bigger. So what we're actually doing here is we're actually including a hash of the transactions in the block. We just take the fingerprint of the transactions, and the output is just a 256-bit string, which is showed here as 64 characters on the bottom right. And then we include those 64 characters in the header. Okay. And the header is just these 6 pieces of data. The 3 parts that are most important to our learning in this course are the ones that are highlighted. We're leaving out the other 3. We'll go into a little bit more detail about difficulty, but it really comes down to these bottom right 3.
Okay, so to reiterate what Kevin just said, what is happening is that when we have, so let's say 2,500, 2,600 transactions in a block, rather than hashing 2,500-ish transactions together plus the hash of the previous block to get the fingerprint for this block, that takes some time. Instead, we do that once. We take all the hash or all the transactions in the block, we fingerprint them, then we add that to the header, which is what you see right here. We're doing it in the bottom right of the header. We're just displaying it like this. There's no position. It's just data. But we're doing the bottom right.
Yeah.
So then we hash this together to get a faster fingerprint.
And cryptographically, that's just as good as what's below it. Technically, it's a little less secure, but because the SHA fingerprint is so unpredictable and so hard to steer a result out of it, we're completely satisfied with just compressing the entire block of transactions, the entire list of transactions into one fingerprint, and then including that fingerprint in the header. For our analogies and for the course of mining, you don't really have to think hard about it. You don't really have to consider it as just the hash of the header, but we're telling you here just for completeness sake that when these miners are hashing a block, they're only hashing these 6 little pieces of data. It's only, I think, 768 bits, less than a kilobyte.
Okay, so now we get to nonce after that little tangent. So what we're showing here is simplified, but we're using emoji. So this is the previous block's fingerprint. This is the fingerprint of the current block. And it should be the same every time we run this, except there's going to be this random number, the nonce, that we're going to introduce. And so remember, Moby Dick, you change one lowercase l to an uppercase L, totally different output. Well, in this case, we're changing one random number, whether we're changing it from 45 to 46 or from 45 to 7,100 and blah, blah, blah. It doesn't matter. You change it, we get a different output. So when we use emoji,
we get 45, we get a CD or whatever that thing is called. 46, we get a heart. 47, we get a mosque. 48, we get pancakes. Gosh, those look good. 49, we get a saxophone.
What did you
50,
just say?
we get, is that a lotus?
It's I don't know. I
think that's
so.
a lotus.
It's a flower. At the very least,
It's
I can
a flower.
tell you it's a flower. Are we done
51,
yet?
we get, yeah, I think this is the last one.
Okay, so the point is, everything else stays the same. The previous hash from the previous block is the same. The transactions don't change. This one number changes, and the output hash is entirely different. We go from pancakes to
Saxophone,
diamond
lotus, diamond ring.
So, what does that have to do with mining? Why would you ever change this?
Well, it comes back to the challenge. And the challenge, here it is. We're finally telling you what the actual thing is.
Well,
sort of. We're getting closer. The challenge is to repeatedly hash the current block and a random number, the nonce, until you have a fingerprint that satisfies a special property.
Okay.
Spoiler, that special property is that the fingerprint should be lower than a certain number.
So, remember, a fingerprint looks something like this. Imagine, this is not the case, but imagine that you had to keep fingerprinting it with a different random number until you got a palindrome up for your fingerprint, meaning that it was the same forwards and backwards. Or until, I don't know, what letters do we have here?
Until you had 1, 2, 3, 4, 5, 6, 7, 8, 9 in a row.
Sure.
Yeah.
So basically keep changing that random number over and over and over, plus keep everything else the same. Change that random number, fingerprint it until you meet some condition. That's the challenge. Now the challenge itself, Kevin already mentioned briefly. We're not going to go into that until the next video or two. But what we will do is kind of do our own version using emoji.
Yeah. And if this all sounds ridiculous, it's because it is. In the same way that filling out a CAPTCHA is completely pointless. So guessing a random number to produce an output hash that has some special property is completely pointless as of the Bitcoin blockchain. There are other cryptocurrencies that attempt to iterate on this, but for the Bitcoin world and for the Ethereum world, this is really an exercise in futility. There's no point that we're doing this other than to slow people down.
What we're going to do with emoji is, instead of fingerprints being these long strings of numbers and letters, we're going to work with emoji and continue to change the nonce, the random number, until our emoji is yellow. Okay, so we try it.
So let's pretend that our previous fingerprint was a valid emoji.
It has to be yellow.
The challenge was get a yellow emoji, and we got a tennis ball. So that was a valid block with a valid random number. Now, when we plug in the tennis ball, we plug in our current transactions, and we plug in 53, we have Harambe.
Rest
in peace.
That's a gorilla.
Now we go 54.
So we try changing the nonce.
We get cherries.
That's not the output we want.
All right, 55, martini. 56, peanuts. I like that one. 57, surfer.
And finally,
58. Oh, my word.
A lemon. That's
it's
yellow.
A lemon. That's yellow. There's some green on it, but we're considering this a valid output
it just has
fingerprint.
to be majority yellow.
Yeah. So what we just did is we just guessed a bunch of random numbers until hit next slide.
Right. Oh,
That's a good effect right there. I worked very hard on that. So we just guessed a bunch of random numbers until we got an emoji that met our property. Now, again, I'm going to keep reminding you, this is completely pointless. There is no reason other than just slowing down computers. But the net result is that it makes it such that we only add a new block every 10 minutes. And we'll show you really the math in Bitcoin. But for now, we're going to switch over to more of our blockchain diagram where we see a few sequential blocks. So here's the old version where we don't have any particular property of each emoji. Now we have the rock on, we have the little baby chick, and then we have the fingerprint of the previous block right there, and then we got the little happy sun, and that's produced with 12 and 63.
Yeah, so these, first we should mention that there's many yellow emojis. So we're not only looking for the chick or the sun. It could be the tennis ball. It could be the
banana.
Sure.
Could be any one of the smiley faces.
Oh yeah, there we go. They're like all yellow. So these computers keep going over and over and over until they find a valid output, but there's not only one. And we'll see exactly what they're doing in the coming videos. So returning to the Blockchain Explorer, first you'll notice the nonce down here is much larger than what we have, 63 or 12 or something. These are much larger numbers. So the amount of work that goes, there's a lot of guessing that goes into all of this. These computers are basically continuously guessing super, super fast over and over and over.
So, and if you look at the hash in the previous block and the next block, you'll see that they all start with a bunch of zeros. And in the same way that our decimal system works, smaller numbers, if you pad them out with zeros, will have a bunch of leading zeros. For example, the number 100, if we're padding it to 3 characters, doesn't have any zeros. But if we take the number 9, it's actually 009. Smaller number, more zeros ahead of it. Right here, we have a bunch of leading zeros, and that's because all of these hashes share the property of being smaller than what's called the target.
Okay, you're scaring everyone, Kevin.
I'm sorry.
This is what we're going to talk about in the next couple of videos. But instead of finding a yellow emoji, this nonce is continuously changed until we find a hash for this block that has a certain number of leading zeros. We'll leave it at that. All right, we'll explain more later. All right, welcome back. So now we're going to go into detail of the actual challenge that these miners are doing. It's not finding a yellow emoji. It involves satisfying the requirements of something called Hashcash.
Yeah, Hashcash is the proof of work challenge that Bitcoin uses in the same way that a CAPTCHA is the proof of work challenge that a website would use.
Okay, so first, going back to our yellow emoji example, we have this slide here to show you these are the first, these are 30 nonces?
Yes. Yeah, let's pretend that we have a block, we have a bunch of transactions, and we have a previous fingerprint. Let's suppose we plug in 0, we get a crab. We plug in 1, we get an alien. Plug in 2, we get grapes, so on and so forth. This is a chart of those valid nonces, or of the output emoji of a given nonce.
Right.
We're showing this because we want to demonstrate that there are more than one correct answer. There is more than one correct answer.
Yes.
So, voila. 3, 8, 11, 16, 17, 27, all those nonces produce yellow emoji in the same way that there are many more than one individual fingerprint that are smaller than the target, air quotes. There are many emoji and many valid emoji that meet our challenge requirement in emoji coin or whatever we're calling it.
Okay, so you're saying that there's more than one correct answer.
Yeah, there's lots of right answers.
So what is the actual challenge, though, when it's not yellow emoji? What are we talking about with Bitcoin and Hashcash?
So on the next slide, we have Hashcash. This is really what it comes down to. And we'll talk about how target is calculated. But Hashcash is about hashing the header. So these 6 pieces of data, 768 bits, and changing the nonce until you get a value that is less than the target. And the target is a number in the same way that all of these other values are numbers.
So revisiting the Blockchain Explorer, imagine hashing together, again, don't worry about exactly what pieces of data, but just say hashing this data together with this nonce constantly changing, whether it's being picked randomly or one is being added to it over and over ad infinitum until we hit a resulting hash, the fingerprint. And in this case, you can see it starts with a ton of zeros. That means that it's less than the target number. And let's just say that our target number, how many, I'm not going to count these zeros, but let's just say
that's a lot of zeros.
What is that, like 15 zeros, maybe 20?
Give or take.
I don't know. I'm really bad at counting like that. But whatever it is, it had to be less than some number. And in this case, it is.
And remember, if you were to just plug these exact values in on your computer, you would get exactly the same fingerprint. So in the same way that it's easy for a website to verify that a password is correct, it's very easy to verify the correctness of an answer. You, with your cell phone, you with, honestly, an old calculator, could verify the correctness of this proof of work answer with just a few calculations.
Okay, and one thing I wanted to add, look, here is what a average fingerprint looks like. They don't start with a bunch of zeros. I mean, they can, but this is what a typical one looks like. Just a bunch of, maybe a couple zeros somewhere throughout the entire length of the thing. Now imagine having to do this over and over and over just to get 1 0 at the beginning, let alone 10 or however many this is. It's a lot of guessing.
So an analogy that I heard that I really liked was, imagine that this hash right here is actually the output of 256 coin flips. So the output right here, these 64 characters, are actually just a representation of 256 binary bits, 256 zeros or ones. And let's say we call a head a 0 and a tail a 1. So what Hashcash is about is, Hashcash says, I want you to flip a coin 256 times. And I want the first, what is that? Let's say those are 20 zeros. I want the first 80 flips to be heads. Now, how many sequences of 256 coin flips do you think you would have to attempt to get 80 heads in a row if that's 20 zeros?
Right.
So it's extremely rare, and that's why all of these computers have to guess a lot of random numbers. Each random number is basically a way of attempting a new sequence of 256 coin flips. And when you do luck out and find a random number that gives you a sequence of coin flips that is the first, 20 characters, the first 80 flips are all heads, you have found proof of work, and you get a Bitcoin. You get 12.5 Bitcoin.
So just to reiterate, Hashcash involves using SHA-256 and trying it over and over and over on the block header, which includes things like the version of the Bitcoin protocol, the timestamp, and then also the hash of the previous block, the hash of all the transactions in this current block, and most importantly for now, the nonce, this random number that changes, or that you attempt to change over and over and over until you find an output that is less than a target. And what that means is that you're going to have a ton of zeros at the beginning. Exactly what that target is, changes, and how it's calculated we'll go into later. But just think of that now as the goal. Instead of a yellow emoji, we're continually hashing things with a changing nonce until we find a really small number that starts with a bunch of zeros. Alrighty, welcome back. So we're still talking about Hashcash. Now what we're going to do is just walk through a little visualization of what it could look like.
More analogies, just because this is quite conceptually difficult to wrap your head around.
So what we have here is a number line. And let's say that it goes from 0 to 2 to the 256th -1.
Yeah. Next slide, I actually show that number. It's pretty big.
And why does it go up to that number?
So when you have 256 bits, you can represent a number between 0 and 2 to the 256 minus 1. In the same way, a smaller example is easier to understand. If you have 4 bits, you can represent any number between 0 and 2 to the 4th power minus 1. So what's 2 to the 4th power?
2 times 2 times 2 times 2. What is that, 16?
Minus 1?
15.
Which you might recognize that number from hexadecimal. So this number right here is 2 to the 256 minus 1. It's gargantuan. It's I don't even know where to start how to say that number.
But this is the largest output that we could get from SHA-256.
Yeah, this would be the biggest fingerprint. And if you were to actually land it on the biggest fingerprint, it would actually look like a bunch of Fs.
Right.
Would be the fingerprint.
I
wonder what that'll sound like in the mic.
I don't think that's gonna.
So I think someone should get a reward if they ever get that. In all likelihood, it's never happened and probably never will.
Okay, so this is the range of all the possible values for a fingerprint, an output of SHA-256. Now remember that Hashcash, basically the goal is change the random number until you get a value, an output of your fingerprint that is less than some target. Now on here we have this target. This looks like it'd be pretty easy. I mean, what, it would take you a couple of attempts.
Yeah, let's say that's like 1/6 of the way. It would mean on average it would take you 6 guesses. Yeah. This is way
I mean, we wouldn't even be able
scale.
to see. It would be a millionth of a pixel on this screen. I mean,
less. Yeah,
it would be crazy. It would be impossible to see. We'd be zooming in forever to show you the line. But imagine it's right here, and you're trying to guess a number to fit in between this white line and a red line.
Yeah, and we've distracted you here. This slide actually introduces a new piece of terminology, and it's, well, I guess we've mentioned it before, but we mentioned finally how target is calculated. Sort of. It's based on difficulty. So next slide. Difficulty is a setting determined by the network, and we'll talk about how the network determines it, that scales the target in order to control the rate at which Bitcoin is minted.
Okay.
And what's that mean?
Okay, so we've talked about how the goal is to have blocks mined about every 10 minutes or so, right?
Yeah.
And what happens is that all these miners are trying to do this hard math problem, and that statistically, the more miners we have, the faster they'll be able to solve it.
Yeah, and when we say this statistically, that just means that so many people are making so many random guesses that by the law of large numbers, this actually just tends to work out to be 10 minutes every time.
Right.
It's possible that somebody guesses it right on their first try. And it could happen someday. It's just very, 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 very unlikely.
Yeah. Anyway, so depending on the number of miners that are on the network at a given time, the network changes the difficulty, because if there are more miners, then we're going to make it harder. If there's 10,000 miners trying to guess the number over and over and over, it will take less time unless we make it harder. If there are fewer miners, there's only 10 of them, which this is an exaggerated example, but if there's only 10 on the network, then we're going to make the difficulty much easier so that it doesn't take decades.
Boom. So number line, next slide. Illustrated. So if we had 4 miners, we would have a lower difficulty and a higher target than if we had 8. So let's say the number of miners doubled. What we would actually do is we would double the difficulty. And that would actually make the target smaller. And that would mean that on average, the network as a whole needs to make more guesses to find a fingerprint that is lower than that target.
Okay. So we've established that.
Now we got the happy robot and the iMac against one another. I wonder if iMac is verbally trademarked by...
Yeah, just say
Mr.
generic
Cook.
computer.
Generic one-piece computer.
Okay, so these are the 2 miners who are competing right now to fingerprint a block, SHA-256 of that block, pick a random nonce, and have the output be less than this target. So what happens?
So both of them guess. Mr. Robot guesses 1, and One Piece Computer, Purple Computer guesses 7.
Okay, these are the nonces they're guessing.
Yeah, these are the nonces. These are not the outputs. You'll see that the actual pin on the number line is the actual output. So let's say, I don't even want to try and guess how we would pronounce what number came out.
Yeah,
but
let's just leave
it's like
it at that.
50% of the number itself. And then Mr. Robot gets like, I don't know, 75%.
Okay, but notice that there's no relationship. Well, actually, you'll see on the next time they guess again.
Yeah.
There's no relationship between this random nonce and the position on the number line. Otherwise, remember, SHA-256 is not supposed to be able to be steered in any way. You shouldn't be able to figure out, oh, if I just change this one number or I change this character, then I'll finally get that.
Yeah.
No, there shouldn't be no trends that you could follow. So green Mr. Robot guy or gal picks 99, and it's closer, but still too high, not below the target. 15 is what purple One Piece Computer goes with, and that's much higher. But again, you can't infer any. It's not like you guess and check and you say, oh, I need to guess lower.
Yeah, when I guess this higher nonce, the output is lower.
Nope.
It's completely unpredictable.
Yes.
So 124 and 0,
Still not there.
63 and 42.
Aha.
Voila, 42 was the answer. So when the One Piece Computer, when the purple computer guessed 42, we added that little pin, which is smaller than the target. And that means that the purple computer has found proof of work.
So this is just a super quick visualization of what's happening with two miners. Now imagine this number line stretches around the Earth 1 trillion times.
Yeah, the number line is way bigger, and the target, that red line, is way closer to the left side.
And there are thousands of miners rather than two, and they're all trying to guess. And it takes about 10 minutes, if everything goes well, for
Give or
somebody
take.
to get it right.
Yeah.
Welcome back. So in this quick video, we're going to return to this, what do you call this, visualizer, little interactive demo of a simplified blockchain. We have our same transactions in here from, to, and amount. Kevin sent me 10 Bitcoin in this example. Now what we're going to show is what is happening when we click this mine button. So let's not say that I'm malicious. Let's just say that this block hasn't been mined yet. It's still in the process of new transactions are being added in. So Colt, I send Montana, I don't know, 2.3 Bitcoin. Okay, so now what we're looking at is we need miners to compete to take this data, to take the previous hash, which you can see is here from, I think it's, I need to scroll over, but 0.0000221 from here. And I need to take that, and we need to change the nonce over and over and over until we find something. In our case, it needs to start with 4 zeros.
Yeah, so try changing it to 29,267.
Nope. Does not start with
268.
any zeros.
Nope.
And you
9.
can see I keep changing this. We're not getting close. So when I click this mine button, what the JavaScript on this website is going to do is just try this over and over and over. And it might take a little bit, but this is still much, much simpler than the actual difficulty that we looked at. If you remember, we started with like 20 zeros on the actual blockchain. We're dealing with 4 here. But you'll see, oh, that was fast. Ruining my video here. Come on.
Ruin everything JavaScript.
Anyway, you can see this is the nonce it picked, and it ended up with this hash.
2.2.
Let's just try one more. See how long it takes. All right, this one's taking a little
slow.
longer. There we go. Picks a nonce. It tried a bunch of them. This is the one it settled on, and we started with, here we go. We started with 4 zeros. Okay, so hopefully now that makes sense. What is actually happening? Even though this is totally fictitious, just a demonstration, and also much, much faster. It takes one computer a couple seconds max to guess something that has 4 zeros at the beginning. It takes 10,000, give or take, computers guessing millions of times each to...
way more
It takes
than
them 10 minutes on average to do the same thing.
So if you were to run your computer for an entire year straight, even if you had a real fast computer, it's almost certain, and I can't say impossible, but it's almost impossible to actually find a valid proof of work with just one computer. The Bitcoin network benefits from the amount of people working together and the probability distributed over that many computers attempting in unison.
For the last time, returning to this, remember, a nonce in the real world on the actual blockchain looks something like this, much longer. So it could be 1 or 10 or something small like that. It's just really unlikely. You can see we're at 2.4 billion.
Yeah.
And then what we're guessing, we're trying to find a number with a lot more leading zeros, as you can see here. All right, welcome back. So we've been talking about Hashcash for a little bit now, but we've been skirting around these two terms, target and difficulty. We've basically repeatedly said, we'll cover that later, don't worry about it. That's, as some of my previous students know, that's something I probably say too much in my courses. But honestly, in this case, the focus in Hashcash was talking about the basics of the algorithm. That's what we wanted you to understand, this basic challenge. As far as the target itself and how it's calculated, we're going to discuss that in this video and how it relates to something called difficulty. But we'll warn you,
this video is a little bit mathy. So if you don't really care about the math, about how target is calculated based on difficulty, the short answer here is that the target is based on difficulty. And the target is the value under which you want your hash, your fingerprint, to land.
Right.
And when the difficulty goes up, the target will go down. And the Bitcoin network actually adjusts the target based on how quickly miners are finding the answer, finding proof of work.
Right. So remember this example, this number line, this is not to scale because this is a very easy problem in this case. But what we're trying to do, the point of Hashcash, SHA-256 over and over, you change the nonce on a block, and that's the only thing you're altering until you find an output that is less than the target. So the smaller the target, the fewer numbers there are less than that, so the harder it is. So as Kevin is saying, the network updates every 2 or so weeks to reflect...
Every 2016 blocks.
Yeah, which is about 2 weeks, right?
I think it's exactly 2 weeks if they're all on 10 minutes.
Okay, so whatever the period of time is, it's 2016 blocks, and it looks back, the network looks back and says, you know what, I think we were a little fast during that time. Let's slow things down. Let's make it harder. So then they change the network changes itself. It changes the difficulty, which makes the target lower.
And the opposite can also happen. If the network is going too slowly, if blocks are taking too long, then the target will be raised. And how do they do that? By lowering the difficulty. It becomes less difficult for miners.
Okay, so what we're going to do now is talk about the math. So that's really all you need to care about. Is if you want to stop this video, you can. But if you want to learn about the math, learn about the actual numeric values that are assigned and see the current target, see the current difficulty, that's what we're going to do now.
If you're curious.
So there's this equation, target equals n over difficulty. What is that?
And n is a constant, so target is calculated based on n divided by the difficulty.
So n is not actually 16. N is a much, much larger number. It's part of Bitcoin. It's built in. And we'll show you it on the next slide. But the relationship is the same, whatever n is. So imagine we're starting our own cryptocurrency with an n of 16. Remember, Bitcoin's is much larger, but we're saying 16 so that we can do the math easily. And at the very beginning, we set the difficulty to 2.
Yeah, so if we started with 2, we take n, which is 16, and divide it by 2. That gives us 8. So our target lands at 8. Now let's say over the course of 2 weeks, more miners show up, and we want to double the difficulty. Then by taking difficulty from 2 to 4, our equation would then become 16 divided by difficulty of 4, which would give us a target of 4. So what the proportion to notice here is that if we double difficulty, then target gets cut in half. They're inversely proportional.
Yeah. So again, the reason the network does this is not just because it wants to make things harder for no reason. It's that it wants blocks to take a pretty constant amount of time, as much as possible, as close to 10 minutes per block, right?
Yeah, plus or minus a minute or two, but ideally it should be every 10 minutes.
So if some crazy event happened and half the miners just disappeared, I don't know if that could happen potentially, but
maybe
if that
a virus
if that happened, then the network all of a sudden would statistically, it would take a ton longer, twice as long, in order to find the solution for a single block. And then that slows everything down because if we're talking about the same transaction volume, then there's a backlog and things aren't getting processed. So it's important to keep as much as the network can to keep a pretty constant amount of time per block. And so that's what's happening here. Difficulty is the way the network regulates that.
So on this slide, we have the real N for Bitcoin, and it's this number. Oof.
No, okay, nobody pronounces that. It's a very large hexadecimal number. Okay, Kevin, be quiet. So it's a really big number, as you can see here. And it's an hexadecimal because it's just easier for us to fit here. And also it's just a cute little number, all those zeros and Fs. Okay, so if that's what n is, and it's always been that, that is part of Bitcoin. So instead of 16 divided by the difficulty, we're taking this massive number, dividing by another really large number. This is the current difficulty.
For when we wrote the slide.
Yeah. So actually, why don't we just go take a look really quick at the Blockchain Explorer. So here's the block we've been looking at, 520,091. Actually, I think we were looking at 92. But anyway, scroll down, you can see difficulty. Here we go. 3 trillion, is it? 839 billion. Did I do that right? Yeah, 316 million. Okay, that's the difficulty. So if we compare that to, let's go back in time to like half the number of blocks. Let's go to block, what should we do, 250,000?
Yeah, so this will be about 4 or 5 years ago.
You can see difficulty was only 37 million.
Yeah, so way smaller.
And we're talking about trillion today and million back then. And if we go all the way back, let's go to like block 10. Difficulty 1.
So that means just n was, so the target was exactly n.
So you can see that over time, difficulty has changed, and the trend is that it's gone up, but it doesn't have to always go up. There could be a time where it goes down.
And so for the current difficulty, we actually take that n, we divide it by current difficulty, and it gives us a target of 7.78 times 10 to the 54th power in scientific notation. So that's 7 with 54 zeros in it. It's a very large number. So what it comes down to is just finding a fingerprint of a block given a random nonce that is less than 7 with 54 zeros after it. So for a difficulty of 1, as you saw on block 10, what that means is the target was actually just this number on the left, was n. If you take n divided by 1, the target is itself.
Yeah.
And so early miners just had to have that many leading zeros.
Yeah, whatever that
8
is.
Or 9?
8? I think it's 8. So your number, the result of the fingerprint of SHA-256 had to start with 8 zeros. And today we're looking at, 20 or so zeros?
Yeah, a lot harder. And if you think about this in terms of hexadecimal, if you're taking these as sequences of coin flips, at the beginning, all that a miner had to do was flip 256 coins, and the first 32 had to be heads. But now that we have, say, 20, that means that you need to have 80 heads in a row. And that's a lot less likely.
Okay, so it's a lot of math.
Let's take a breath. We've included this cute little picture of a baby cow. This is a break from the math.
Yeah. So moving on from this cow.
Yeah, back to the math. All right. Here's the number line that we had. And Hashcash, as of Q1 2018, is you need to land your fingerprint below this number. So, and we're going to try to depict this number compared to the actual number that it could be, to give you a sense of the scale and the unlikelihood of finding valid proof of work with just a random guess. So in the next slide, this is the real number, 2 to the 256 minus 1. That's the maximum fingerprint that you could produce.
Yeah.
Remembering that a fingerprint is just a very big number, and we represent them with hexadecimal values. So back to 2 to the 256. Now, what we're going to do to simplify this, let's represent the actual target as 2 to an exponent. So it looks a little more similar to the right-hand side. So the target as of 2018 Q1 is about 2 to the 182nd power. Now, this is of course not drawn to scale, and those two numbers don't look so different. But the number 2 to the 182nd power is a lot smaller than 2 to the 256th power. That means you have to take this number on the left and multiply it by 2, and then by 2, and then by 2, and then by 2, about 70 times to get to the maximum value. So it's 2 to the 70th power smaller.
And so this is as close to being accurate as we can get, but this is still not even close.
Yeah, you can see a pixel there, and that's just wrong. The red should be up against the left. So a standard computer to actually do this, it would basically, the statistics we looked up is a MacBook 2014, give or take, can do about 1.8 million hashes every second. So that's 1.8 million guesses in a second. So for a MacBook to actually find proof of work by itself would actually take about 10 million years.
Okay, I am skeptical of that. But
So the reason that's such a massive number, and the reason that the difficulty has gotten so high, is because MacBooks are no longer miners. The new mining hardware is specialized chips called ASICs, application-specific integrated circuits. And these are microchips that have one job and are good at doing only one thing, and that's calculating fingerprints. So you give them a number, and it gives you the fingerprint very quickly, much, much, much faster. Thousands, sometimes millions of times faster than a normal computer can do it. And that's what makes this problem tenable. But this is also a frustration for a lot of people with the Bitcoin network, is that you can no longer use general purpose hardware to participate on the Bitcoin network. It's so difficult to mine now that it's really become a situation. These chips are an economy of scale. So that's why there are these cartels, people who have invested a lot of money into massive mining operations that are running really the big show.
So here's a simple example of, this is a very low difficulty example where the target is a very high number relative to the current targets that we're looking at.
And then the left is a fingerprint.
Yeah, so how many zeros are we looking at here?
I think this is 9.
Okay, 9 or 10
10.
fingers. Gosh, 9 or 10 zeros.
10 fingers.
So basically all that you're trying to do, if this is the target, and maybe this was the target a couple of years ago, for example, you're trying to find a number, the result of SHA-256, such that it is less than this. So for example, we just focus on the first digit there. All the zeros need to be the same, and then the first digit needs to be smaller.
Yeah.
Or, I mean, this whole thing could be zeros, and it would satisfy the requirements. It's just really rare to get. Sometimes on the blockchain, you will see something that has an extra zero, or maybe even more, but it's just really hard statistically to actually find that.
Yeah, it tends not to happen.
So here's a block. This one is 250,002. This was back, when was this? 2013. Okay. So all that we'll say, you can see here, we've got a bunch of zeros. We're not going to count them out, but there's a bunch of zeros. Remember, the target itself is not part of the block. It is calculated based off of the difficulty. So the difficulty is here, but nowhere on the block does it say the target is exactly this.
Yeah, miners calculate that, and people verifying the block calculate that on their own.
But this is the hash that was found. The correct nonce, or a correct nonce, this large number down here.
Mm-hmm.
So when you take this, hash it with everything else, SHA-256, this was an output with however many number of zeros in there, that made it less than the target.
And same as the case for the previous block, same as the case for the next block, and that's why you'll see in a lot of our slides, and then on a lot of these, like block explorers, you'll see a bunch of hashes that begin with a bunch of zeros, and that's because these are small fingerprints.
Okay. All right, welcome back. So continuing on with Hashcash, just a little bit more. You might be sick of it, I know, but it's really important. So what we're going to do is actually walk through a really, really simplified, basic example, but a real example. So rather than working with SHA-256, where the output looks something like this, so instead, we're working with SHA-4, a much simpler version. And just to clarify, SHA-4, this is confusing.
It's not like SHA-2 or SHA-3. We've gone and made it
Those are
more
the
confusing.
families, the general families, SHA-2 and SHA-3. SHA-4 is not used by anybody, but we're just making it up, and it's the same idea, except the output is 4 bits. So
instead of 256 bits, it's just 4 bits.
Yeah, so an output might look like 1011 or 0001, but when we put that in hexadecimal, which is what these are in, we're talking about a single digit because there are 16 options. So 4 bits means there's 16 possible numbers we could represent from 0 up to 15. So when we do hexadecimal, that means 0 up to the letter F. If none of that makes sense, doesn't really matter. All that we're trying to do is hash this together, and our output is going to be some number between 0 and 15. And we're trying to find an output that's less than our target, which for now is 2. So we're using 2. That's our example.
Yeah, so we're still going with an N of 16. So difficulty 8 would give us target of 2.
So what we need to do is find a nonce, continue to pick a random number, hash this thing together until we get an output from the fingerprint that is less than 2.
So on a number line, it's going to look like this. So if we're rolling a die, and we're trying to land it between 0 and 15, then a 0 or a 1 will count.
Yeah.
We're considering this less than, not less than or equal to, so 0 or 1 are what we're
And this
looking
is a
for.
super easy one. Obviously, it wouldn't take very long.
So we pass 87
As
and
the nonce.
And our fingerprint, our SHA-4 fingerprint, is the number 13.
So that's too high.
Yes, too high. And we're giving you the decimal version because hexadecimal is a little more difficult for most people to read.
Yeah, so we need to find a number less than 2. So we need to change the nonce.
So guess again. 6, we get 9. 13, we get 2.
Still too high.
26, we get 5.
42, there
voila, we get 1. So what we've just done is we've established proof of work on this block. We've found a random number by looking through a bunch of guesses that when hashed with this block produces an output, a fingerprint that is less than our target.
Oh, Kevin, we forgot. We have.
Oh, my effect.
There we go.
Love that. So this is a valid proof of work for this block.
Yes.
And this miner would then win the block with the Bitcoin associated with
Which
it.
in the next video, we're talking about rewards. So
Yeah.
jumping the gun a little bit. But as you can see, this is a very simple example, but we change the nonce, we get a different output. There's no pattern that we can follow. We couldn't have just said, 87. Okay, that's too high. We got 13, so we need to do lower. We go down to 6, then we get 9. We go to 13, then it goes down to 2. We go to 26. There's no pattern that we can actually follow here. And 42 is what eventually gave us 1. And this is one potential solution. There's not only one answer, remember. It's just about finding an answer that works. The other thing is that, of course, this is much, much easier than the real version of this. So in the real world, in Bitcoin, it's way, way more complicated and harder to do. It involves way more guesses. We actually have some stats on this.
So this is what the network was running at earlier this year when I calculated this. This is 10 million terahashes per second.
Wait. What's a terahash?
A terahash is 1 trillion hashes per second.
Okay, so that's just 1 second. We're doing 1 trillion guesses, but it still takes how long on average? It takes
10 minutes.
10 minutes. So let me go back to the stats here.
So it's 10 quintillion guesses a second. And at 10 minutes, it's 6 sextillion guesses, which is an unimaginably large number.
Yeah, so this is the number of guesses, on average at least, that it takes. Yeah. Remember, it could be the very first guess that a miner makes.
It could.
It's just really, really unlikely that happens, but it's possible.
It's just by the law of large numbers that this tends to happen after about 6 sextillion guesses.
So in summary, it takes a lot of guesses, a ton, 6 sextillion guesses on average. Huge number in the real world with Bitcoin compared to what was ours, like 5 guesses or something until we got it right.
Yeah.
But that's what you get. That's the idea, is that it's supposed to be hard. It's supposed to involve work. Remember, it's all about deliberately slowing down the network and making it so that it takes time, it takes effort in order for a new block to be mined, and it's not instantaneous.
And that's 6 sextillion. In the last chapter, in the last video, we mentioned 10 million years for a MacBook to guess this. It would take about 10 million years for a MacBook to make 6 sextillion guesses.
Yeah, so that's just one MacBook we're talking about. The network, it doesn't really consist of any. Well, I guess there are MacBooks on there.
There's probably a couple.
But the majority of the miners who are winning, who are correctly mining things, are farms of ASICs,
mining machines. Yeah,
anyway.
Things specifically for this.
Okay. All right. So now that we've covered a ton of detail about the actual process of mining, the math, the challenge that all these miners are repeating over and over and over at these ridiculous rates. Now we're gonna keep talking about mining in the next couple videos, but we're now viewing it from a distance. We're not talking about how it works up close. We're talking about the competition between miners, who wins what, how it's decided who wins, what happens if there's a disagreement or two miners find workable nonces and solve the puzzle at the same time. All sorts of things that have to do with mining that aren't actually about the challenge itself or the math. So let's start by talking about, or reviewing, I guess in this case, the block rewards that miners receive for correctly solving that puzzle.
So in 2009, for the first Bitcoin block mined, Satoshi, or whoever that is, earned 50 Bitcoin for that block. And the intention was that the block reward would be cut in half every approximately 4 years. So there was a schedule based on the block number. In 2012, the reward was cut in half to 25. In 2016, the reward was cut in half again to 12.5. And at block 630,000, which is projected to happen in 2021, the block reward will again be cut in half to 6.25. Right. It's projected to be, the prediction will probably be quite accurate because every 2016 blocks, the network will adjust its difficulty and thus its target and the rate at which it might mints new blocks. So 2021 is probably a pretty accurate estimate. And a lot of people ask here, why is it being cut in half? And why will miners retain an incentive to continue devoting this much electricity to it? And the thinking is that over time, the transaction fees will come to support miners. So we're going to talk about transaction fees soon, but right now we're just focusing on the actual quantities and how they are awarded to an individual miner.
So back on the Block Explorer, this was the most recent block a couple minutes ago. It may have changed, but what I want to show you is that if you look here, there we go, block reward 12.5 Bitcoin, and it tells you the current US dollars, $114,658 as of recording. Of course, that will change. If we go way back though, let's go to block like 200,000. Is that the right number of zeros?
2 million.
Now you can see 50 Bitcoin for the block reward. And then somewhere in the middle there, it changed to 25. We don't have to go hunt it down. But you'd notice that if you go back and you explore different blocks over time, you'll see that the block reward at some point shifts.
Suppose I'm a miner and I've won a block. How do I actually get the Bitcoin? How do I get this 12.5 Bitcoin? So pictured here is our colorful block diagram. And the top 6 squares, rectangles, are the block header, and the colorful envelopes are the actual transactions. So as a miner, what I'm actually doing is I am greedily adding a special transaction at the beginning of that list. And that's, in this case, a 12.5 Bitcoin transaction to myself. So this 12.5 Bitcoin transaction is included in the actual overall fingerprint of the block. And what that means is every miner has their own transaction at the beginning of that list of transactions. So, for example, in this picture, we have 2 miners, miner A and miner B. And they each have their own deposit address for any Bitcoin that they would hypothetically earn from mining a block. So pictured here on the left is miner A with the Bitcoin transaction to address A. And on the right is miner B with the similar transaction, but with a different address. And what that means is both miners are mining virtually the same transactions with the exception of this first one.
Right.
So their fingerprints, even with the same nonce, would be totally different. So this first transaction is actually called a generation transaction, and it has no source, it just has a destination. And this is included in this miner's block, and if the miner does mine valid proof of work, then they broadcast the exact block that they've mined proof of work on. And this helps other miners to verify exactly the order and content of the underlying block, not just the headers.
Okay, so here's a little diagram of, imagine we have miner A and miner B. They both are mining away on the same transactions, but they both have optimistically inserted that the generation transaction, the transaction basically saying, I win 12.5 Bitcoin. So all miners are doing that. It's just only one of them is actually going to win it and have that transaction cemented into the blockchain. But they all optimistically think that they are, or hope that they are.
Yeah, so that transaction exists on every miner. It just doesn't become real. It doesn't become trustworthy Bitcoin until proof of work is found on that block.
Right.
So suppose miner A strikes proof of work. Then they're going to broadcast that information to the rest of the network. And everybody's still mining. But when they hear that miner A has found proof of work on this block, this one where nonce is 66 and the fingerprint is a little tiger, then miner B is going to see that and immediately want to abandon it and jump in front of miner A's block. Now, why would they do that? And this is an important part of Bitcoin mining. In the Bitcoin network, the longest chain is the most valuable. So miners don't have any economic or personal interest in continuing to mine in a contest for a block that they've already lost. That block will very quickly become irrelevant. And why is that? It's because the entire network switches over to it. And as the entire network switches over, the chain gets longer, and People, users of the Bitcoin network, see the longest chain as the one that is most secure, the one that has had most work applied to it.
So now what I want to do is go back to the Blockchain Explorer, and what I want to show is that not only can we see the reward, so in this case, what are we looking at? Block 200,000.
So back in 2012.
The reward, 50 Bitcoin was only worth $624 back then.
So were they like $12 each back then?
So whoever it was won 50 Bitcoin, around $624 at the time. And we can actually see, if we scroll down here, that generation transaction, which is just the transaction of the miner optimistically adding in 50 Bitcoin to me, or to the miner, to their address, or to an address that's generated for them. You can see it here at the very top. So all these other ones have a from address and then a to address.
Oh my word, look at how big the transaction, 100 to 95.
Yeah, 195, there we go.
Rolling
It was
back
only
then.
$2,000 back then. Today, yeah.
Those people would be millionaires.
Okay, so here we go. They all have a from address except this very first transaction. No inputs, newly generated coins going to this address. So this is the address that whoever mined this, or whatever computer mined this, inserted this transaction and then hashed everything together.
And you'll also see it's 50.63. That 0.63 on top is including transaction fees. So remember, we'll discuss that soon. But for mining a block, you not only get the generation transaction, the block reward, you also get all fees associated with the transactions that you include in it.
And now if we look at a more recent block, we're looking at a 12.5 Bitcoin reward, which currently is worth $100 and something thousand. And you can see here at the very beginning, here's that generation transaction, no from address, and it's to this address of the miner. This time it's for 12.9 Bitcoin, which is 12.5 for the reward, plus the fees associated with this block that the miner mined. All right, welcome back. So in this video, we're talking about orphan blocks. And that's just the name for what happens when you have a blockchain that diverges, there's a disagreement, or two different miners find valid proof of work. One is eventually abandoned, becoming an orphan block. So we'll talk about that process. So here's an example of where it could happen.
Yeah, so pictured here is a scenario where two different proofs of work have been found at about the same time.
Our proof of work here means finding a yellow emoji.
Yeah. So we showed these here and also noted that the contents of the blocks are different in this picture because they can be different. In general, they'd probably be pretty close to one another.
It might just be they've received transactions in a different order, that sort of thing.
Or that they, for example, haven't seen all the same transactions that one another have seen. They're just, because the network is so large and is connected by so many nodes, in general, you can see different miners mining different blocks. In this case, I've illustrated them as totally different. They'd probably be about the same, but different in the picture. So pictured here is the network. It's a small network. It's got 5 miners. And suppose that the miner in the top left in the US were to strike proof of work at the same time. Could be Canada. Could be Canada.
Could be Mexico.
Right. Could be Mexico.
Wow.
And then in the bottom right, I'm going to say Australia. Sorry to New Zealanders. They also strike proof of work at about the same time, usually within, 30 seconds of one another. So they strike proof of work at about the same time. And then what happens is they both broadcast their valid proof of work. They broadcast the nonce, the header, and the contents of the block. And what ends up happening is that Asia and Africa see the Australian block, and then South America sees the North American block. What ends up happening?
Well, we end up with basically a split network where we have 2 different blockchains that continue to be mined and new transactions are added on. So that's what you can see here. We kind of have history splitting off. And we have this version in green that continues on, and miners are trying to find proof of work. Then we have this pink/purple magenta version down here, where miners are trying to find valid proof of work. And remember, it all matters what the previous hash was, because that is hashed in to the next block. So if there was another block after this one, so this one is mined, and there's another block afterwards, it depends on that, and so on. And so what happens here is that one of these is going to be abandoned eventually, and it usually happens pretty quickly, because, as we've already discussed, it's really not a good situation to be in, to be a miner mining a shorter blockchain. If there's another blockchain that's longer, that means that it's safer, it's more secure. Yeah, it's more secure.
People are more inclined to participate on a longer blockchain that has more work applied to it, because it means the earlier transactions are hashed under more actual power of proof of work.
Yeah.
And that means they're more secure.
So in this case,
they're harder to undo.
If these two are neck and neck, and they're both working, trying to find proof of work, two parts of the network split, trying to find the next valid proof of work. So in the last slide, we deliberately showed a split here where the pink side has more miners involved, because it's more likely that they're then going to find proof of work faster, that they're going to pull ahead. It's not impossible that green could, but in our situation, it's more likely. So in this case, pink pulls ahead, finds a valid proof of work, cementing the next block, which green was still looking to find. So pretty much everybody on green is going to just abandon that and say,
as soon as they hear about it,
we need to join this new block, and basically this is truth now. This is history. Ignore everything we were just working on, because it's worthless at this point. So it's abandoned. Hence the orphan block. That's the official terminology. And what we'll do now is actually show you some instances in history when this happened.
Yeah, and it's also important to note that the abandoned blockchain, this cool dude Smile, North American block, anyone who earned Bitcoin, the actual miner who earned Bitcoin for mining that block, does not actually get that Bitcoin, because that transaction isn't included in the new main chain.
So much hard work gone. So here's a web page that shows us a history of orphan blocks. Their little definition: detached or orphan blocks are valid blocks which are not part of the main chain. So they are valid. That's the important part. But this occurs naturally, as you can see here, when two miners produce blocks at similar times.
And they also note that this could be caused by an attacker with enough hashing power who was trying to reverse transactions from the main chain. In general, that's computationally untenable right now. It could be possible in the future given centralization, but in general, you don't have to worry about that.
Okay, so what you can see here, it looks like the last one of these orphaned blocks, or the detached blocks, was back in January of 2018. And this was the blockchain when it was basically one blockchain, and there was no disagreement. This was block, 503,948. And at one point, there were two valid proofs of work found. So both of these were called they had height of 503,949. They came directly after this because two different miners found proof of work. And they were, the same day, 23, 28, 07, 23, 28, 33.
Yeah, so 26 seconds apart.
26 seconds between them. So they found it too close to one another, and it propagated across the network. They both propagated across the network, and two different parts of the network started mining.
So it's also important to note that relayed by is listed here. And relayed by refers to the actual party that mined the block. And in this case, it was two mining pools. A mining pool is a team of miners that team up to spread out the risk. And by participating on a big team, you contribute an amount of effort, and you also get part of the earnings of the entire group. So what probably happened is Slush Pool propagated their valid block within their network within 26 seconds of GB miners having found their proof of work. The GB miners found theirs, or heard theirs first, and the Slush Pool heard theirs first, and they both continued forward.
And then eventually proof of work was found on this block, and not this block, it looks like. And so then this one was abandoned, and people moved on to block 503,950. I don't know why I said it that way. 503,950, the next block. And this was left and abandoned. So whoever found proof of work over here didn't actually get paid at all. It's very sad. They had to abandon everything, give up, and start on this chain over here. And you can see if we go back, there's a bunch of these, but overall, compared to the number of blocks, it's really infrequent.
Yeah,
so
it's like once a month in the last year.
It looks like, so January 12th, then December 6th. This tends to happen or coincide with times of increased latency in the network, meaning that there's longer periods. It takes longer for people or miners to communicate with one another, to let each other know what's going on. And that usually coincides with higher traffic on the network.
Oh, look, Slush Pool lost again.
Yeah. You can see this. Let's see. There was November, October, August. Yeah, it looks roughly, I'd say, once a month or so, at least over the last year. Anyway, that's the idea of an orphan block. 2 proofs of work found, only 1 blockchain wins. All right, now that we've learned more about mining, we've talked about Hashcash, we're going to talk about how this all works together to make Bitcoin more secure and more tamper resistant. And we've already touched on this, but we just want to go into more detail now that we understand what mining actually is, what the operation or the trillions of, quadrillions? Quintillions of operations,
Sextillions.
Whatever, the huge number of operations that are happening. We understand why that's hard. Now let's talk about why that makes it difficult for somebody to change something in the past, to tamper with the ledger.
So pictured here is the head of the blockchain. And on the far right, with the circular arrows, we've indicated that someone, actually the whole network, is working on finding proof of work, finding, in this case, a yellow emoji. So for a lot of these examples, we're going back to our emoji example, so we don't have to look at the little tiny hex values. Let's just think about finding a yellow emoji. So the previous values are all authentic or all valid, and now we're working on finding a yellow emoji for this block. So for somebody to break in and tamper with, for example, the leftmost value, suppose we want to add this little red transaction.
With the skull.
Yeah. So if we wanted to change that light blue transaction to the red transaction, what we would have effectively done is change the fingerprint of that block. And now the new fingerprint is very likely to not be a valid in terms of proof of work.
Right.
It's probably not less than the target.
Yeah, and that's, we're adding this transaction. We haven't done anything. The nonce is the same. Remember, this was the nonce 53 that was found to result in this yellow emoji with the blue transaction there. But when we swap out the data, we're still using that same nonce. We haven't tried again to mine this. So we're going to end up with a different fingerprint. In this case, what is this, an owl?
Little owl. So all things left constant, we change one little value, and voila, now we no longer
Kevin loves
have...
to say voila.
Voila. Now we no longer have valid proof of work for this block. The nonce doesn't work. Now, for a client of the Bitcoin network, they would see this block, and they would say, this looks wrong. I'm not even going to take this one seriously. Clients want to see that given a nonce, given the transactions, and given the block header, that we have a valid proof of work, that the output starts with, give or take, 20 zeros.
Yeah, it's less than the target.
So the person who on the bottom has now tampered with it, who's indicated with this little red skull, would then want to catch up to the authentic blockchain. So the owl fingerprint has changed, which means if we want to propagate that outwards, if we want to make the actual chain, then in the next block, we'd need to update the previous fingerprint. So we'd change that previous fingerprint to the owl, and now the next block, this one in the bottom middle, is a watermelon, also not a yellow emoji, given the same nonce, given the same values. So this watermelon brought out to this third block on the far right is now referencing, the third block is now referencing a previous emoji that's not even yellow. So what do we want to do if we want to actually take over the network and add our red malicious transaction? We'd have to start at this leftmost value, or at this leftmost block, and find proof of work on it. Now, proof of work, as we continue to dwell on, is really difficult to do for especially any one individual. So the whole network, it takes about 10 minutes. Suppose you're just one person, and suppose you're even a very prolific miner and you have 10% of the mining power of the network. Even with 10% of the mining power of the network, to catch up all the way to where the current network is, you would have to start hashing as fast, if not faster than them. Because remember, it's the blockchain that is taken the most seriously, that is considered the most valuable, is the longest one. So we'd start at the left, we'd begin mining proof of work, but remember, the rest of the network, the other 90%, are working on the authentic chain. So the likelihood that we catch up, even from 3 blocks back, is so infinitely small that the rest of the network doesn't really take this 10% of defectors seriously. It just falls behind, and it ultimately becomes irrelevant.
Okay, so returning to this blockchain demo, we have our same transactions, we have 5 blocks. Currently, everything has been mined, it's all green. There's nonces, there's valid hashes, everything works. But what I'm going to show is if we change one of these, we've already seen this, but we're going to show what happens when we remine. So first, I'm actually going to take, let's go to the beginning here. I'm going to take a screenshot just of these last 2 blocks so we can reference them. Now what I'm going to do is let's go here and say there's some malicious actor who wants to change this to be 210 Bitcoin. Okay, so now this block is messed up because we no longer have a valid proof of work. Remember that we're trying to start off in this example because it's all done in JavaScript in the browser. We're not talking about 20 zeros at the beginning, which would take potentially years for this computer to do. Or what did we say, a year?
I think 10 million years for a laptop.
Way off.
Yeah.
So instead it just does 4 zeros at the beginning. Anyway, what I would have to do is the rest of the network is still up here, moving on to the next block. Everybody has, as Kevin has already mentioned, as soon as somebody finds proof of work, everyone abandons what they were doing and joins on that solution and keeps going and adds on to it. So here what I'm going to do is click the mine button. This is not actually what mining looks like. You don't click anything really, but you'll see it takes a little bit. The nonce is going to change.
Spinning, spinning, spinning.
Here's the new nonce, and this hash that was found has 4 zeros at the beginning. Okay, so now this block needs to be updated because the previous hash has changed to be 0000F, but we need to find a new nonce. We need to use that. We need to fingerprint all of this together, including the new value of that previous hash. This has to be in there, and this is going to change the output, so let's mine it.
And hurry, 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 because the rest of the network is still continuing forward. We're trying to catch up. So if you were to take over, for example, just 10% of the network, which is a lot of the network, it's 1,000 full nodes, then your 10% mining power against the rest of the network, if the full network is taking 10 minutes to find proof of work, your 10% would probably take about 100 minutes to find proof of work on just one block. Meanwhile, the other 90% are continuing forward.
Well, and there's one other thing to discuss. So let's just finish this. So we have a new hash down here, a new nonce. So then it's been updated here. The previous hash now reflects this one. So we have to remine this block, find a new nonce so that our end result, the fingerprint of this entire block, has 4 leading zeros. Here we go. Kill some time here. All right, so that finished. I'm now going to take a screenshot again. Okay, so here are the 2 screenshots now of just the final 2 blocks. Let's just say that magically you were the luckiest person in the world. You managed to find proof of work, not just once, but twice or 3 times in the time that the rest of the network were able to find one proof of work.
Yeah, your 10% caught up to the rest of the network.
Which is like insanely unlikely.
It's very unlikely, yeah.
But let's just look at the results there. I don't remember which one is which. One of these is the first version, the other one's the second version. It doesn't matter, but if we look, the transactions, in this case, the transaction's the same. But if we look at the hashes, they're totally different. The nonces are totally different. So you're not trying to find the same data, right? There's many solutions to a given proof of work. It's just that it's so hard to find. It's a needle in a haystack, but there's still, I don't know, thousands of needles in that haystack.
Yeah, I wouldn't want to be climbing
massive
around in that haystack.
Yeah. So you're trying to find, a viable solution. And so what we have here are 2 blockchains now that are actually valid. As far as if we look at them from a security point of view, they are fully mined. Proof of work has been found for everything.
So in this scenario where you have caught up with your 10%, what miners are automatically going to do is they're going to prefer the longest valid blockchain. So if your 10% were to actually pull ahead right here, then the rest of the network would actually see this and see, hey, there's a valid blockchain. It's length 5 or it's length 6 now. And even though we're the 90% and it looks like most of the network is working on one chain, we're only length 5. What that means to the mining software is let's go with the more secure option. The blockchain with 6 blocks is technically more valuable or is heuristically more valuable because it's more secure. All the transactions in it have had more cryptographic work piled on top of it, which means that people will want to pursue that. So if you did manage to pull away, you would have successfully taken over the network not really taken over the network, but inserted your invalid transaction, your false transaction, and then the network would believe it.
So anyways, what we're trying to show here is that as you go further back in time into the blockchain, you alter something, the amount of work that you would have to do to try and convince everybody that it was valid grows, and it continues to grow. And remember how much time it takes just to find one proof of work. If you're trying to do something 1,000 blocks or 10,000 blocks ago, that's going to be insane. And I mean, maybe once we have quantum computing or something, that would be possible to do it fast enough to catch up to everybody. But otherwise, it's infeasible. So as time grows, the power of, or the security grows as future blocks are cemented and laid down. It becomes harder and harder to tamper with the past.
Exactly. Yeah, that's why miners prefer a longer chain. You can create a brand new blockchain and do a really low difficulty and put some transactions in it, but people won't really want to spend assets stored on that chain because they won't be confident that those assets can't be manipulated. People believe in Bitcoin, which is something we've been really aiming towards explaining. People believe in Bitcoin because cryptographically, they've threaded the needle so many times. They've threaded the needle 520,000 times, which makes it inherently valuable.
All right, welcome back. So we've been talking at length about blocks and the blockchain. What we're going to do now is introduce an exploit that takes advantage of the 10 or so minutes that it takes for a block to be hashed. And it's called double spend. But first, let's just illustrate it. Suppose I'm selling a car on Craigslist or something like that. And for some reason, I only want to accept Bitcoin. So it's going to be a large amount of Bitcoin. Well, I guess with today's prices, it's probably like 1 or 2 Bitcoin.
I'm going to buy your car for 2 Bitcoin.
Okay. So I post this ad, Kevin responds, he comes over to pick up the car, and I've never sold anything for Bitcoin before. So he tells me to download an app, I do it, he scans my address, he shows me that he's hitting send, and it hits my address, on my wallet app it says, all right, here's a new transaction, pending, blah, 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 you can see this amount to Bitcoin from this address, and I give him the keys, and he drives away.
And it's important to note that it's still pending, and then I drive away.
Yeah. So then a day later or so, I go and check and try and cash it out or spend it on something else. And I realize that I don't have that Bitcoin. What happened?
What did I do?
It's a double spend.
Well, what I did was I, in the background, created an extra address. And this also works. It improves my odds if I create a bunch of addresses. But right now, we're going to talk about one malicious address and one of Colt's address. So in this case, what I did is I, at the same time as sending that transaction to Colt, also created a transaction with the same source, with the same existing Bitcoin, and sent it to both Colt's address. So he got the confirmation, or he got the notification saying, oh, incoming Bitcoin transaction. But I also sent it to an address that I own. And this is a problem with digital currency. This is the difference between something digital and a physical commodity, is you can trivially duplicate it.
Right. Well, and why is this really a problem, though? Because if this one went first, even by a millisecond or a fraction of a second, shouldn't it just be added in first, Kevin?
Well, so I can change the timestamp on my transaction, and I can tell the network, hey, I actually created this transaction 10 seconds ago, 10 seconds before the transaction destined for Colt. Now, some of the miners and Colt's wallet app might indicate that, might only see the transaction destined for Colt. And in that case, it would say, okay, incoming transaction. So let's illustrate this in pictures. On the top, to the destination, this is the Bitcoin transaction destined for Colt. And on the bottom is the Bitcoin transaction destined to my own address.
Evil.
Now, so red is evil, blue is good.
Yeah.
Now, in the next slide, we'll show what they look like on the actual blockchain. Here they are on a block. And in this case, the red transaction appears before the blue transaction.
The evil one.
The evil transaction appears first.
In which case, miners are going to reject the blue one because they're going to realize, wait a minute, this address had, let's say that Kevin had exactly 2 Bitcoin in the address he was sending. The miners will notice that that address that Kevin sent the Bitcoin from had already been spent. The 2 Bitcoin had been moved to another one of Kevin's addresses. The network has no way of knowing what's real and what's not. It's just a to address and a from address and an amount. And so if it received this one first, it's going to assume that mine is fraud, or that's maybe we shouldn't prescribe intent to it. It's just going to reject it because there's no Bitcoin to be spent. That address is gone. So it doesn't get added to the blockchain. So even though I got a confirmation, well, I didn't get a confirmation. I got a notification from my wallet app saying, hey, we noticed there's a transaction. It's pending. Wait for confirmations. If I don't wait for those confirmations, which means that it gets hashed into a block over and over and over, if I don't do that, there's a chance that Kevin could have double spent.
Yeah, this is not a guarantee, but it is a vulnerability because it's a possibility. And if I'm buying something, for example, 2 Bitcoin, and I'm a real jerk, then hey, that's great odds. I'll take a 50% chance of getting a free car.
Yeah, so all you want to do, honestly, is just wait to make sure that you get those confirmations. If you're selling something for Bitcoin, it's not really, it doesn't really make sense as a quick turnaround currency, as something you would buy coffee with, for example. Buying a car, though, you could have Kevin send the currency ahead of time, or I could just have him wait 30 minutes or so to get a couple confirmations.
So let's look at this on the actual on a split blockchain. So suppose we have miners looking at their own versions of blocks. On the top, we have the transaction destined for Colt, and on the bottom, we have the transaction destined for me. Both of them exist at the same time, just in different miners.
Mm-hmm. So let's say roughly half the miners have the transaction to me, the good one, and half of them have the evil one, and it's just a matter of which one they found out about first. That's the one that gets hashed in. So what would actually happen, just like any other disagreement that we've talked about, the longer chain is going to win. So whoever finds proof of work first, which in our example, let's say that unfortunately a miner finds proof of work for the evil chain. Well, the chain isn't evil, but it contains our evil transaction down here. Then the miners that were working on this block are going to abandon it and come join this side, meaning that the transaction I thought that was sent to me, that my phone told me about, even though it never said it was confirmed, I at least saw that it was going to be confirmed, or so I thought. Well, that's gone, and I just gave away my car.
Now, this is hard to pull off.
Yes.
Just because normal wallet apps aren't going to let you do it. But you can build your own wallet app. All it takes is adherence to the Bitcoin rules, and you can interface with the network. And because of that, it's important to know that this is a possibility, and it's important that we show you this because this is the reason for a lot of the latency in Bitcoin transactions. Is many of the services and many of the individuals using Bitcoin are going to insist on waiting for block confirmations. And that has the effect of slowing the actual process down in exchange for more security.
Right. So we're not saying this to, scare you that it's something you have to, constantly be worried about, but it's more just, it helps explain why you need to wait a little bit for your transaction to be officially confirmed. And also, this is one of the reasons that other cryptocurrencies, it's one of the problems with Bitcoin, I guess, that other cryptocurrencies have attempted to address. Things like Ethereum, we'll talk about later, have a much faster time for a block, so that if you want to wait for a couple blocks to be hashed, it might only take a minute to get 3 or 4 blocks rather than 30 minutes. All right, welcome back. So what we're going to do now is address something that we've kind of been avoiding a little bit. We've mentioned the fact that there are fees associated with Bitcoin transactions, but we haven't really talked about where they come from, how they're decided, and what they indicate. What's the point of them? So that's what we're going to do now. Basically, we've learned how transactions work. There's just one missing piece, which is the fee. But first, we got to talk about block size.
So this is a fictional block measured in generic units. A real block is measured in bytes. But for this picture, before we talk about the real size, we're just going to use this for fractions. So This is a 100 unit block. And in a perfect world, a transaction would just be exactly a neat 25 units. You could fit 4 transaction, nice and neat, no extra space.
Or why not like 1 unit?
1 unit would even be
And then we could have 100 of them.
But we need to have some information. The source address, the destination address, the signature. In reality, what ends up happening is transactions are not all the same sizes. So let's cut to the blockchain to see why that is.
All right, so I'm here on the Blockchain Explorer again. This is block 520,832. And if we look here, just as I scroll down, some of these transactions are all pretty different. Obviously, they have different addresses and amounts. But look at how many addresses this one has as inputs. 3 addresses, and then 1 address that it's being sent to. Where this one has, 5 of them?
Yeah, so that transaction, for example, the 5 to 1, means that this person put 5 separate addresses worth of Bitcoin and sent them to 1 address.
Yeah.
And that's 5 input components and 1 output component. And each of those is represented on the blockchain or in a block as bytes.
It looks like they were like consolidating into a new address that had everything from before. Before we go back to the slides, I just want you to see that there are transactions of all different sizes. 1 to 1, we have 2 inputs to 2 outputs. or we have, what do we have here? 3 inputs, 1. Anyway, they're all different sizes, and so they don't take up the same amount of space.
So back to our fictional blockchain, or fictional block. Now we have a real block. So in this square, we're representing 1,000 bytes as just this rectangle.
Yeah. So that's not a block.
This is not a block. Actually, one block is going to be 1,000 of these squares. Actually, 1,000 and a tiny bit more for those of you who are very detail oriented.
But it's 1,048,000 bytes roughly?
1,048,576 in a megabyte.
So anyway, what we have here is just a small representation, but the smallest possible transaction, a one address to one other address, takes up 191 bytes.
Yeah. A 1 in and a 2 out, which is a little bit more common, actually a lot more common, is going to be 250 bytes.
Okay.
So this variance means that the number of transactions that fit in a block varies all the time. And that's why we haven't given you a hard number. We say about 2,000, about 2,400, and that's because it really depends on the constituent transactions. So now let's look at scale. So in this window, these are drawn to scale. If the entire window that you're looking at this in, assuming you're looking at 1080p or 720p aspect ratio, actually regardless of aspect ratio, that square, the pink one, would be about the size of an average transaction. The green one would be a bigger transaction. And this is about how much room in a block you have to fit. So
all the space here.
Yeah, so every 10 minutes, the Bitcoin network can handle this much space worth of transactions. And this is where the controversy comes in.
Right.
A lot of people want to make this space bigger. A lot of people want to cut down the size of those squares. You can actually segregate part of the information in that square to somewhere else. It's not that important to the average Bitcoin user, but just know that there's a lot of controversy around the impact on the size of a block and the scale of what Bitcoin can handle. If they ever want to become a high-speed payment network, they're going to need to be able to handle more transactions than they do every 10 minutes right now.
Yeah, and it also really only matters because there's so many people, so many transactions trying to be made at a given point. If we're talking about, 10 transactions a day, the block size doesn't really matter.
So this slide shows 100 tiles, each of which represents about 1,000 bytes. It's actually, 48,576 bytes.
This is the size of the block. Anyway, we've changed the scale now down to here.
Now we're at grid scale. Each square represents 1,000 bytes. So the biggest transaction ever was actually 999 kilobytes. And this is just a massive transaction because of the number of inputs and the number of outputs. In that case, the block held one transaction.
Okay, so we've talked about this idea of a finite block size that currently is set and may change eventually, but it hasn't. And we've explained the problem of transactions not all being the same size, so they don't just fit neatly in there in a little box. Sometimes they're a lot larger than others. So there needs to be a way to incentivize miners to take on certain transactions.
Yeah, so set priority.
Yeah, and that's where fees come in.
Enter fees, people's favorite part of Bitcoin.
Yeah.
So fees are set by the transaction sender, and the miners get the fees of any block. When a miner strikes a block, they get all of the fees associated with every transaction in that block. And what's that mean? That means that miners are incentivized to include the transactions that have the greatest fees.
So it just means that if you have a really high priority transaction you need done as soon as possible.
Like you need your coffee right away.
Yeah, well, you probably don't want to use Bitcoin
like
for that
10
anyway.
Minutes right
but if
away.
you did want to make sure it's as soon as possible, you would pay a higher fee to ensure that.
Now, what's that mean about network congestion? So when the network is congested, which at times it definitely is, you can't fit enough transactions into a single block. This begins a bidding process. And it's not really a dynamic bidding process. It's just whoever is trying to create transactions will look at the network traffic and see, the network looks congested. I'm going to bid higher. I'm going to pay more, a greater fee, which will hopefully get me to the front of the queue. And miners select for the greatest fees. If your transaction doesn't make it into the current block, it's not that big of a deal. The miners all have a queue and are going to get to it eventually. But this is where the latency of a Bitcoin transaction comes in. If you need your transaction immediately, you got to bid higher. If it doesn't matter when it clears, then you can bid quite low.
Yeah. So we'll wrap this up by showing a history of Bitcoin fees, and you can see that they have fluctuated quite a bit. And this spike here at one point Let's see, the average transaction fee was $32.
Oh no, it got higher. That's not even the peak.
Is it?
Screwed
Oh,
over. I think
you're
it was
right.
in the
You're
50s.
right. I thought,
This
there
is
we
the-
go. 55.
Yeah, this is the average transaction fee. So what people are paying in general at the spike.
And this was back in late December of 2017.
Yeah,
there was
Christmas
a
time.
huge spike in interest and activity on the Bitcoin network. And that coincided with a lot of traffic, a lot of transactions, higher fees. So $55 is pretty high because that doesn't change with the size of the transaction. So you could be paying $55 for a $100,000 transaction, or you could be paying $55 for a 50-cent transaction.
Yeah, which hopefully you're not doing. But
Yeah.
what this means, this is useful for some people. If you need to transfer $100 million, you probably want to break it up into a few, but you don't have to pay some massive clearing fee.
Lastly, this is something that a lot of people criticize Bitcoin for, and other cryptocurrencies try and fix or build upon. Have lower fee structures or different fee structures, and also try and avoid the problem of too small of a block and overloading the network and having a queue and all of that. There are other approaches that ensuing cryptocurrencies have attempted. Hey, welcome back. So we've spent a lot of time so far talking about how Bitcoin uses cryptography to prove the integrity of the ledger. We've talked about the blockchain. We talked about fingerprinting, SHA-256, all of that stuff basically has been around this first point here, proving the integrity of the ledger. But Bitcoin also uses cryptography for a second purpose, which we've alluded to earlier by graying it out on this slide. Now we finally have a slide that emphasizes it.
The other half.
Okay, so we're going to talk about how Bitcoin uses cryptography to prove ownership of transactions, basically to prove that the Bitcoin in an address is mine.
Yeah.
Or that Kevin's sending me Bitcoin to prove that it's actually his to send.
Yeah. So when I send you Bitcoin, how can we be confident, A, that it was mine, and B, that you're definitely going to get it, and that I can't take it back?
Yes. So that's what the next, it's going to be a large chunk of videos, just not as large as what we just covered about fingerprinting and SHA-256 and the blockchain and all of that, but it's still going to be a pretty substantial couple of videos because there's a lot to talk about. We can't just dive into how it works without actually explaining some of the math and cryptography behind it, just like we did with, we talked about fingerprint functions first, and then we applied it to the blockchain. We're going to do the same thing here. We're going to talk about the specific type of cryptography that Bitcoin uses and then apply that to Bitcoin.
And don't be intimidated here. This will be a chunk of videos with some math, but this is a component of Bitcoin that extends much beyond blockchain. Public key cryptography, what we're going to go and do here, has applications all throughout computation and really is an amazing piece of technology that not a lot of people know about. And we're going to do our best here to make it understandable to somebody who has no background in cryptography or math.
So you might have noticed the title of this slide, or the first slide, is Symmetric Key Cryptography. And this is actually not what we're focusing on for the section. This is one video on symmetric key cryptography because what we're going to be learning is called asymmetric key cryptography.
Also known as public key cryptography.
Yeah, so we're going to contrast it. We're going to start by talking about symmetric key cryptography just in this video for like 2 minutes so that when we talk about asymmetric key / public key cryptography from here on out, you'll have something to compare it to. You'll understand the difference between the two.
So symmetric key cryptography, also known as shared secret cryptography, is a type of encryption. And we have the definition here: process of converting information or data into a code, especially to prevent unauthorized access. So if I want to send Colt a secret, how can I encode? How can I scramble some information so only Colt can decode it?
And we've already seen these slides on the Caesar cipher, but this is the most basic type of, I think the most basic. Maybe there's something simpler.
I think this is close to the most basic way
for
to do this.
Symmetric key cryptography. So I can encrypt something to Kevin, and we'll talk about why it's symmetric in just a moment. But
yeah.
I send him a message, hello. Once again, if you missed that video, all that we do is we have a little table here. We find the H. Where's H?
It's a V.
Yeah, and we do the same thing.
Find
for an E, it's
a G.
Okay, and we get this Vigitix. And then I send that to Kevin. He then has the same cipher. He has this table to look up and decode the information using that same thing that I used to encode it. He used it to decode it, if that makes sense.
So we both have the same copy of the cipher. We've shared it.
Same thing here with goodbye. Same idea.
And that's the symmetry, is that both of us use the same secret to both encode and decode.
So I encrypt it to Kevin using that cipher, and it's not limited to just things like the Caesar cipher. There's all sorts of symmetric key algorithms. It's a whole type of cryptography where I send Kevin some sort of encrypted data, and there's some key that I used, there's some magic that I applied, and then Kevin can use that same thing to go the other direction, to reverse it and get the original message back using the little bit of magic that I used, if that makes sense. It's sort of like a reversible cryptography. So to wrap that up, with symmetric key cryptography, which is also called shared key or shared secret,
shared key,
both the sender and the receiver need the same cipher. It all hinges on that. Yeah. Kevin has to have, if we're talking about the Caesar cipher, he has to have that little table that says what I'm mapping the different letters to in order to understand my message. So that he can go, I can encode it one way, he can decode it the other way. Again, it's not just the Caesar cipher. There are much more complex algorithms that still are symmetric, meaning that the sender and receiver both have to have knowledge of that algorithm. All right, welcome back. So in the last video, we talked about symmetric key cryptography really as a counterpoint for what we're actually going to dive into in this section, which is asymmetric key cryptography, aka
public key cryptography.
Yes. So everything we saw in the last video, again, it's not actually what Bitcoin is built with. Symmetric key cryptography, it's built with, or one of the things it relies on is public key cryptography. That's what we're really focusing on. We just wanted to show you something to compare it to. So now we can contextualize it a bit more. So public key cryptography is something that it's pretty cool. Kevin has some very strong feelings about it.
The next few videos are so cool. We're going to do our best to explain a concept that is really interesting, even if you don't care about cryptography or math.
Okay, that's all opinion.
I'm hoping that we're going to do our best to explain this in a way that a layperson can understand this, and hopefully my goal here is that our students leave here with an understanding of what is possible with this new form of communication, secret communication.
It's something that's really powerful, and it's not just relevant to Bitcoin. It's relevant to computing in general today. Whether it's
all over the place.
It's all over the place, and there is some math involved, but you honestly don't have to understand every little bit of the math to understand the power and the utility of public key cryptography. So why don't we just dive right in? What is it?
So public key cryptography is a cryptographic system in the same way that a Caesar cipher or a symmetric key cryptography is a cryptographic system that uses instead a pair of keys, not just one. And one of those keys is public and one is private. And those two keys are produced by solving a very difficult math problem. We're going to go into a little bit of that, but in general, what you need to know is instead of one key to communicate, where both parties have the same key, in this case, there are two separate ones. There's a public key that anybody can know, and then there's a private key that only the creator of the key pair will know.
Yeah, and both of them are just really long numbers. And actually, this should sound familiar at this point if you've followed the whole course. We've talked about this idea of something that's public that can be shared with people, an address, for example, and something that's private that you keep yourself in order to get access to Bitcoin. So we've been using these terms, but now we're going to actually show the relationship between the two keys and talk about how they're generated and talk about the math. So stepping back, this is not public key cryptography, what we're showing you here. This is a diagram of a shared key cryptographic system like the Caesar cipher. So if you're colorblind, these are two of the same colors, green here. So you have a message, I encrypt it with whatever, let's say a Caesar cipher, send it to Kevin. He has the same cipher. He knows exactly how to decode it. He uses that same key. In this case, it could be a table that says A turns into X and B turns into Y or whatever it is. But he has a way of decoding it or decrypting it. That's shared key cryptography.
So we share the key in advance before communicating,
yes.
which is a flaw in that system. It's very difficult to securely share a key, especially if we're geographically separated.
Right. All right, so this is what public key cryptography looks like. So there are two keys. Basically, before anything happens, I could go on my computer and basically run this very hard math problem and generate a pair of keys, a key pair, public and private. And then I can share that public key with Kevin, for example, or with anybody and say, hey, Kevin, here's my public key. Next time you want to send me a message, whatever your secret message is, use this public key to encrypt that message. Now, what the encryption looks like, we'll talk about later, but just imagine that it somehow scrambles it up, whatever his message is, hello world, or how about actually its coordinates to where he buried a body.
Body. Yeah.
So it's some secret thing. He doesn't want anyone to intercept. He uses the public key I gave him. I gave to anybody. He uses it. He encrypts it. We end up with a scrambled version. Then to decrypt it, I'm the only person who has the private key, unless I was a moron and gave it to somebody else. But I kept it to myself, and I can unscramble using the private key. So it's this different relationship. There's not one key that we're sharing. There is one thing I'm sharing with Kevin, but then I'm keeping one part for myself. Or I could share that public key with everybody in the world and say, anytime you want to send me a secret message only I can understand, use this public key to encrypt your message, and then I'll use my private key.
Yeah, so everybody can use the same public key. We can always use Colt's public key if we want to encrypt something that is destined for Colt. However, only Colt will be able to open it, because Colt is the creator of the key pair, and Colt has kept his private key, basically the unlocking mechanism, private.
So what's this have to do with Bitcoin?
Now we return to our analogy
of a Dropbox.
So these Dropboxes. Here we have a picture of a Bitcoin. There's just a letter B. This is the symbol for Bitcoin going into an open envelope. And this operation here that we described earlier on in our first and second iterations of explaining this somewhat crummy analogy of I can put Bitcoin into a Dropbox that Colt created, and then only Colt can open it. That operation is performed using public key cryptography. I actually use Colt's public key as the destination, as my Dropbox. So I wrap my Bitcoin with Colt's public key. And once that Bitcoin is locked onto the blockchain, then Colt will be the only one who can open it. Colt will be able to use his private key in the future to unlock the transaction that I stored on the blockchain for him. So this is a secure way for me to transfer something to Colt, and also consider the fact that once I put my Bitcoin into it, I can't get it back out. I don't have the private key corresponding to Colt's public key. I can't undo my transaction. And this makes the act of a Bitcoin transaction, once it's on the blockchain, irreversible. So Satoshi Nakamoto, whoever they were, took this concept of public key cryptography and applied it to transferring something of value on a network, on a distributed network. And this allows people on the Bitcoin network to transfer a piece of data, a Bitcoin, or some denomination of Bitcoin, to somebody else and make that transaction irreversible. And then once that person has that transaction in their possession or on the blockchain, nobody else can take it from them. So this is how we establish ownership.
So this is what really we're setting up the rest of this section to talk about. These diagrams are on the very, very simple overarching view of how this works, but we're going to dive into actually looking at some numbers, talking about how the public and private keys are generated, how they relate to one another, how the encryption and decryption works, at least at a surface level, but definitely deeper than what we're talking about here. That's going to be the bulk of this section, and it's going to take a couple videos to really see the big picture, so hang in there. All right, welcome back. This is going to be a really short little demonstration, but I think it's going to be nice. I'm excited about it. I think it will help explain how this stuff works. So we found this website, maybe not the most beautiful website.
It's beautiful. I like it.
It's beautiful in its own way, but it's really a nice simplified demonstration of public key cryptography. So what I can do is click this button, generate keys, and it will perform the difficult math problem we kind of have alluded to. However, it's going to give us two very short keys. The ones we're working with will be way, way, way longer and more secure. But basically, all you need to care about, it gives us a pair of a public key and a private key, and there's a very special relationship between the two. They're not just two random numbers. They are the outcomes of a difficult math problem.
So I'm going to walk away from the screens.
Okay.
And Colt is going to generate a key pair, and he's going to tell me his public key, and then we're going to encrypt a message. And we're going to see if Colt can then decrypt it with his private key.
Okay.
And hint, hint, he'll be able to.
Yeah.
Okay, so I'm stepping away.
Kevin. I'm actually going to hide the private key from you two for now, from everybody. I'm going to block it out on the screen in post-production, if I remember to do that. Okay, so here we go. Everyone can see the public key. Kevin, are you listening?
Yeah.
The public key is 251.
251.
Okay, so I tell him that. Now I'm going to refresh the page. And now we're starting from a blank slate. Imagine that now Kevin is at his computer, or he could do this on paper if he really wanted to. It'd just be some hard math. But he's going to send me a message about what are we doing? Where the treasure's buried.
my favorite color.
Wow, what a message.
It's a secret.
So what is it?
It's not going to be a secret for long. Now, hold on. You're going to have to step away. Get away. All right, so now I'm sitting at Colt's computer through a different mic, and I'm going to type my secret message. Actually, are we going to block this out, Colt? I think we're going to block out my message too. Yeah. Okay, so we're going to block this out, and I'm going to type in my secret message. What is my favorite color? And my encryption key was 251. Yep. Colt, that was your public key? Yeah, 251. And now I'm going to hit encode. Okay, so we get this result. Stay back, Colt. We get this encrypted message. Hide this, and I'm copying and pasting the encrypted message. So here we have it. So I'm going to give this message to Colt, and he will hopefully be able to decrypt it using his decryption key. So Colt, come back. It's in your clipboard. So pretend this is happening across a geographic distance, not just across a room where Colt is standing facing the wall. And suppose that somebody is trying to intercept our communication. We're trying to communicate secretly. So the only information we've transmitted between us up until now is Colt has told me his public key. And now I've taken my message and I've encoded it, and I've written it on a piece of paper and sent it in the mail.
Yep, and I just got it. So here it is.
There it is. Colt has transcribed that.
So
and now
this makes no sense to anybody unless they have the private key to decrypt it. Now, I didn't tell this to anybody. I hid it from you actually as well. And I could still hide it from you. I'm going to do that right now. I'm going to hide this just for a second. I'm going to type the decryption key in here, which is my private key.
I'm not looking.
And I'm going to click decode. So here we go. The decrypted message is chartreuse.
Voila.
That's your, yeah, that's Kevin's favorite color. And voila is his favorite phrase.
Yeah.
So again, imagine, so I actually haven't shown you the private key at this point. So I could use it again. I could give anybody who wanted to send me a message, any of the allies on my team during this, or on my, whatever, my side during this conflict, send me a message encrypted with the public key 251.
Yeah. Now, if someone intercepted that, let's say the bad guy, let's say Hans Gruber, intercepts the piece of mail and knows that Colt's public key is 251 and then sees my scrambled message, there's nothing he can do with it.
Nope.
As opposed to if it were a Caesar cipher, then if Hans Gruber had the Caesar cipher and the encrypted message, he could just easily decrypt it. And this is really the innovation with public key cryptography.
Oh, by the way, if you care, my key was 5. That was my private key. So very easy to guess. In this case, like these tiny little keys, someone could just sit here and type, okay, how about 6? Is it 7? Is it 8? But the actual keys we're going to be working with are massive. They actually look something more like this. So here's a key pair. We can generate a new key pair. This is just a little online tool that we found that helps do this very quickly. So we've got private key, and this is in base 10. So it's a smaller number. And then our public key is this really long string. This is in hexadecimal. So the actual number in base 10 would be much longer. Okay, so it doesn't really matter what the numbers are, but just keep in mind when we say public and private key, we're not talking about 251 and 5. In the real world, we're talking about things like this.
Which are unguessable. You could have every computer in the world running for 1 million years and you wouldn't guess one of these.
All right, welcome back. So just like we did with hashing functions, where we explained the idea of a hash function, and then we actually went into the detail of explaining MD5 or introducing the actual implementations, MD5, SHA-2, SHA-3. Then we walked through and did some examples with SHA-2 and explained how it works. We're going to do the same thing now with public key cryptography. So we've talked about at a high level, you got a public key, you got a private key, and we've talked about how it works. You share the public key with anyone, you keep the private key safe, and you can communicate, or at least in one direction. Kevin can send me messages if I have the private key and he has my public key. And if I want to go the other way, I'd have to generate a new key pair, or he would generate it and give me the public key. But we haven't actually talked about any implementations. We've talked about it in general terms. Now we're going to introduce 2 specific implementations, 2 actual public key cryptographic systems.
So these are 2 public key cryptographic algorithms. On the left is RSA, and that's what we're going to cover in this chapter, in this video. And it's a lot easier to understand, but it accomplishes the same thing as Bitcoin's actual algorithm, which is ECDSA. That's a lot more advanced, but it has smaller keys. So the actual pair of keys, those numbers are smaller, but more secure. We're going with RSA because it's a little bit easier to understand. The math is sort of, you can fit it onto a single slide, and most people will be able to understand the basics of that math, whereas ECDSA, which stands for Elliptic Curve Digital Signature Algorithm, involves understanding a lot more complex geometry to figure out the relationship between a public and a private key.
Yeah, so we're just going to explain basically the same concept. It holds true between both algorithms, both implementations. It's just that the math itself is different. But the relationship between the public and private keys are the same. It works in the same way. These are just two different ways of doing it. RSA came along first, as Kevin mentioned, in the 70s. It was, what's it stand for again?
It's named after its inventors, Revest, Shamir, and Adelman, and that's three, I believe, professors at MIT.
Yep. So in the 70s, I think you'll come to appreciate how crazy it is that they came up with this.
That they discovered this relationship.
I mean, it may be, I don't know, maybe people who are, cryptography majors and have PhDs are laughing at this, saying that, oh, it's actually common sense. But it just seems insane to the layman that we are over here coming up with this. And we're going to dive into the math now, but we just want to explain ECDSA is the real thing. So we don't want you to think that RSA is what Bitcoin uses. But the truth is, it doesn't matter as far as explanation-wise. It's going to be the same concepts. You need to understand the public and private keys either way. The actual implementation is hidden away from you in the bowels of Bitcoin. So before we actually talk about RSA, we need to just cover two concepts in math. If you're familiar with them, you can just skip through this. It's just going to be a minute. Exponents and modulo, two operations. So the first one, exponents, you probably are familiar with, or you may be. Modulo is a little less commonly used in the real world outside of programming. But exponents, let's start there. How's it work, Kevin? In like 2 seconds, don't bore us.
Exponent means multiply a number by itself that many times. So if you want 2 to the third power, so when you say exponent, you say to the power of this number. 2 to the third means 2 times 2 times 2, 3 times.
So we get 8.
8. So 5 to the fourth power means 5 multiplied by itself 4 times. 5 times 5 times 5 times 5, which is 625.
Okay.
So 2 to the fourth power would be 2 times 2 times 2 times 2, which is 4 times 4, which is 16.
Okay, so next we've got modulus or modulo. I don't know which, I think they're used interchangeably.
Both work, yeah.
We looked it up a while back on Wikipedia. They're both listed there. I kind of use them interchangeably too, I think. So the way that it works, it's also called the remainder operator. So I don't know how schools around the world teach division, but the way I learned division, before we talked about fractions or decimals or anything, we just talked about using the remainder. So we would say, let's say 9 divided by 2. You would figure out how many times does 2 go into 9 as a whole number. Well, it goes in 4 times. 4 full times. So that gives us 8, right? 2 times 4.
But then
there's a remainder of 1. So I would actually I would do this little division house, is what we called it. 2 goes into 9, and we'd write 4 on top, R1.
Remainder 1. Modulus is just asking for the remainder.
Yeah.
So when we say 7 modulus 3, we're basically saying 7, when you divide it by 3, what's the remainder? So 7 modulus 3 would be, you take 7 divided by 3, and we get 2. And we know that the remainder on top of that is 1. So 7 modulus 3, or 7 mod 3, is 1.
Or here's another example. 11 mod 4. You figure out how many times does 4 go into 11 without a fraction. Just the largest whole number we can multiply 4 by that is less than 11. So that's going to be 4 times 2, right? So that gives us 8. So then we have 8 compared to 11. That means a remainder of 3.
So 11 mod 4 is 3.
All right, one more little quiz.
Mod 5. So how many times does 5 go into 12? It goes in 2 times with a remainder of 2.
Yep, 5 times 2 is 10. That gives us 12 minus 10, which is 2. So that's the end of the math review. Coming back to RSA, which again is just one implementation, the most famous, the first implementation of this public key cryptography system.
Yeah, in the same way that MD5 and SHA-2 are just implementations of fingerprints.
So what we have to talk about here is that we've been saying there's a public key and a private key that are generated, 2 numbers. There's actually a third number that goes along with them.
A special number called M.
Okay.
So when you solve the RSA seed equation to generate a pair of keys, you get out a public key and a private key and this special number M. And M is going to, whenever you're transmitting this information to anybody. If you want to tell them your public key, you also have to tell them M, because it's part of the calculation, how you encrypt it. For analogy's sake, it's just easier to think of it as one part is public and one part is private, and there's also a little thing that you always include with it.
So now we've established there's these three variables, these three pieces, and let's just say that the private in orange that just always stays private, and that's the one thing you want to bury wherever the safest place is. You don't want anyone to get that.
Yeah.
The public key in M, that's okay for
once you
people to see.
generate those, you can just smack them on a billboard. You can put them on your website. You can put them on your business card.
You can we could have like a little circle around this, just calling this the public key.
Yeah.
But technically, for our math equation, you'll see why we're not doing that. So on the next slide, we have some math. Here we go.
Well, this is all the math. This is the RSA algorithm. Well, this is actually the RSA encrypt and decrypt step. We're not going to go into how you generate the key pair. That's a little more complex. But when you want to encrypt a message with the RSA algorithm, all you do, and remember, we think of a message as just a piece of data, and on a computer, you think of data as a number. So the word hello can be thought of as a number. A picture can be thought of as a very, very large number, but you can take that message and raise it to the public key. So the public key is also a number. So to encrypt something, you raise it to the public key, and you take the answer modulus M, and that output, that number right there, is your encrypted message.
Right.
Now when Colt, if I'm sending a message to Colt using his key pair, Colt has his private key. When Colt receives my encrypted message, pictured here on the bottom, Colt takes my encrypted message, which is just a number, and then raises it to his private key, modulus M, and the output will actually be the message itself, the original number.
So we're showing the math here, but in reality, nobody actually goes and does this math themselves. One, because you don't need to, there's code to do it. But two, the numbers are so massive that you can't just pull up like a calculator out of your desk and even type in a public key, for example.
No.
They're just way too long.
Yeah.
But it still works. The math is the same, and we're going to work with really simple numbers to start to just demonstrate that to you. But we're not showing this to you because you need to get ready to do this math yourself. We're showing it to you so you understand how these work together and the relationship.
And in terms of scale, these numbers that we're dealing with here are so much bigger than a fingerprint. A fingerprint is typically 256 bits. The numbers we're dealing with here are 1024 or 2048 or sometimes 4096 bits, zeros and ones. And those numbers are so unimaginably large that you would never be able to plug them into the biggest you'd need a calculator the size of a building to type them in.
Okay.
But what's neat is because we're using the modulus operator, there are some math tricks that actually make it tenable to do the exponent operation on them on a computer.
We're getting carried away, Kevin. It's good information. But here's just a review. So public key, I give Kevin the public key. He has a message he wants to send to me. He encrypts it, which again means raising the message to the public key, modulo M, taking the remainder with M, which was generated at the same time. He sends me that result. And then I take that result. I have my private key. I raise that encrypted message up to the private key, which is just a number. I mod the same M that Kevin used, and I get the message back out, which it's pretty crazy. So again, this does not work with just arbitrary pairs of numbers. It's very, very difficult to figure out a pair of numbers that this works with, or a triad, a
triplet.
Triplet, there we go. To figure out three numbers that, including M, that make this work. You can't just pick random numbers. This is not like a mathematical property of the world. This is a property of very, very special sets of numbers.
So here we have an actual triplet.
A really simple
key pair.
one. The shortest, I think this is the smallest one, right?
No, you can do smaller. I think like 1, 1, and 0 technically works. This is one of the smallest usable ones. So if you actually wanted to communicate with somebody but wanted to be able to do the math, you couldn't even do this math by hand. If you wanted to be able to do it with a computer calculator and no code that optimized it, this one would work.
Except it would also be pretty easy to guess, right? Because we know that we're working with small numbers.
Yeah.
But so this is not secure, but it follows the relationship.
Exactly. So our public key in this scheme is 7. Our private key is 23. And M, that extra number, is 55. So if Colt were to have generated this and wanted me to send him a secret message, he would just give me 7 and 55, and he would hide 23.
So suppose Kevin and we're, I don't know, in a foreign country, and we're
behind enemy lines.
Behind enemy lines, and we're trying to rendezvous at some point in the next day. But
To
we need to figure out a meeting
bury
time.
that body.
Yeah, we need to figure out a meeting time. And Kevin's not just going to send it to me as plain text, and he doesn't want to use some sort of Caesar cipher because he would have to send that to me as well. And then if it was intercepted, then the whole jig is up. So
The jig is
we
up.
already have this public and private key pair generated. I have the private key. He has the public key in M. So I give it to him, and he's going to tell me the meeting time is 16, apparently. 16 o'clock military time.
16 o'clock.
Or just
So-
anywhere that's not the U.S. time.
Yeah, the rest of the world. So to give Colt this secret message, 16, without having actually shared anything other than the public key, what I do is I take 16 and raise it to the 7th power, modulus 55.
So 7 is a public key.
So 16 to the 7th, mod 55, is 36.
And let's just take a moment. 16 to the 7th is a big number.
Yeah, it's pretty big.
Even though we're talking about a small exponents here, 16 to the 7th grows really fast. This is 16 to the 7th right here. So those are two small numbers. This is a 2-digit number raised to a 1-digit number. Now imagine we're talking about numbers that are huge, like way, way huger. Now imagine potentially a number that's more than 1,000 digits long. These numbers more than 1,000 digits long. The result is just going to be massive.
So back to our mini example. I've encrypted this message with Colt's public key, our 4 o'clock rendezvous time, and it comes out to be 36. I can just broadcast this over a completely insecure channel.
Yeah, he just goes out and starts yelling 36.
I can just
like a
shout
madman.
36, and I think people would realize that we're up to something no good if I'm shouting some people would think something was up if I was just running down the street shouting 36.
Anyway, he says 36, or he gets that to me somehow. If you're shouting the data 36 across the street, and somebody knows the public key
And the modulus.
and M, can't they just work backwards?
So unlike a plus, or unlike an exponent, or unlike a multiplication, you can't work backwards in a modulus. It's a one-way function. So the one-wayness of modulus means that when you actually perform modulus on that really big number, 16 to the 7th power, which was what about 2 million or something, 20 million?
Yeah, it was the long number.
It was a big number. When we modulus 55, we really lose a lot of information there. We get 36. There's a lot of division pairs that when you take this number, mod 55, the output is 36. You can't work backwards with just 36 and a modulus 55 to determine what the input was. You might be able to narrow it down given the fact that our public key is just 7, but at the scales that real RSA keys work at, there's absolutely no way to reverse the modulus operation.
Yeah.
It's a lossy one-way function.
Yeah, and that's different than multiplication and division, or addition and subtraction, or exponentiation. It's kind of unique in that sense as far as the traditional day-to-day math that people do.
Yeah.
So then on my end of things, I have the private key.
So Colt hears someone shouting 36 walking down the street, and he's like, oh, that's probably Kevin.
Yes, and I know my private key, and I know M, which again was public. So really, it's just the 23 that I need to keep secret. So then I take 36, his message, I raise it to the 23rd power, which is going to be a really big number again. And then I'm going to mod by 55, which trims that all the way back down to 16.
And let's look at 36 to the 23rd, mod 55, just to prove that that's true. So now we're at Wolfram Alpha, which is a much more powerful online calculator than just Google. And why are we here? Because 36 to the 23rd power is a massive number. So we take 36 to the 23rd power, mod...
Well, let's just look at that number first.
Oh, there's the exact number.
So
That's a
this is
good calculator.
That's the number itself.
So let's do that guy, mod 55. Copy and paste
Scientific notation really is not cutting down on this. Okay.
So we grab the number.
I'm going to paste it in here.
And then we do space mod 55. Is 16. And that's the original input.
Yes. So you can see the math is really complicated. I mean, it's feasible that we could do it by hand, even with these small numbers, but to multiply something out to this, you gotta be pretty good at multiplication by hand and not make any mistakes and have a really long piece of paper and a lot of patience. So that's the relationship. Again, Kevin takes a message, in this case, just the number 16, raises it to the public key, mod 55. Then I get that encrypted message. I raise it to the private key, mod the same 55, and I get the original message back. It's pretty cool. And this only works with special key pairs that are the result of this crazy math problem that generates them. Generates M in the public key and the private key. So we're going to end the video here. I know it's a lot. Just keep in mind that you don't have to be able to do this math. The computer takes care of it for you. Bitcoin does all of it for you. It's just cool to understand how this works. And it's pretty magical. Okay, we're just going to end the video now.
Voila.
All right, welcome back. So we've spent a while talking about public key cryptography in the context of encryption. So you have your two keys. I'm trying to communicate with somebody, or I want someone to communicate with me. I give them a public key. I keep the private key. You can see this little diagram here. I have a message. Let's say Kevin encrypts it using the public key, sends it to me, and I'm the only one who can decrypt it with the private key. That's a traditional use of cryptography, communicating and trying to obfuscate or hide a message and then being able to decode or decrypt that message on the other side.
Yeah, that's the one that Caesar was trying to do.
Yes. Now we're going to flip it on its head and show you, basically, if you switch the order of the keys, you can do something totally different. And the reason that we're showing you this, it's called private key signing, is that it's what Bitcoin uses. Bitcoin doesn't actually use public key cryptography to encrypt anything. This slide doesn't exist in the Bitcoin world. It only works, or it only takes advantage of the other direction. And it's kind of a big pivot here, and it might be a little jarring, but bear with us. We're going to devote a good amount of time to explaining how this works, because it's kind of unintuitive that you would want to do this in the opposite order, but we'll explain why in just a second.
All right, so let's review our equations here. This is how one would encrypt a message using a public key and then decrypt it with a private key. You take your message, you raise it to the public key, which is just a number, modulus n, which I think we called m in a previous chapter, should be n. That will give you your ciphertext, your encrypted message. And then you pass your encrypted message over even an unsecure line to your destination, and only they will be able to decrypt it with their private key. So we've compressed this down into one line. We've sort of simplified the equation that if you just take the message to the public, mod n, you take that result to the private, mod n, you just get message. This is both of the equations on the previous page mushed into two lines. Now, if we keep extending that out, you can take the result to the public, mod n, to the private, mod n, and ultimately you're going to get the same message out. There's no reason you'd really want to do this over and over, but we just want to show you this because this is a process that you can repeat over and over. This is called idempotence.
What was that?
Idempotence, idempotency. This means that you can repeat the operation over and over and you're going to get the same result.
So this equation here would just simplify down to the original one we saw, this. Or we could, if we could have 6 pairs, blue and then orange, but public then private, and it would simplify down to just this again.
Yeah. As long as they match, and as long as they're paired, then you're going to get the same message out ad infinitum.
So why are we showing you this?
Because you can switch the order. If you take the message, raise it to the private key, mod n, and then to the public key, mod n, you still get the message out. This process, the fact that you can switch the two, actually has a really interesting application in terms of cryptography. And that's what Bitcoin is going to use, hint, hint, and we're going to explain that in the next video. But side by side, what we just want to demonstrate here is that the order in which you apply these, as long as they are paired, is going to still give you the same message output.
Yeah.
That relationship between private and public key applies regardless of the order that you apply them in.
Yeah, and it seems weird, right? Because if you have a public and a private key, you should be the only person who knows the private key, and we've been talking about you use that to decrypt a message that someone sends you. Why would you ever want to encrypt a message with your private key and then send it out so that everybody could decrypt it with a public key? What use is there for that? That's what we're going to cover in the next video. We just want to demonstrate right now that mathematically it works just fine. It's totally possible.
So what we're about to cover in the next video is called a digital signature, the idea of signing with your private and then letting people verify that with your public key.
All right, welcome back. So in the last video, we talked about how we could use a private key to encrypt something, and then anybody with a public key could decrypt it. But that makes no sense as far as like sending a secret message. Why would you want to send a secret message then that everybody could decrypt? It's not really a secret anymore. So what's the use case of doing this? What's the utility?
So it has to do with proving identity. And this is our clip art representation of something called a private key sign, something often called a digital signature. And this is the digital equivalent of signing a document. In the same way that when you sign a check, the thinking is that only you could produce your handwritten signature.
Which very faulty logic. It's so easy to just copy a signature. That's not the case with digital signatures.
Digital signatures are much, much, much more secure than a handwritten signature. So the thinking here is that when you create a key pair, only the owner of the key pair, somebody who possesses knowledge of the private key, could create a valid digital signature. And when we say valid digital signature, we just mean that when it's checked against the public key, that it reports it back as correct.
First, let's just prove the math that it still works going this direction. So we had the opposite of this slide. Our key pair we've been working with, a very simple one, 23 and 7. So if we used 7, like we did a couple videos ago, to encrypt, and then we could use 23 to decrypt, it worked. We can go the other direction though, and remember the math. Let's say our message is the number 16, a very simple message. If I take 16 and I raise it to the 23rd power, mod 55. So I'm using Wolfram Alpha just to make this a little easier. So 16 to the 23rd gives us this massive number. And then I'm going to just mod 55, was it?
Yep. So your output is 26, and that is Colt's digital signature. Now what we're going to do is we're going to verify that 26 against the public key by raising 26.
And what was the public key?
It was 7.
All right, so we do 26
to the 7th
power. To the 7th power, and we can do this all at once too, but that's the number. And then we do
mod 55. And our output should be 16. 16 there, the original.
Okay, so the math works going the other direction.
Yeah, and it looks the same way that encrypt does, where encrypt, you raise it to the public key, and then you mod M, you raise it to the private key, mod M, and then you get the original value back. So now how would this be useful? How would someone use this in a digital context? Well, digital signatures are used to create a signature of an important document that one needs to demonstrate they actually created. The thinking is, if I actually sign a contract in real life, my signature is proof, or is proof enough that I was present and I gave my permission. I signed the document.
Yeah, I like to think of it as the private key is what gives you power in either direction. So if you're talking about encrypting something, and we're talking about communicating across enemy lines, anybody can send me a message with the private or with the public key. I'm the only person who can decrypt it. But going the other way, the power that I have is that I'm the only person who can encrypt something with my private key, such that the public key will actually make sense of it, that people can prove that it was me. So it's not about securing a message or hiding anything. It's purely about saying that I'm who I say I am. I have the private key. That's literally all it means. It's just about proving identity. So if I wanted to send Kevin this document, a really important document,
important.pdf,
and I want to make sure that when he gets it, he knows it was from me, or at least from my computer.
Yeah, I don't want Colt's evil twin brother to create a second copy of important.pdf with different details and somehow different content. I don't want to mistake that for the real thing. I want Colt's proof that he was the one who created it.
Yep. So I have a key pair that I've generated, a much, much longer one compared to 23 and 7, but the same relationship, really large key pair. And I use my private key, and I tell everybody else the public key, and I say, hey, you can use this public key to prove that I sent something to you. But first, I sign it with my private key, which is it's the same as encrypting. We raise it up to the power. We'll talk about exactly what we do, but just for now, we take this document and we sign it with my private key. I'm the only one who has it, and that generates this signature, which apparently my signature is Picasso's signature.
It looks just like Picasso's signature.
So then Kevin gets that document and he gets the signature, because remember, we're not trying to hide the document. This is all out in the open.
You would send your document in plain text alongside it. This isn't about hiding it.
No, it's just about proving that it was from me. So then Kevin takes that signature and he has that public key that I sent out to everybody, or maybe not everybody, but he has it along with anybody who needs it. So he can use the public key to then verify that I am the one who actually encrypted this, who used my private key.
Now, suppose that Colt's evil twin brother has a signature that looks a lot more like John Hancock's. If he were to sign an evil copy of the document, and I were to use that signature and plug it in to Colt's public key, then the output would be, it would reject. It would be an invalid, it would come up as an invalid signature.
Yeah, it wouldn't match. Just like the other direction. If we have a mismatch between a private and public key that aren't a valid pair, if Kevin encrypted a message with a public key, but then someone tries to use the wrong private key, they're not going to be able to make any sense of it. It's not going to work. Going the other direction is the same thing. It's the same relationship. It's just a different application.
So it really comes down to, I look up Colt's public key to determine, and then I plug in his signature to determine if he really created the document. And that's another way of saying, I look up his public key, plug in the signature to determine whether or not Colt had the secret key.
And if you miss that, it's a really small change. Just this little text here.
Yeah, and we're calling it secret key, private key, synonymous. Now, a minor detail for implementation's sake. This isn't really important to the end user, but if you're curious, when you're actually signing a document, you're not going to actually raise an entire PDF to an exponent. A PDF, if you were to think of it as a sequence of bits and bytes, that's a massive number. And then if you want to raise that to another massive number, it's going to be prohibitively slow. Instead of Colt actually signing the entire document, what he instead signs is he signs a fingerprint of the document. And the thinking is that if his evil twin were to also be trying to interfere with this, the evil twin would, one, not be able to generate a document that had the same fingerprint, and two, would not be able to digitally sign it. So both of those steps would be too difficult for somebody to spoof.
So the math ends up looking like this, where we have the fingerprint that we're signing, and then we're taking that result, and then we're using the public key to check or to verify that we get the fingerprint back. Now, in review, here are the two ways that you can use a public-private key pair. On top is encryption, which we covered in the previous videos, where you take a message, you raise it to the public key, or you somehow use a public key to encrypt it, and then you use the private key to decrypt it. With a signature, what you instead do is you use the original message, you sign it with the private key, which produces a signature, and then you send the signature alongside the message to your destination, and the destination, the recipient, will then use the public key to verify the output. And more accurately, what you're doing is you're actually fingerprinting it and then sending it. Here's the same thing with somebody who doesn't have the private key, my evil twin, allegedly. So they would try and sign it with some private key that doesn't match the public key that everyone has. Because remember, it all hinges on the fact that I, ahead of time, say, hey, this is my public key, everybody, this is how you know it's me. So Kevin is going to use this public key, and it's expecting the exact corresponding private key to be what signed the document. So if it's some random other private key, whether it's totally random or just a wrong private key, the signature is totally different, and so my public key won't work. And then Kevin knows that somebody did something along the way, or that this didn't come from me.
Yeah, so I would just trust the first document, the top document.
And then remember, it's fingerprints that we're actually signing rather than the entire document.
And note that the actual fingerprints that are ultimately signed, if Colt's evil twin has a different document, it will have a different fingerprint. So not only is the private key different for Colt's evil twin, the fingerprint that Colt's evil twin would be using would be totally different.
Mm-hmm. So in summary, the question that we're trying to answer here by going the other direction, using the private key first and then the public key, is to check if the generator of the key pair, the owner, the person who has the private key, did they create this file or this message? And the way we do that is just by using the public key to verify.
Now you might notice a similarity between fingerprints like SHA-256 and Ketchak and digital signatures. Now, both of them do accomplish one thing in the same way. They prove that a document has not been altered. You can use a digital signature in the same way that you use SHA-256. But digital signatures are, one, slower, and two, have an added benefit. And digital signature doesn't just demonstrate that something hasn't been tampered with. It also demonstrates that it was created by the same person that owns a public key, or that created a public key. So it's not just integrity, it's authenticity.
Okay, welcome back. So now we get to the big moment of putting together Bitcoin and public key cryptography. We talked about encrypting things, the top part here, which Bitcoin doesn't actually do. But then we talked about is it the inverse? The opposite?
The opposite? Yeah, I think the opposite.
We talked about the opposite way, where you can use a private key to sign something to prove that it was you signing it, and someone uses the corresponding public key to verify that. Same keys, just different order. So this is what relates to Bitcoin, and that's what we're going to talk about in this video, is how it relates. When are things signed? When do you use a private key to sign something? Before we go any further, let's revisit Billy, Kilgore, and Montana. These are our 3 hypothetical people in our super small network. We're just going to work with transactions between the 3 of them. So each one, we've color-coded them. They each have an address, which, remember, the address is based off of the public key. They're not quite the same thing.
So technically, these addresses are the SHA hashes of public keys. You don't really need to know that, but for the detail-oriented, we just wanted to clear that up.
Okay, so everyone has an address and the corresponding private key. Okay.
So we show here that Montana receives Bitcoin at her public key, at her address. And now here's the big leap we're going to take. And this is that Montana can unlock the Bitcoin that she has received at her public key, at her address, with the corresponding private key. Now, what does that look like? So Montana will take the address, and in order to move Bitcoin from that address, she will produce a signature using that address's private key. Now remember that the address is public information. It's a public key. And Montana's private key, generated at the same time alongside the address, has been kept hidden all along. When Montana wants to spend the Bitcoin associated with her public key, she will prove to the network that she is the real owner of that public key by creating a signature that only she can create.
Right. Well, otherwise, anybody could see that, oh, this address, whoever owns it, has 10 Bitcoin in it. Why don't I just make a transaction from that address to myself, for example, or to some person I owe money to? The only thing standing in the way of that is that Montana has to produce the valid signature, has to basically use the private key that she's been keeping secret this whole time, or her wallet app has been holding on to prove that she actually owns it. Otherwise, in this transparent system where everyone can see all the balances of any address, anyone could just spend stuff all over the place.
Yeah, Colt could not generate a valid signature based on that address. He can only generate signatures based on addresses that he has generated.
Yes, unless maybe I could kidnap Montana and torture her, and then force her to show me her phone. And then I could go into her phone and find the private key.
So yeah, under duress, people can steal your keys, but in general, the math, it's bulletproof.
Yes. Also, I don't believe
people
in
are
torture.
Fallible, and yeah, we don't condone torture for keys.
Okay.
So in terms of our analogy, we need to update you. We have left out, and for simplicity's sake, we didn't include what was inside of this clip art envelope. Inside of this envelope, this Dropbox where we have stored Bitcoin, where did that Bitcoin come from? Well, that Bitcoin came from another address. And how did it move from the other address to this envelope? How did it move into the Dropbox? So the owner created a signature using the private key corresponding to that address, which told the Bitcoin network, or showed the Bitcoin network, hey, I have permission to move this Bitcoin.
Okay, so let's walk through a little bit of an example.
So here we start with Billy, and we're not going to talk about how he got this Bitcoin, but pretend he has it in an address. He owns the address. He owns the private key.
Well, let's say he mined it.
He mined it. That's perfect. Yeah.
So there is no from address. So this is his address, Billy's address that has 3 Bitcoin. And what he's going to do is send all 3 Bitcoin to Kilgore.
Yeah. So Billy is going to generate a signature using the private key corresponding to that public key.
Yeah, so if we actually step back here, at this point, Billy has the address, which is based off the public key, and he has the private key. He's keeping the private key private, but he has it at this point. Then here, when he goes to spend it, when he goes to send it to Kilgore, he basically shows proof to the network that he has the private key. He doesn't
in his possession.
Yeah, he doesn't disclose the private key. He doesn't say this is the private key. He signs it signs a transaction with the private key, just like we talked about how you could sign a file to prove that you were the creator of that file. You have the private key, someone with the public key can verify it. Same thing, Billy can sign the transaction and say, here's the result of me signing it. You can check my work and see that it's actually me.
And how do they check his work? Well, they see his public key. They see his address. So the network has both pieces of information in order to verify that it was really him. So for the detail-oriented, what Billy is actually doing, because the public key is not exactly the address, what he does when he presents his digital signature, he also presents the real public key corresponding to the address. So that right there is enough information for the miners to verify, hey, this is the real public key, and this is a real digital signature generated based on the address from which Billy is sending this Bitcoin.
Okay, so it's a lot of detail. All that really matters, Billy has a private key. He uses that to sign the transaction and prove that it's his money to spend, his address that he owns. So on this slide, we're showing that Kilgore, which is the pink here, now has ownership over those 3 Bitcoin that were sent from Billy. Now, Kilgore's wallet app generated some private key corresponding to this address. So whenever Kilgore wants to spend that, he has to produce the private key and sign. So he doesn't show everyone the private key, but he uses it to sign the transaction to prove that he owns it. And he also presents the public key to show, hey, check my work with this public key. The only way that this would work is if I signed it with the corresponding private key, check my work.
So let's step back into the real world and talk about checks and how this would relate to actually writing a handwritten check. So here is my artistic rendition in Keynote of a check. From Billy Pilgrim to Kilgore Trout for $152. And what information is here? At the top left is Billy Pilgrim's name, and this is because the check was issued by his bank. It's it's his letterhead. The destination in the to field is Kilgore Trout. So that's for the bank to see, okay, this check, this amount is destined from Billy Pilgrim to Kilgore. And then the last most important piece of information is that Billy Pilgrim has sanctioned the check by signing it. And the thinking is only Billy Pilgrim can actually handwrite his signature. Yeah. Maybe someone could forge it, but if you looked close after the fact, if Billy were to contest it, they would be able to see that this wasn't the real signature.
Yeah, and this analogy doesn't hold up that well when you consider that it's not that hard to forge a signature, honestly, in the real world. But imagine the idea of signatures. It's the same idea. It's supposed to prove your identity. The thought process behind having you sign a check is that only you could sign that check. Only you can write your signature. So you can see here that this is what Kevin's talking about. The signature that Billy creates is based off of, or it includes the address, his address that he's sending from, the to address, Kilgore's address, the amount that he's sending, then he signs that whole thing with the private key, which again, the only way he could do that is if he had the correct private key. He produces the public key so people can check his work. Miners can verify that it's correct.
And this is why Bitcoin is valuable, is because people are confident that you cannot forge a signature, you cannot hack the system. And when you own Bitcoin, it can't be stolen.
Well, and when you own Bitcoin, what do you actually own, Kevin?
You don't own anything physical, you just own the private keys associated with addresses that contain unspent Bitcoin.
Right. So returning to this diagram, Billy sent Kilgore 3 Bitcoin. So now let's say that Kilgore wants to send those 3 Bitcoin on to Montana, which is the greenish color here. So it's the same idea. Kilgore has to then provide a signature that takes the address that contains 3 Bitcoin, the address that he is sending the Bitcoin to, along with the amount that he's sending, and he signs all of that to prove that he owns it. And then Montana takes ownership of that. Montana's address has a corresponding private key that she keeps. And this is a chain that could keep going on as long as somebody keeps trying to spend the Bitcoin.
So returning to our analogy, envelopes, drop boxes, this pink Dropbox above Kilgore's address corresponds to the entire transaction of Billy's address, Billy's signature, and then Kilgore's address. And then the next one, this teal, cyan one, is Kilgore's address, Kilgore's signature, and Montana's address.
Yeah, so these are the things that would be added to the blockchain, in the transactions. So this is a single transaction where on the blockchain we can see here's the from address, here's the to address, and we can also see the signature that was provided to prove ownership of the original Bitcoin in this address. Same thing here, from, to, and the signature. So just to illustrate what we're talking about, if we take a look back on the Blockchain Explorer, or one of the various apps to look at the blockchain, we're looking at I'm not even going to read it, some block number, bunch of transactions. If we look at each individual transaction, we can see the addresses, but above it, you can actually see this hash of the transaction.
And that's just a unique identifier of the transaction.
So if we click on this, it takes us to a page where we can actually see more information. And the things that we care about, other than the input address and the originator, the from address and the to address and the amount, you scroll down, there's this thing here. It's called the script sig. We're not really going to go into too much detail, but this right here,
that's a signature?
This is a signature that whoever owned this address had to provide the private key to generate. They had to say, all right, here's the result of me signing the transaction. Here's the signature. And in order for you to check that, because they could just say that that's the signature, but in order for it to make sense, they also have to provide the public key, which is right here.
Yeah, so that public key, we talked about how the address is actually the hash of a public key, and we use them synonymously. That's the real public key right there.
Yeah, so I know it's confusing, but this is just if you want to take a look. This data is here. You do have to click on the actual transaction to view it. It's not just on the regular block page that lists all transactions. But again, to spend this, the person who had this address had to use their private key to sign the transaction. That's what we see here. And here's a public key they provide as evidence, as a way to check their work. So the last thing that we'll do here is show you that there's this chain of Bitcoin that goes back to, we don't know how many addresses. I mean, technically, this could be the place where this Bitcoin originated, but most likely, if we click on this address,
it came from somewhere.
It came from somewhere else. So if we scroll down, we can see on this address, so this is the outgoing, right?
That's the transaction we were just looking at on top.
And then here is where it came from, right?
Yeah. Click that guy. And now we're back at the address that it came from. Scroll down.
We can do the same thing.
And we can keep going back in time, back and back and back. So what's that look like? Well, we made a slide.
Yeah.
This is a rough diagram of what the blockchain looks like, or what the sequence of transactions look like. It's just the transfer of ownership of Bitcoin from address to address.
Yeah.
And that has some implications in terms of the anonymity and privacy of Bitcoin. Remember that everything on the blockchain is completely public. You can keep the ownership of your address private, and we'll talk about anonymity in a later section. And that means that if we take any individual transaction, for example, this blue one, we can see the sequence of addresses that it came from.
So to wrap all of that up, in each one of these transactions, the person who owned an address had to provide the corresponding private key, keep it secret still, but sign the transaction to prove that they owned it, and also provide the public key so other people could verify that. And then that happened again here. So this person could send the Bitcoin to this person. And if this person in the blue envelope wants to send it on to someone else, they would have to sign the transaction themselves to prove that they own it. All right, welcome back. So one thing that we've kind of skimmed over is the fact that not all transactions are one-to-one, meaning one address in the from column to one address in the to column. In fact, most aren't, and we'll talk about why in this video. So you probably have noticed this if you've watched any of the videos where we're looking at the blockchain. If we scroll down on just any given block, there are many transactions that are one address going to two addresses. Or here's one that is, five addresses to two, 1 to 2, 1 to 3, looks like. So it's not always one-to-one. In fact, one-to-one is really not that common. But all that we want to show in this case is that there's all different sizes, all different flavors of transactions, whether it's 1 or 5 or 10 addresses on the
50.
from side or on the to side.
So here we have the simplest transaction, and that's just moving Bitcoin from one place to another. And suppose the source address has 2, the destination has 2.
So we're not losing any Bitcoin, or we're not having any leftover Bitcoin.
Nope. This is a pretty simple transaction.
Okay.
So the next scenario would be, suppose you need to send 5 Bitcoin to somebody, but you have multiple addresses and none of them have 5 Bitcoin. You don't have enough. So what you actually do is you assemble a list of addresses that contain as a sum enough to send the amount that you want to send to your destination.
For example, here on the blockchain, we just found one. In this case, it's actually 3 inputs, but all of them, if you look, they're tiny amounts. and there's only one output. So these three were added together to meet this, whatever this is, what, 0.04925 Bitcoin,
Yeah.
which are sent to this address.
Now, the use there is that you don't need to have exactly the right change to send to somebody.
So most likely this is someone who is, it's really unlikely that they would be paying for something and they just happen to have the exact amount of these tiny little pieces of Bitcoin. They probably were just combining a bunch of small amounts together to have one address that had a little bit more.
So as we alluded while we were looking at the Block Explorer, what about the word change? What about when you need a refund, when you want just part of an address to be sent to somebody? So suppose we have 5 Bitcoin and we want to send 3 to someone else. There's no way to cut an address in half. You can't just send part of the Bitcoin in an address to somebody. Once you use the Bitcoin in an address, it's permanently gone. So an unspent transaction output, which is really what we're talking about here, the Bitcoin in an address, once it's used in a transaction, it's gone. So in order to get change, if we wanted to send 3 to our destination, we would need 2 back. And how would we do that? We wouldn't actually keep 2 in the source address. What we end up doing, what our wallet app will do for us, is we create a new address.
Yeah. So there's the first address that we're sending the 3 Bitcoin to, and then the leftover we send to a new address that's created for us with a new private key that corresponds to it. And so we still have possession over this. We don't have possession over this. Hence the little shiny part there.
Oh, I love these effects.
Okay. So if we hunt around on here, I'm sure we can find, here we go. Here's an example. So this address had 101.38869 Bitcoin in it.
We see 2 output addresses here. One of them has 0.05 Bitcoin and one of them has 101 Bitcoin, that's $1 million. What's important to note here is that we don't know which one is change for the sender and we don't know which one is actually pointed at the destination. It's hard to say. Do you think they were sending 0.05 to somebody and they kept 101 in change? Or do you think they were sending 101 and they just needed 0.05 in change? Because these addresses are anonymous, we don't know. But what is indicated here, what's interesting about this Block Explorer is it shows whether or not the Bitcoin associated with that address is spent. So the bottom one, the 101 Bitcoin, the $1 million or so that just moved, has already been moved somewhere else. The top half, the 0.05, hasn't been spent. It's still sitting in the address, starting at 154YEJ. And then the bottom half, the 101, has already been moved. And it actually looks right below it like it's moved immediately. So the transaction right below, 17AGW, or is that 2 V's, is moved to a new place. And then they have 0.11 unspent and 101 spent.
Right. But remember, when it says spent, it doesn't mean that because the way addresses work, it could be tiny, tiny fractions of a Bitcoin being moved, but that address is considered done. So spent doesn't mean somebody sent $1 million in a transaction. It means that somebody sent any number and then the leftover was sent to another address, like we've been talking about. So it is confusing. Technically, I guess it does mean that it's spent. It is moved around, but it's just spent to another address that you still own.
Yeah, so those addresses are empty now.
All right, welcome back. So this section is a pretty big change. We've been focusing all of our time and all the videos basically around Bitcoin or teaching things that are necessary to understand parts of Bitcoin. It's all been about the blockchain and Bitcoin, and we haven't really ventured into any other cryptocurrencies, of which there are many at this point. And how many? Actually, we don't have an exact count, but there's thousands. Yeah. Probably not tens of thousands, but probably 2,000 to 3,000.
I think a few thousand now.
Yeah. So there's a bunch of them out there. New ones pop up every day, or maybe not every single day, but they pop up all the time.
I think every day there's at least one new one. Yeah.
All right. So there's a ton of them, and they we're not going to go into them because there's not time to do that. And our course would go out of date really quickly because new ones pop up. And also, a lot of them just aren't worth our time because there's nothing really to teach. That most of these, or I shouldn't say most, but a lot of these other cryptocurrencies that are out there are basically Bitcoin with a fancy marketing plan or a new logo and a different name, or they're geared towards a specific audience like horse lovers or something like that.
There's garlic coin for people who like garlic bread. There's Doge coin for, I don't know, people who like Shiba Inus.
But there's also a subset of these other cryptocurrencies that actually do some things that are innovative, or they build on top of Bitcoin, or they're not just, at the very least, they're not straight copies of Bitcoin. They introduce changes, whether it's to the way the blockchain works or how long a block takes. or the number of blocks or the number of transactions in a block. Or some of them, like Ethereum, actually add in some totally different functionality that isn't present in Bitcoin. So that was a very roundabout way of saying that we're now going to talk about
Ethereum.
So you probably heard about Ethereum. If you've heard about any of the cryptocurrencies other than Bitcoin, of which there are many, as we've mentioned, here are some of the most popular in today's world. And when we say popular, a good metric of that, it's hard to measure buzz or something. I guess we could look at like Google Trends or something.
Twitter.
But what we're talking about is market cap of these cryptocurrencies.
Yeah, so that's the number of outstanding units of a currency multiplied by the exchange rate in dollars or whatever your currency is. So basically the size of a cryptocurrency's economy.
And what Bitcoin, most recently, when we did this calculation, what was it, Kevin?
I think Bitcoin's about $150 billion as of April 2018, and Ethereum, I think, is about 70.
Yeah, so it's between a third and a half, right?
Yeah.
So Ethereum has the largest market cap of any of the other cryptocurrencies, as we record this at least. So it's still not close to equaling the market cap or the size of the economy of Bitcoin, but it is the furthest along compared to all the other cryptocurrencies. So really quick, we're not going to go over any of these other ones on this page, on this slide, but we just wanted to highlight some of the larger ones. And these are ones that aren't just reskinning Bitcoin. It's not just Bitcoin with a fancy logo or a new color scheme. These add some sort of innovation or at least alterations to Bitcoin.
Yeah.
So what do we have here? This is Monero.
So not endorsing them, but top left,
Yes.
Monero. This is a privacy-oriented cryptocurrency.
We got Zcash.
Zcash, also privacy-oriented, allows you to more privately, more anonymously send coins from address to address.
Litecoin.
Litecoin, which is like a faster version of Bitcoin.
Yep. And then Bitcoin. Then these three over here, I feel like you can figure these out if you knew roughly what you're looking for. This is clear. There's an M, an L, a B, a Z. Then over here we enter into just random symbols. So this is Ethereum.
So I think that's called a tetrahedron. That is the Ethereum logo.
Well, wait, I think that's two tetrahedrons, isn't it? A tetrahedron is just a four-sided object. Whatever shape this is the Ethereum logo. Up here we have, which one is this?
Cardano, which is similar to Ethereum. It's smart contract based.
What is this what is this showing?
I don't know. It looks like
a sand dollar.
It does look like a sand dollar.
Acne. Yeah. Or like a sand dollar. It looks like you're looking through the bottom of a colander.
Looks like a spark.
Okay. Whatever this is Cardano.
And then the bottom one, fidget spinner, which is the Ripple.
God, I was going to say that. It looks like a fidget spinner. Kevin's stealing my jokes. So this is Ripple. Yeah, these currently are probably the most well-known out of all of them. And definitely by far, Bitcoin is the most popular. And then not right behind it, but behind it in second place is Ethereum. So we are going to talk about Ethereum in this section. Again, not just because people like it or because it's popular or because it's worth a lot of money. We're going to talk about it because it actually adds some sort of innovation on top of Bitcoin, something that's pretty different and it's pretty radical. It's not just a faster time for a block or
a new name
or fancier technology for the addresses. It's actually very different. So that's what we're going to talk about. We've kind of talked it up, so in the next video, we're now going to introduce Ethereum. Hey, welcome back. So in the last video, we said that Ethereum is one of many cryptocurrencies. It happens to be worth a lot more money than most of the other cryptos out there. And we also mentioned that it innovates. It added something in that Bitcoin didn't have. Well, there's a couple things that it does differently. Let's just start by just giving a broad overview of what it is, though.
So, in a sentence, Ethereum is a decentralized payment network, similar to Bitcoin.
Okay, that sounds just like Bitcoin. Decentralized payment network seems pretty bland to me, Kevin.
Not bland, but the same as Bitcoin, nothing new. But Ethereum allows users to write code that runs on the blockchain. So, Ethereum's blockchain is not just for commodities, not just for transactions. It also allows users of the network to run and write applications.
Yeah, so this is a really weird idea to most people, myself included, when I first started hearing about it. I think actually a lot of people have invested in Ethereum and own it without really understanding what it is or how it works and what's happening behind the scenes. So it's not that you have to understand this if all you care about is just wanting to go buy Ethereum. But if you do understand it, I think it's a really cool thing that Ethereum does. I'm not an evangelist. I'm not trying to convince everyone that this is the way of the future or anything. But just from a technological perspective, it's kind of a weird and cool idea. So as Kevin already mentioned, basically the idea is that you run code on all these computers, all the different miners. Imagine Bitcoin, except instead of just mining the ledger and keeping track of the ledger, maintaining it, they are running code that anybody could write, applications. So we'll talk about what makes sense and what doesn't, as far as what you would run and why you would care about that in just a little bit.
Yeah, and at face value, if you're wondering why you would put code on a blockchain or how a blockchain would actually be used to run code, you're not alone. And
Yeah.
This is something that is quite confusing initially. So over the next few videos, we're going to do our best to explain in layperson's terms what is going on the Ethereum blockchain and why it's different than Bitcoin.
Right. But let's start just quickly by talking about the history of Ethereum, or Ether is what most people will say, because that extra syllable at the end is just too much work.
It's too much. It's two syllables extra, and nobody has time for that.
Oh, you're right. I can't count.
Ethereum was born out of someone named Vitalik Buterin's desire to add scripting to Bitcoin. So Vitalik Buterin was a contributor on the Bitcoin project, and he was interested in introducing really an application layer to the blockchain, to Bitcoin's blockchain. So that community is a little difficult to convince when it comes to making massive changes to the underlying architecture, sort of understandably. So he failed to get any traction, or failed to get enough traction to make a material change to Bitcoin. So what he instead did is he decided to make a new cryptocurrency. And that new cryptocurrency is called Ethereum.
And when was it? Around late 2013?
Yeah, that was in 2013, and they actually began development in early 2014.
So a quick note, Vitalik, the guy Kevin's been talking about, it's a little bit controversial, I think, in general, because
A lot of it controversial.
the way that he's gone about, basically everything is the opposite of how whoever created Bitcoin, Satoshi, or whoever, whatever team it was, they tried to stay under the radar, kind of be quiet, picked a pseudonym, as we've already discussed. Vitalik has put himself out there front and center, not only his name, but he does, like, I saw him on Vice News just a couple days ago doing like a media blitz, basically. He's very vocal, and yeah, he's a personality. So very different than the approach that the creator of Bitcoin took.
Yeah, he does interviews, he has a Twitter. It's very different. There is somebody at the helm of Ethereum, and that has its advantages, it has its disadvantages.
So next, what we're going to do is try and get to this idea of running code on the blockchain. But to do that, we're going to start by just talking about running code not on the blockchain.
So, Nintendo 64.
Many sweet memories.
Good memories. So, if you don't know what this thing is, this is a naked Nintendo 64. This is a video game console. And it looks like it came out in 1996. And it's a simple computer. Now, we're showing this because of this little black square on the left. And this black square is called a CPU. It's a central processing unit. And we're pointing at this because this is an analog, or this is really the main component that we're going to need to describe to move towards an explanation of Ethereum, because this is actually the piece of this circuit board that does computation, that can actually do something like 2 + 2. So when a Nintendo needs to calculate, for example, the velocity of Mario's jump, when you hit the A button, what actually moves that character from the ground upwards? Well, that's actually a CPU.
Well, that's actually acceleration, Kevin.
Well, I guess it's also acceleration. So how does the CPU determine the acceleration and the velocity of Mario? So that's actually this CPU, this brain in the computer, moving data around in memory.
Okay, so we've established CPU is important. Your computer has a CPU, whatever phone you have has a CPU. Great. Now we have to transition to a turtle.
My favorite, Simple Turtle. Colt doesn't like Simple Turtle. I, for one, think it's a great example to explain what's going on in a CPU.
Okay, well, I don't hate it. You're just going to have to bear with us for a second. And if you know how to program, this is... this might be a little bit slow.
Cover your eyes.
So the idea behind Simple Turtle, it's a really classic example when people are learning to code in Computer Science 101 or whatever intro to programming course. It's an educational tool, an exercise that allows you, the whole goal is that you have this little turtle, this avatar, and a course, an obstacle course or a world that you're trying to navigate, and you're trying to get the turtle to the food.
You got to get the turtle to the leaf.
So you have to give instructions to the turtle how to get there What we're trying to show here is that code is just a bunch of instructions, so simple little things. And I promise this will tie back to Ethereum in a bit. So Turtle starts out here, and we can tell it to move forward. We can't just say move to the food. We have to give it very specific instructions. Move forward how many spots? 4 spots.
So this is all happening on the CPU.
Then we tell it to turn right, and then we tell it to move forward 5 spots, and then we tell it to turn left, and so on. And this is obviously one of many ways of getting to the food, but the idea is that it's just a recipe of these short, stupid little lines. On their own, they don't really accomplish much. You put them together, you have an application, although that's a bit of a stretch to call this an app.
It's quite useless.
So as we've already mentioned, or as I did, skipped ahead a little bit, there's a CPU on pretty much any device these days. I mean, even smoke detectors, phones, laptops,
TVs,
gaming
radios,
consoles.
Everything.
All over the place. And these all, I mean, they vary in their capabilities, but they are all doing the calculations on whatever device they're in.
So the next model of computation, which is really the evolution forward from just using the CPU in a Nintendo 64, was called the cloud computing era.
Sure.
We'll call it an era.
Okay.
So a cloud computing refers to the act of using computation that is remote. So, for example, take Lyft.
Which, I guess Lyft isn't in every single country.
Lyft is just like Uber.
Okay. It's a ride-sharing application. I'm sure that most of our, 99% of students will know, but occasionally I make references, and then students will say, we don't have that in our country. And then I should be more sensitive to that. So I apologize. Lyft is a ride-sharing application. So what Kevin is trying to say is that your phone, when I go or whoever goes to request a Lyft, we don't have the entire Lyft application running on our phone. Every person, every ride that's currently going on, every driver that's nearby, every review and piece of feedback and all that stuff is taken care of on Lyft's servers. And there's probably many, many computers that are running at any given point, and they might even be across the world. But the idea is that your phone is just kind of connecting to them. You send a request, and all the hard computing happens on their computers, and then it sends you back an answer saying, all right, your driver is X, and he'll be here at this point.
And that's why that app only works when you have data.
So this is cool. This is sort of distributed, but remember that all these servers are owned by Lyft or Uber or whoever it is, whatever company we're talking about. They might have multiple computers, they might be running code all over the place, but they're in charge of all of it. And their entire server farm could go down, for example. A building, the power could go out, and then you can't use the application. Or a developer makes a mistake and pushes some bad piece of code, and it takes down the entire app. So what Ethereum does...
So Ethereum takes this concept of remote computing and extends it, applies it to the blockchain. So all these computers on the Bitcoin blockchain are really only being used for their memory. They do proof of work, they do some computation, but their value lies in the actual storage that they have. Ethereum extends this by using miners to not only store data, but to compute, to run applications.
So all of these thousands and thousands of Ethereum miners across the globe are not just keeping track of transactions, they are running code, and the code, it can be written by anyone. You can develop, there are courses on this website to teach you how to write entire applications that run on the Ethereum blockchain. But the idea is that all these computers run it at the same time. They're not running different pieces of it. They're not trying to break it down into small pieces. They all run the exact same code. So this isn't, a full application, doesn't really do much, but here's some code, and this is sort of authentic Ethereum code.
It's a little bit simplified, but that's what Solidity, one of the main programming languages on the Ethereum blockchain, looks like.
So regardless of if you know how to code or not, this is code, and it's run across, instead of 5 like we have here, thousands of computers all at the same time. So just like with the Bitcoin blockchain, if there's a transaction that people disagree about, miners disagree about, it doesn't really matter because the rest of the network doesn't care. The rest of the network agrees and moves on.
It's based on consensus, not any individual opinion.
Same idea with code. So if one of the miners goes offline, something happens, the power goes out, it doesn't matter because the rest of the network is running the same code and keeps going.
So now returning to this diagram of the Bitcoin blockchain, we have transactions pictured as envelopes. And what we want to draw attention to here is these envelopes, these transactions really just contain an amount of Bitcoin and a destination address. So Ethereum extends this by allowing transactions to also contain data. Now let's look at that in the context of Simple Turtle. Imagine Simple Turtle is running on the Ethereum network. What would it look like?
Well, so if this is what it looks like on a single computer, one CPU, here's what it would look like on 6. But instead of 6, we're talking about thousands of miners on the Ethereum network, all running this at the same time. Now, this might not, well, it doesn't make sense at all to actually run code like this.
We'll talk about why you would want to do this. Just know that it's run in parallel on the entire network. And if, for example, one of these machines were to disagree or have a glitch or someone were deliberately trying to interfere with it, that it doesn't really matter because 5 other ones are all determining where the actual turtle is, whether or not what orientation it has, whether or not it's eating.
Yeah. So, like, just to really be clear on this, this is not a good example of something you would actually want to do, but you could do this on the Ethereum blockchain. But we will spend a lot of time talking about worthwhile uses. And I think we should get this out of the way that some people are crazy about Ethereum and think that everything ever should be run as a distributed application
Dating
on the blockchain.
app. And calculator.
We definitely don't feel that way, and we're not trying to we're not trying to convince you that this is the future of every single thing ever. I think people get carried away. And also, I think a lot of people do that because the more they talk about it, the more people buy Ethereum, the more their Ethereum's worth. So keep that in mind too.
So beware the hype.
Yes. But it's cool. And there are use cases.
Just kidding. Hype.
No. Okay. So welcome back. We're talking about Ethereum. Now we're talking about something called smart contracts. So we talked about how the Ethereum blockchain allows you to write code and have code executed across the network, across all the different nodes of the Ethereum network. Now we're going to get into some basic terminology and actually talk about some situations where that would make sense. Because, spoiler, it doesn't make sense for you to have every bit of code you ever want to write. Every application in the history of the world should not be run synchronously across 10,000 computers. It just doesn't make sense. But first, let's define a smart contract. A smart contract is, put simply, is the code that you write that runs on the blockchain. But there's a little bit more to it. Why is it called smart contract?
So first, the definition of a contract. A contract is a voluntary agreement between 2 or more parties that is enforceable by law as a binding legal agreement. Now, in contrast, a smart contract is a contract, same definition, but it's enforced by computers. And you might be familiar with a smart contract or a type of smart contract already, and that would be a vending machine. So a vending machine has a simple contract, and that's if you put money into a vending machine and it's the right amount, the vending machine will give you something in return. It doesn't require an authority or a third party.
Yeah, there's no person there. There's no arbiter.
To actually enforce that agreement. But people tend to interact with them, and most of the time they work.
Yeah.
Ethereum doesn't really have a situation where your Fritos get caught and don't actually come out of the vending machine. However, there are some subtleties in which these contracts won't behave in the way that you want them to. We're going to discuss that.
So returning to a more Ethereum-specific definition. Ethereum smart contracts are just the applications, the code that runs on the blockchain. And as we've already alluded to, this doesn't make sense for every single application in the history of the world. For example, a dating site, there are dating apps actually that do run on Ethereum. But personally, I don't know. But we believe that it doesn't really make sense, and it's sort of just capitalizing on some hype, some trends. But there are things that Ethereum smart contracts are good at. They're resistant to downtime. They're resistant to censorship. So just like anything where you have a centralized authority, if you have one server, if it goes down, your application would go down with it. If you have one server and the group in charge of it wants to censor something, they can do it.
Yeah.
Now, the last two, fraud and interference, we have an asterisk next to fraud because Ethereum smart contracts, when we say fraud...
You can't defraud a contract. However, you can write contracts that are fraudulent.
Yeah,
that
you could write sketchy
people.
code.
Yeah, sketchy code that can trick people into doing things that they shouldn't do.
It's just like in the real world.
I've
heard of many stories of bad contracts or bad things that have happened when people sign their name. And they don't know what they're getting into. So to put that another way, code that runs on the Ethereum blockchain will run exactly as expected. So it's not Ethereum's problem if somebody doesn't know what they're getting into, if they don't understand the code, for example.
If somebody is deliberately deceitful in the writing of a contract, yes, you can trick people into participating and into interacting with malicious code that you've written. However, code that runs on the blockchain will run exactly as it has been written.
All right, so we've established the idea of a smart contract. It's just code that runs on the Ethereum network. And in general, it only makes sense if you care about downtime, you care about censorship or the lack of downtime, the lack of censorship. all that stuff. We'll talk about some examples again.
We'll talk about where that's good, and we'll talk
Yes.
about where that's not useful.
Yes, but again, we're taking a nuanced view. So not everything needs to run as a smart contract. So let's talk about something that would make sense.
A simple one.
So a simple example that we're going to talk about is something called a deed. So in the real world, what is a deed, Kevin?
So a deed is a representation of ownership of a property in this case. So if you were to buy the property at 123 Main Street, you would actually prove your ownership. You would actually be buying a deed to that property. And that's proving, hey, my name is on this deed. That means I am the owner of 123 Main Street.
And it's just a piece of paper.
Just a piece of paper.
Okay.
It's usually kept at the bank.
All right. So then what does making it a smart contract really do? What does that mean?
So suppose we didn't really trust our bank to hold on to that deed. What we could do is we could actually host that information, that piece of paper on the blockchain. And instead of having one copy at our bank, we could have the number of miners copies of the deed, which means every single miner in the Ethereum network would instead hold a copy of our deed. And what that allows us to do is that allows us to really make our deed resistant to, for example, destruction. Once it's on the Ethereum blockchain, it's very, very, very unlikely that it will ever be destroyed. It doesn't look like any time in the near future that the entire Ethereum network will be shut down. Now, that's our resistance to interruption that we were describing on the previous page. So how would we use this deed? Suppose we wanted to transfer. So remember, this deed is just a contract. It's a piece of code that lives on the blockchain, and all that it has is two pieces of data. One, the address, and two, the owner. So represented here as the cyan circle around it. Suppose I wanted to give, or I wanted to sell this property to this person who's pictured here as what? It's like a blood orange color.
Yeah, you can just say blue and orange, Kevin. We don't have to go with these elaborate color
I
descriptions.
like the Pantones. It's
It looks like
Tangerine
like
Tango or something.
tequila
Yeah.
sunrise off the coast of Cabo Orange.
Okay, we'll call it Cabo Sunset. So we've agreed that it's called the burnt street cone orange.
Okay, get on
person.
it. Get on it, Kevin.
So suppose I want to transfer this deed to the person on the right, pictured here as burnt street cone
Just
Cabo
orange.
Sunset orange.
The orange clip art.
Yeah, suppose if I want to transfer this deed, which in real life what I would do, I would go to the bank with that person and then I would sign my name and then we would transfer the deed to them. On the blockchain, what we would instead do is we would send a transaction to our contract. We'd send a transaction in the same way we sent a transaction to our Bitcoin miners. That transaction would say, I'm the owner of this deed, transfer it to this orange person. And that would mean that the deed would then update to that orange person. And the orange person would have their address. And from that point forward, they would be in control of that deed.
So when you say it updates, though, that means that it's updating across the network. Every miner is updating. Their computer is running code to update the value of the owner. What are we calling this? I guess we haven't said variable, but the place in memory that is storing the owner.
Yeah.
They're updating it across however many thousand miners there are at that moment to change from this owner to that owner.
Yeah. So in Bitcoin, we could only send Bitcoin. We could only send actual currency. Now in Ethereum, what we can do is we can send data. We can send a message to a contract and change data on the blockchain. That ledger is no longer limited to just holding, for example, the unit of Bitcoin. It can now hold information like the owner and the address for a deed.
Yeah. So the commands that are sent along are basically lines of code.
Yeah. Like Simple Turtle, it would be like you could send a turn left message.
Yes, or in this case, change owner message or update. Well, I guess that's it, just changing the owner.
It would just be change owner. And this contract would have been smart enough, would have been written in a way to only respond to an air quote change owner message if that change owner message is sent from the current owner. So for example, let's say I own it and then Colt just is trying to mess with me and steal 123 Main Street. He couldn't send a change owner message to that contract. The contract would just ignore him. Colt, steal my 123 Main Street. So in the next video, we're going to give another example of a smart contract that's a little bit more useful than this. Much more useful than old Simple Turtle and a little bit more useful than our deed.
Okay, see you then. All right, welcome back. So up until this point, we've talked about smart contracts, the fact that they're applications that run on the Ethereum blockchain, and we've been very upfront about the fact that in most cases, an application doesn't really benefit from running on the blockchain. And in many cases, it can actually just be a hindrance and not worth it. But there are some situations where it really does make sense. And so what we're going to do now is walk through one hypothetical situation, which has to do with voting or an election. So give us a little setup, Kevin.
So suppose we are trying to conduct an election in a country where we don't trust our government, and we want the election to be run fairly. We also are concerned about external actors interfering with our election. We're concerned about our government trying to suppress some voters. We just want to make sure that everybody has their fair vote and that the count is fairly conducted. That nobody can, for example, interact or interfere with, for example, a voting machine, which is very often a concern in modern elections.
Yeah. So as Kevin I think Kevin's idea is a little more far off, maybe a couple of years away.
It's going to take some infrastructure before we could do that.
But what we're going to talk about still could be relevant in today's world, even if we're just voting on something not as important as a governmental election. Let's say we're voting on a change that's going to be made to Ethereum, for example.
Yeah.
And everybody has their own opinion. People want to vote and be able to contribute, but we don't want people to be able to abuse it and vote 10 times. We're not just going to make like a dumb website where people can go just click over and over and over. We want to make sure people vote once and that's it. And votes aren't changed. People aren't manipulating or deleting votes.
Or suppressing votes, and that the votes are counted fairly. So what we would do is we would issue an address to everybody who is allowed to vote. Every voter would get their address, and that would give them the ability to interact with the blockchain. So in this case, we've pictured 9, all color-coded. And in this case, all we're doing is we're voting yes or no, thumbs up or thumbs down, on whether or not the incumbent president should be allowed another 10-year term in office.
Right.
No,
or whether our proposal is being added into
little...
Ethereum or whatever it is.
Yeah.
It's one yes or no vote. We're not allowing people to rank candidates. We're not allowing people to submit their own write-ins. Super simple in our case, although you could do all of that we described.
Yeah.
But in this case, just a yes or no.
Just yes or no. So we start the election by it's written into the contract. The election begins on this day, and then we start receiving votes. So the first one comes in. It's a thumbs up.
Okay, now stop, Kevin. When we have this here, what we're talking about here, we're showing this in one place, right? This looks like there's one centralized voting. I don't want to say ledger, but one voting
machine. Yeah.
Sure.
This is happening on every single computer in the Ethereum network. In the same way that when you send a Bitcoin transaction and it propagates across the network, this election is hosted on all the machines in the Ethereum network.
So when red votes yes here, thumbs up, all the computers are going to know about that very shortly. All the miners will know.
So what they actually do is they create a transaction and they destine it for the election. And all it is it doesn't have any Ethereum, any money associated with it. It just has a thumbs up associated with it. They send it to the nearest miner, and then that actual transaction propagates across the network. And then within 10 to 15 seconds or 10 to 20 seconds, which is the block time for Ethereum, that vote is presumably hashed into the current block or maybe the next block. You send the vote and you wait a little bit. So right now we have 1 vote. So we get our next votes, 2 no votes. So 2 people don't want the president. They've had it. They're sick of this president.
Okay.
So then we get 3 more votes. A thumbs up, a thumbs down, and a thumbs up. And these are all being tabulated on all the machines in the entire Ethereum network.
Right.
Every single machine has the contract running on it.
Yes, and if somebody were to hack into one of the machines, for example, it wouldn't really matter because this is consensus based. That's the idea here, that somebody could go and destroy 10 records even, or burn down an entire city.
1,000 of them, which I hope they wouldn't do, but it wouldn't affect this election. The goal here is that this election is unstoppable and that its results are untamperable with, and that we can be confident that everybody has their ability to participate in the election, that really no suppressor and no interfering entity could stop this election.
Unless there was some real crazy conspiracy where the entire network somehow was in on it, and maybe aliens took over, and reality isn't.
Can we say the I word?
The I word. Illuminati.
The Illuminati.
So at the end of the day, the miners could tabulate the results. We see that it's a yes. So in this case, Even though we didn't trust the government apparently enough,
No.
we had to have this Ethereum-backed election. Everybody still voted to keep the current president or dictator, or whatever we're talking about.
And the current president would be thrilled. Thumbs up. But everybody agreed beforehand, hey, we're going to trust the contracts. We're going to believe in the Ethereum's ability to keep a fair vote.
Just like people believe in Bitcoin's ability to keep a transaction safe. Same idea, except now we're talking about thumbs up or thumbs down, which is just a piece of data. All right, welcome back. So what we're going to do now is take a step back from smart contracts, from talking about code and how it runs on the Ether blockchain, and just talk about some of the other fundamental differences between Ether or Ethereum and Bitcoin, because there are a couple others that we've glossed over up until now. We've actually mentioned briefly, for example, it takes, 15 or so seconds for a block in Ethereum?
Between 10 and 20.
Okay, versus compared to Bitcoin, we're talking about roughly 10 minutes.
Yeah.
So that's one distinction already. We're going to talk about a couple of others. And these were done for reasons. So we'll talk about why. These are choices that the developers made as they were creating Ethereum. And they had the experience of looking at Bitcoin and how it worked and figuring out how to improve upon it, at least for what they wanted to do.
So let's start by talking about some of the limitations of Bitcoin. The first one we list here is transaction times.
Okay.
A lot of people are frustrated with the fact that you have to wait at least 10 minutes to clear one block on the Bitcoin blockchain. So if I'm buying coffee and I want to buy it with Bitcoin, ideally I don't want to have to stand at the register for 10 minutes, at least 10 minutes, for the current block to be confirmed. And more often, and for safety's sake, you want to wait a few blocks. You want to wait 20, 30, 40 minutes until your transaction has been hashed a few blocks in to the blockchain before you consider it complete.
So this slide here actually illustrates some of the key differences around transaction times and just transactions in general between Bitcoin and Ether. So when the developers of Ethereum were setting out to write the code to set up Ethereum, they decided that they needed to have a faster time per block. And the reason for that, the main one is that if the whole currency, the whole idea is based off of running code and having this code run across the entire network, you don't want to have these blocks take forever. Because you're not just working with transaction data about an amount of Bitcoin. If you're actually building a voting app, like we've talked about, you don't want it to take 10 minutes for the apps to talk to one another, to update, essentially.
Yeah, the intention is that these applications will grow much more complex and communicate with one another. You don't want to sit there for 6 hours while a message propagates across half a dozen applications to get you a result.
Yeah. So Bitcoin, roughly 10 minutes or 600 seconds per block. Ether, we're talking about 15, what did we say, 10 to 20?
Yeah, between 10 and 20.
And then one of the upsides of Bitcoin, though, is that less bandwidth is required because the miners are communicating with each other less often, every 10 minutes versus every 15 seconds.
So one of the problems with Ethereum being faster than Bitcoin, one of the advantages to Bitcoin, is that Bitcoin's blockchain splits less often. As we talked about in the mining chapter, when two miners find proof of work, they have to broadcast their answer to other miners. So there's a much shorter window to communicate in Ethereum and answer, and very often multiple miners will find separate yet both valid proofs of work against a similar timed block.
However, Ethereum has a built-in way to kind of handle that, right?
Yeah,
Ethereum takes a different approach where it's not winner take all. One person is not the only miner who gets paid for finding proof of work if many people find it, unlike Bitcoin, where one person is going to get the payout.
Yeah, in Ethereum it's called the uncle reward. You're rewarded even if your block is not included in the main chain.
All right, but we're going to get there. The last thing we should mention on this slide, the payout for Bitcoin, you find proof of work, it's 12.5 Bitcoin right now, although remember it started at, 50? And then halved, and it's halved again to 12.5. For Ethereum, it's 5 Ethereum per block. The blocks, like we've said, are mined much faster, 10 to 20 seconds. So the reward is lower. And that also makes it the shorter window, the 15 seconds per block, makes it more predictable for miners because you're not, investing all your hopes in getting this one shot per 10 minutes. You instead have every 15 seconds you get a new shot, roughly.
Yeah, things even out faster that way.
So the next thing we'll talk about, as far as a limitation with Bitcoin, a frustration that people had after seeing Bitcoin work for a couple of years.
Especially when it got popular.
Yes, was transaction fees. So what are we looking at here, Kevin?
So pictured here are the average transaction fees over time. I think, what's that? The way back. That is November of 2015, 16?
No, this is 17. I think
17.
this is just, I don't know what the scale for this is.
Looks like 6 months.
Okay. All right.
So in the past 6 months, we've seen many more spikes in the Bitcoin transaction fees.
Yeah, so Bitcoin is here in blue.
Yeah.
Hopefully this line shows up. And down at the bottom, you might not even notice it over here. This is the Ethereum transaction fees at the same time.
And because Bitcoin has a smaller block, Bitcoin has about 2,400, give or take, transactions per block, and it's only one block every 10 or so minutes, that means fewer transactions fit on the actual block. And what happens when the network is congested, and we covered this in the fees chapter, when the network is congested, that means people have to fight for a spot on the current block. And how do people fight for that spot? They bid higher. They say, I'm willing to pay a larger fee. So what was it? That was about Christmas time, right?
Yeah, $55.16 US dollars.
So if you wanted to be on the current block in December around Christmas time, even if you needed to send a millibitcoin, if you needed to send, I don't know, that was probably $20 at the time, you needed to include the transaction fee or a competitive transaction fee, give or take $55. For an average user, if you're trying to buy coffee with Bitcoin, or if you're even trying to buy anything with Bitcoin,
right,
paying $55 for any transaction is prohibitively expensive.
Yeah.
In Ethereum, it's much more stable.
Yeah, and you can see, so not only are the fees lower in Ethereum, they're also, it just doesn't fluctuate as much. There was, it looks like, it went up for a bit here, but still, relative to what we're talking about in Bitcoin, the difference is we're talking about $4 versus 50 cents compared to $55 down to like $1 in Bitcoin. Much, much larger fluctuation.
And remember, there's a lot of variance on fees. If you don't need your transaction to clear quickly, you can bid way lower and just wait till the network is less congested. But these are the averages we're showing here.
Okay, the next point that people have become frustrated with Bitcoin for has to do with how mining has evolved over time. And we've mentioned this already, that mining, when we first introduced it as a way that, yes, potentially you could earn Bitcoin, we were very clear that it's very difficult to do nowadays because it has become a very centralized, I guess not a monopoly, but a very centralized market where very few people or organizations that have a ton of money, they've concentrated all the mining power in the world into a couple of places, a couple of organizations. So we've mentioned this a little bit, but the reason that this happened, and it wasn't like this at the very beginning. Anybody could start mining. But what happened is that people started making what are called ASICs. What's that stand for, Kevin?
Application-specific integrated circuit.
Yes, so that's not a
Microchips
Bitcoin
on the
term.
left.
ASIC is, there are all sorts of ASICs out there for different purposes, for different applications. But there are chips that have been made specifically for mining Bitcoin. That's all they do. So you can see, actually, this is a picture of some of them.
And that's a fan on top of them because they run
get
really hot. So
Yes.
the problem with these things is they are an economy of scale. If you want to buy one of these, they're sort of expensive. They're not too expensive. It's just a microchip. But if you want to buy 10,000, it's going to be a lot cheaper than 10,000 times the price of one.
Yeah.
Now that favors people who are willing to put in a massive investment. And what has happened over time is a small group of people, relatively small, has the mining power has concentrated amongst this small group of people, which has basically created mining cartels, groups of people with disproportionately more power than the average user. Now in Ethereum, what they've done, one of the decisions they made is they decided to build the mining algorithm, their proof of work, in a means that is actually more difficult to program into an integrated circuit, into an ASIC.
Yeah, so they saw, at this point, when Ethereum was created, Bitcoin had already changed enough, for the mining landscape had changed enough that the developers saw what was happening, and they wanted to avoid it. They wanted to make something that was truly decentralized in all ways, meaning that anybody could mine at any point. You didn't need to spend $100,000 or $100 million building a warehouse in order to make money doing it. So what they did, as Kevin mentioned, is they found a way, a different algorithm, and a different place to run it on your computer, essentially, on the graphics card, which is something that every laptop these days has. But the difference is that graphics cards are an existing product, an existing economy that wasn't created like these Bitcoin ASICs to mine, that were created out of thin air just to do this. But, graphics cards have been around. They have their own market, right? Computer gamers, buy graphics cards, and they have for years.
And they're also very useful for artificial intelligence algorithms. So they'll continue to be useful in the future, which is of particular interest to people who care about the environment. Those chips on the left will be completely obsolete within a matter of years, whereas these graphics cards on the right will remain useful because they're general purpose computers.
So the last point that people view as a limitation of Bitcoin is that it's limited in scope. And this one stands out compared to the other three, which I think objectively we can look at and say that, yeah, there are longer transaction times, or fees are higher, or that the mining landscape has become centralized. Limited in scope, though, it set out to be a currency. It didn't set out to be anything else. And that doesn't make it that's not bad. It's
not inherently bad.
A negative thing.
Subjectively, once people started using it, people said, whoa, it would be awesome if we could actually add some intelligence into this distributed system.
So we've already mentioned this, but the developers of Ethereum set out with the idea of, instead of just simply creating a currency that's stored on the blockchain, what if we could actually run applications at the same time? Do something beneficial other than just storing transaction information, run code. And we've talked a little bit about it. We showed a couple examples. We're going to continue to do that. So if this is still a little fuzzy, don't worry. I know it's a really foreign idea. A lot of people who understand cryptocurrencies in the blockchain still struggle to really understand how Ethereum works. But the point is, as far as how it compares to Bitcoin, Ethereum just does something else. It's not just using all that time and energy and mining power to just store numbers. Well, actually it is. At the end of the day, that's what code sort of is doing anyway. But it's not just storing numbers that relate to the currency or to the transactions. It allows users to run code. Okay. So to wrap that up, you want to take it, Kevin?
So here's our side by side. Bitcoin and Ethereum. Bitcoin, the blocks take much longer. The miners use something called an ASIC in Bitcoin, whereas in Ethereum, you use something called a graphics card, which you might be familiar with.
Well, and we should clarify, that's not necessarily true that all miners use ASICs.
It's just the miners who are earning anything are using ASICs. Bitcoin addresses are owned by people, whereas Ethereum addresses can be owned by people or can exist as applications. And then Bitcoin was designed to be a commodity, whereas Ethereum was not only designed to be a commodity, it's also designed to be fuel. The actual currency is supposed to be fuel for applications that run on the blockchain.
Yeah. And so we'll revisit the last two especially. We haven't talked about how what it means, like fuel for applications, and how code actually is executed. We'll get into that in just a little bit. All right, welcome back. Now what we're going to do is talk about what happens in an Ethereum transaction in some real detail. We've kind of just said Ethereum can run code on the blockchain and there's also a currency involved. We're going to actually explain how it works and what's happening. So we've seen a slide like this one. I don't remember if it was exactly this one, but on the left, we've got Bitcoin. You send Bitcoin in a transaction to an address, and that's it.
In Ethereum, not only can you put Ethereum in a transaction, you can put a method call. You can put data into it.
Yeah, so this is code. If you're not familiar with what a method call means, something like move forward or, I don't know.
It's an instruction.
Transfer deed or vote yes or vote no or something. Whatever the code is, there are some instructions you could include.
And on top of that, there's another distinction. Not only what goes in the transaction, but where those transactions can be destined.
Okay.
So in Bitcoin, transactions can target a public key.
Well, it's not technically the public key, Kevin.
It's a hash of a public key, but basically a public key. You point a transaction at a public address, a destination that's owned by a person.
A human. Hence the yellow little clip art we have here representing a person.
I think it's like olive chartreuse.
Okay, Kevin, I'm going to kill you. So
Ethereum transactions can point at both externally owned accounts, which are the same thing as a public key in Bitcoin, or a contract, which is just an application, a smart contract that's hosted on the Ethereum blockchain.
Yeah, so this is the weird thing. You can send Ethereum to a person, I can say, hey, Kevin, I need you to send me X amount of Ethereum, please, just like you would with Bitcoin. Or we can have transactions that are sending code to contracts. So instead of sending an amount of Ethereum to Kevin's account, I could send a line of code to some address.
Like a vote yes or a vote no or a transfer deed. You can also send Ethereum to contracts. There are some contracts that associate with them a given amount of value.
Yeah, like crowdfunding.
Yeah, for crowdfunding, you would want to hold Ethereum in a contract. And in that case, you'd also send Ethereum to the contract.
Yeah. Okay. So reviewing the Bitcoin blockchain just looks like this roughly. Well, very simplified, but we've got the number of Bitcoin and then an address that you're sending it to in each transaction, as well as, I guess we're not picturing the from address, but anyway, This is what a transaction looks like on the right side of the equation, how much and where it's going to. Now returning to our simple turtle example, this is what we're working with, and we're trying to get this to run on the Ethereum blockchain, don't ask why, but if we wanted to, it might look something like this. Instead of the Bitcoin blockchain, we have this. So not just transactions containing Bitcoin being sent to an address, we have transactions on the Ethereum blockchain that contain Ether, like here, 3 Ethereum being sent to this, whatever this address is. But then we've also got turn right being sent to this address, or here we actually highlighted the green ones contain code.
Yeah, the green ones are simple turtle.
Yeah, and so this is a very silly, trivial example with turning right and move forward. But in place of these, it could be, like we've talked about, send vote, or transfer funds for crowdfunding, or what else?
Self-destruct, or
yes, sure. All sorts of commands or information. Like what would you send? What kind of information?
So some contracts very often need to know the exchange rate between Ethereum and another digital currency. So in some cases, you want to update your contract with an up-to-date exchange rate. To do that, you would create a transaction and then point it at your contract. And for example, you might call a method or and give it an instruction that says update current exchange rate, and then give it a little piece of data. That is the relative value of Ethereum to whatever you're describing.
So to wrap all of this up, Bitcoin, you send Bitcoin. That's it.
To people.
Ethereum, you send Ethereum to people, or you can also send it to applications, but you can also send things that aren't Ethereum. You can send data, commands, code, without any Ethereum involved, or at least part of the transaction. So in the next video, we're actually going to show you on basically the equivalent to the Bitcoin Blockchain Explorer, but for Ethereum. We'll prove to you can actually see transactions at one address to another address. You can see some have Ether, some don't, and some have code, and some don't. So that's coming up next. All right, welcome back. So what we're going to do now is talk about something called a DApp. What is a DApp, Kevin?
A distributed application.
Okay, so we've talked about the idea of Ethereum, the fact that you can write code that runs across the blockchain, distributed across the entire network. So what we'll do now is actually walk through some sort of slightly dumbed down code and actually show an implementation. So it's not going to be
dumbed down.
Okay, it's not going to be step by step how to create a DApp, a distributed application, but it's going to walk through the important parts, the idea of having code that runs across all these computers. We're going to show you some code, and we're going to walk through what happens, how code is included in transactions.
So yeah, just the basics.
Yes, but this is not supposed to be, introduction to coding in Solidity, or introduction to writing your first distributed application, your first contract, getting it up and running. This is really more about breaking down the basics, how it works. Also, you don't need to know how to code to watch this.
No. So pictured here is a contract, and applications on the Ethereum blockchain are called contracts. And this contract is written in approximately, a little bit simplified, but a language called Solidity. And Solidity is one of the primary programming languages on the blockchain.
Most contracts, well, a lot of contracts are very, very complicated. For example, you can implement a voting app, which it's still not that bad, but it's a lot more code than this. But this is the simplest possible thing we could think of. All that you do, we have a number that we're keeping track of. It's called stored data. And it's going to start at 0 for everybody. And then once it's up and running on the network, anybody can then say, I want to add 5 to stored data. I want to add 1. I want to add 50. I want to add any number. And if you care about the code, this isn't that important. You can call this thing it's called a function called add. And I don't want to confuse anyone, but you can pass in a new number. So you can say, I want to add in 5. I want to add in 10. I want to add in 20. And it will be added to the current total. So it starts at 0. Kevin says, add 5, and then it goes up to 5. And it will go up to 5 across the entire network. So it's not just on Kevin's copy. The entire network will update. So anyway, it's a really simple idea, but it's sort of the building block for something like a crowdfunding application where people are going to contribute money. For my Kickstarter on Ethereum, people will submit $10 and $50 and $1,000, and we're going to total it all up somewhere and keep track of that. But this is just the super dumbed down version with no real money involved.
So you might be wondering how people communicate with this contract. In the same way that people can send a transaction on the Bitcoin blockchain to another address, you can send Bitcoin to an address. You can communicate with contracts with transactions.
So as Kevin mentioned, you can write a contract code. This is our contract, just condensed, and it gets its own address. Just like here, we have a person who has an address, and these are super shortened addresses, but they're in reality much longer. But for example, the address 05, that's where we're going to send transactions to hit this contract if we want to increment or add to our variable, our piece of data. Or if I wanted to send money, Ethereum, to this green woman, I could send it to 08. Or here's a different contract we're not going to talk about at 09. So on the network, addresses can belong to a person, which we have a slide on this like a million times in the course. You're probably sick of it. Addresses can be a person or a contract code. So we're going to walk through our idea with Accumulate. You can see that fancy
I put a lot of
out.
effort into that.
Okay.
Yeah.
So here's our code again. And remember, at the very beginning, we set this up. We're not talking about how we set it up, how we initialize everything. It's up and running on the network. Everybody's computer, all miners, are running this, and stored data starts at 0. That's the default, as you can see here. We start stored data equals 0.
Yeah, and this little rectangle, stored data, that 0 is stored on every single miner's computer.
Yeah.
There might be some miners might disagree, and they might have randomly set it to another number, but remember, this is about consensus. Most of the network, in this case probably all of the network, has that little piece of memory that is for stored data, and it's a 0 right now. So let's see what happens when this contract starts receiving messages.
So the format of the messages, the only thing people can tell our code to do is to add something. So again, we haven't explained functions. If you don't know what they are, don't worry. Just know that if somebody sends a line of code that says add and then a number, we're going to take that number and add it to stored data across the entire network. So somebody sends basically a transaction to our address for the contract. So this isn't to a person, this is to a contract, our Accumulate contract, and the message, the data just says add 0. So that's actually, why did we start with that? It's kind of pointless.
That was pointless. They're playing a joke.
Okay, somebody else sends another transaction.
So they send this transaction, add 1 to number 5, which is where our contract lives in memory, and you'll see that stored data increments by 1.
Yes, and that's on all computers on the network, barring somebody being disconnected or someone disagreeing somehow. But in general, the consensus is that stored data is now 1.
So next one comes in, someone adds 1, and stored data, all the computers on the network, all the miners on the network see the add 1 and increment stored data to 2. Next one comes in, add 2, they increment to 4.
Right.
Next one comes in, they add 3, and they increment to 7.
So we should note that these could be coming from entirely different people. The way our contract is set up, it doesn't matter. You don't have to have permission to add. Anybody can send a transaction. So this could be one person, this another person, or they could all be the same person. It doesn't really matter. In reality, when you write a contract, you usually don't want just anybody to be able to manipulate your data and change things. And this is not a course on writing contracts and on solidity and the syntax. But if you did take a course, they would show you how to handle that and how to prevent that, how to basically add in authentication. So finally, we add 5. Oh no.
Oh,
last
one
one
more.
is 8.
8, surprise.
So our total has been updated to 20, and all computers on the network should have 20.
And we'll talk about why this is useful and why someone might want to do this. They're probably not going to do it with just stored data and one number. But what we're describing here is really the base example of running an application on a blockchain.
Yes. And it's kind of weird, but you send these transactions or these sort of transactions to an address, which is not a person. It's code or it's an application, and it's waiting to hear instructions. It's waiting to basically get a message about what to do next. And usually they're way more complicated, but the idea is the same. Fundamentally, someone, or it could be another contract talking to another contract, is sending code.
So right now this just exists on the blockchain, and it's sort of hard to interface with for the average person. So what a lot of contracts have is they have an interface. They have a front end on the actual, for example, on a web browser.
Okay. So up until this point, everything we've shown you is happening behind the scenes. You basically have to be a miner or you have to understand code in order to really know what's happening at any given point. And the same could be said of pretty much any application or any website that you use, except for the fact that most applications have some sort of interface, something that's pretty or easy to understand for humans that you can look at. So for example, Airbnb's front end, or any website. You go to a website, the data itself is ugly, it's stored in computers, it's hard to look at, but it's displayed in a nice way for humans to understand. So we could do the same thing with any Ethereum contract, which is what we're kind of showing here. We could have a website, And this website just provides a window into our data. So it's not going to allow you to manipulate things. You can't change anything. It's just showing you what's there. Just like when you go to, NewYorkTimes.com, you can see the latest news stories, but you're not making news stories or you're not changing them. You're just viewing them. Same idea here. So we can have a little website. And again, don't worry about the code. But if you look at this, we're sort of in JavaScript.
If you understand it.
We're writing code that says, I want to connect to the Ethereum contract with the address 0x or 05, which is not really what an address looks like in the real world, but it's short and it fits on the slide. And that matches what we see here, although I think we actually added an extra 0.
Pretend there's a 0 on the other slide.
So imagine though, what we're doing here is just saying, all right, connect to the contract at this address and let me have access so I can just look at what's going on there. And then we can display it. So we can see it starts at 0. And then if we waited a couple minutes, all these ads happened, all these transactions to our contract happened. If we refresh that web page, it would now display the up-to-date total. So not that useful, but imagine that you're building more complex applications. So we said building a dating site isn't really a great idea in our opinion, but the people who did build a dating site, they need some way for people to look at what's going on. They need an interface. So they have some sort of front end on, I assume, in the browser. Maybe it's an iPhone app or a computer app. I don't know. But there's some interface that is connecting to the blockchain.
And also, just a note, I have no idea what is at https accumulator.com. We don't condone anything that happens on that website. You probably don't want to visit it.
To summarize all of this, if that front end thing lost you, don't worry about that. The focus really is that we write code, whatever language we use. This one is sort of a bastardization of something called Solidity. I think bastardization isn't a bad word, is it?
Swear words.
Okay. It's a watered down version of Solidity, a simplified version. Doesn't matter, but we write code, and this contract has its own special address, 05. People can send transactions or sort of transactions containing instructions, pieces of data to that address. And that's pretty cool. Welcome back. What we're going to do now is take a look at the Ethereum blockchain. So the blockchain explorer that we've been using only works for Bitcoin. So this is a different one. It's called Etherscan, and it allows us to just look at the transactions. So here on the home page, you can see a list of recent transactions. And the first thing, and we can see the block that they're in. So all of these are in the same block, 5541409. Then we can see the from address and the to address. And you can see over here is the value, 1 ether, 0.995, 0, 1.0, blah, blah, blah. Let's start by just taking a look at one of these transactions, like this one right here, which is from this address to that address for 1 ether. If we look at it, we can see that what is there really to see? It was successful, the block that it's in, the from address, the to address, the value, about $669 at the time. We're going to talk about gas in a little bit. And then we can see this field, input data. There was nothing sent.
So 0x is code word for nothing.
So this tells us this is a transaction from one person to another person. Or I guess it doesn't have to be a person who's sending it, but it's a purely financial transaction. There's no data or code involved.
So those are called externally owned accounts. So basically all accounts in Bitcoin are externally owned because people make addresses. In the case of Ether, not all accounts are externally owned. Some of them are contracts.
Now for the cool part, if we look at some of these to addresses, there's a little logo or a symbol here, an icon, that signifies that this is a contract's address. And if we click on one, let's go with, some of them have names, some of them don't, and we can talk about why that happens later. But I'm going to click on this one. It's called CryptoKitties Core. So this CryptoKitties is an application. How would you even explain it, Kevin?
It's sort of like trading cards. It's like Pokemon on the Ethereum blockchain. And we could probably write an entire course on CryptoKitties. But in this case, just think of it as sort of a collectible item. Yeah. And the data in the contract refers to these cats. Felines.
Yeah, okay. So it doesn't really matter. All I wanted to show you is that if you see one of these little icons, this signifies it's a contract. And if we click on one, like the CryptoKitties Core, this is the contracts page that we're viewing. This is not the actual transaction. You can see up top, here's the address of the contract. You can see the creator who created it. But we can also, this is kind of cool, you can view the source code of this. So this is the contract itself. If you look here, contract ownable. And we're not going to look at the code, but this is interesting. You can actually see the code if you wanted to. This is the contract. So just like when in the last video we did the accumulator contract, this is a much more complex one. And the other cool thing, you can see all the transactions that have been sent to this contract. And not only that, but if we look at one of them, like let's just pick this first one, 17 seconds ago, you can see it was sent from this address to the CryptoKitties core contract address. There was some money involved, but there was also data sent. So if we look at this, breed with auto, this was the function that was called, which this is the whole point of CryptoKitties is that you're basically, you have kitties and you breed them together and you try and get rarer kitties, I think is how it works.
Yeah. So matron and sire, you breed a matron and a sire, and out comes a new CryptoKitty.
But that's not really the point of this video. So the cool thing is that you can literally see the code, the message that was sent here. And this is just one going to CryptoKitties. Again, if we go back, we can see, I mean, there's a lot of transactions. 14 seconds ago, another 14 seconds ago. Let's just look.
It's a lot of cat
So here's
breeding.
a different create sale auction. So this must be somebody selling.
Someone's auctioning a cat.
Yeah, someone's auctioning a kitty. So here's one. It's still a very small amount, but it's slightly larger. 0.018 Ether was sent. And if we take a look, what was sent is that the message, aside from the money, the $12, was bid on siring auction. So somehow, whatever the game is or
Someone
the app.
is bidding on the rights to mate that cat with their cat.
Yeah. So there's money involved, which is why there was Ether contained in the transaction, as well as the input or the data, the message to actually bid that amount. So now what we're looking at is
the CryptoKitties actual website. In the last video, we talked about how you could have a front end and an interface to your contract. And this is the interface to the CryptoKitties application. So those transactions we were looking at, the contract we were looking at just a moment ago, are sort of usable from this interface. So here's the marketplace, and this is where those functions are actually incepted. So we were looking at bids, and they can be created from this interface. And what this means is the average person can interact with the Ethereum blockchain without actually handcrafting those transactions.
Yeah, so if I had an account and I had, however this works, I've actually never used CryptoKitties, but I could go here and yeah, I'd sign in. And then once I signed in, I could submit a bid. And that would generate something like this, a transaction, whatever my bid amount was, bid on siring auction. Or something like that. I don't know exactly what generates this, but I would assume when you bid on a siring auction that this is the data that's sent.
Yeah.
So back to just the homepage of all the transactions. Really the point we want to make here is not to show you CryptoKitties even. That just happened to be one that was a contract that we looked at early on. But it's pretty awesome, in my opinion, that you can actually see how this all works. It's all, I mean, remember, that's the point of the blockchain. It's all out there. It's all public. So we can go and literally see the lines of code that are being sent back and forth. Well, not really back and forth. The lines of code that are being sent one way and then being executed by all the miners. And we can see just regular old transactions. For example, this one right here. Sent from this address to this address, 3.9 Ether. Those are two regular old addresses, no contracts involved. Pretty cool, and hopefully this makes it clearer, even if you don't understand the code. Hopefully it makes it clearer what's actually happening, this idea that you can send code, send instructions in a transaction. Welcome back. Now we're going to talk about something called the Ethereum Virtual Machine, or EVM. So basically, this is the environment where Ethereum is run. On people who are mining Ethereum, who have basically nodes on the network, they don't run Ethereum just on their computer like you would a regular piece of I don't know, a game or a piece of software, an internet browser. It has to be sandboxed. It has to be kind of hidden away from the rest of the world. And we'll talk about why that is. And the way we do it is using a virtual machine. So first, let's talk about what a virtual machine is.
So some of you might have familiarity with using a virtual machine and may not even know it. A virtual machine is when you actually simulate a computer, a machine, inside of your computer. So right. Pictured here is an ordinary iMac. Silhouette of an iMac with an Apple logo. Now, suppose you need to run some Windows software, as many people often do. You can't just open up a Windows application in Apple or in Mac OS X, but what you can do is you can spin up a piece of software that simulates a PC. So you'll have a window open up that is actually a full booted version of Windows 10 or Windows 7 or XP or whatever your favorite flavor is, And that is actually an entirely virtualized Windows machine.
Right.
And that's useful because you don't actually have to have a physical Windows box, but you can do what a Windows machine can do.
Yeah, although there are some limitations, and
Definitely.
you don't want to, like, if you're going to be spending a ton of time on Windows doing some, intense gaming, for example,
No.
you don't want to do this. But it is an option. Like for me, I sometimes do this when I need to record Windows-specific videos for students. Instead of buying a separate Windows machine, I just add some, set up a VM, a Windows install on my Mac, and I can start recording there.
So some terminology real quick. The machine that you're actually running the code on is called the host machine. And then the simulated machine is called the virtual machine. So what does this have to do with Ether? And there are some security implications here. This is why Ethereum runs in a virtual machine. And it's to sandbox it from the rest of a computer. So pictured here is a host machine with the Ethereum virtual machine running in it. And the EVM is a full-fledged but very simple computer that is run on every miner's computer. Now, why do we do that? What's the use of that? We want to prevent the Ethereum virtual machine from reaching out and interacting with any data on the host machine, because there could be viruses, there could be dangerous things, there could be files that we don't want it interacting with.
Or, there could be sensitive files that contains personal information or data that we don't want leaked. And this is on every single miner's computer, however many thousands of them are going. If someone wrote code that just said, send me all the names of the files on the host computer and get an encyclopedia of all the files on all the miners' computers, and that's not good. But the same it could go the other way too. If there's a virus on one of these host computers, we don't want it to interact and screw up the network and get into Ethereum somehow. So we sandbox things, as Kevin's mentioned. And that really just means putting borders, boundaries around sort of the space in your computer. It's sort of a weird foreign concept, but you can partition part of your computer and basically give it rules.
So the Ethereum virtual machine can't talk to the host machine, but it can talk to the actual Ethereum network. And that's speaking to all the other miners. So it has to speak to other miners, and it has to be able to receive incoming transactions and relay them. So the Ethereum virtual machine has access to a small window of the internet, and that is the Ethereum network. Mm-hmm. It can't just talk to regular websites. It can't go to google.com. It can't check the weather. If you want to include data like that in your application, there are sort of mechanisms, there are ways to do that, but it's not out of the box.
Yeah.
Now, the same goes for the host machine. Your Ethereum virtual machine cannot access files, we said before. And this is to prevent it from, for example, someone writing a contract that says, hey, gather all the files on any miner's computer that are named important.pdf.
Yeah, exactly. So here's a little chart to wrap this up. So a miner's computer can access the internet if the human who owns it is trying to browse, for example. But the section that the EVM is running on, that Ethereum is set up in, can't access the internet. But it can access the Ethereum network. It can communicate with other miners. I mean, that's the whole point. If it couldn't, then we wouldn't have a network. We wouldn't have any sort of distributed way of running code. We wouldn't have the blockchain. So that part's important. Then as far as accessing files on the computer itself,
It can't. Nothing on the host file system, but in exchange, it can access basic CPU functions. It can do things like SHA hashes. It can do multiplication, subtraction, addition.
Exactly.
The basic operations, because it is a simple computer and it needs to be able to access that CPU.
Yeah.
And then last but not least, it cannot access the peripherals of the miner. And a peripheral is referring to things like a camera or a mouse
a
or
printer,
a printer.
keyboard. Yeah. It can't access that. It can't, get into the webcam and start taking photos.
No. Unrelated, side by side.
Yeah,
it can.
These look like they're, comparison and that these are related. They're not. This side, what this is showing is that the EVM, basically, we've said that it can't access the host file system, and that's true, but it still has its own special place to store data because it does need to be able to store information and access it out, but it has its own designated little area that is safe and quarantined from the rest of the computer.
Yeah.
So that if I send, for example, the first contract we showed was that accumulator thing, there needed to be a place to store that value, whatever that value was. It started at 0, we added 5, it went to 5. It has to be stored on each miner's computer, and that's in the EVM, and it's in a special sandboxed area for storage.
And even if that miner turns their computer off and back on, it will still be there when they wake back up.
So that's the EVM, the Ethereum virtual machine, and it's important to understand all of this just so that you can understand how Ethereum is safe. All right, welcome back. So we're going to introduce a topic now that is really central to Ethereum and transactions that we haven't really talked about yet. It's pretty cool. Basically, it's a solution to a problem that can come up when you're running code across a distributed network. So if everything is running code concurrently on the network, all these miners are working on some application at the same time based off of a transaction. If that code has some sort of bug, whether intentional or not, that holds up the network, maybe there's something that's running infinitely, or maybe it's like taking up a huge amount of memory and it's constantly storing new numbers, like every number from 1 to on to infinity in memory. And it's doing that in all however many thousand miners are working at that same moment. That's a huge problem because it's holding up the entire network. No new transactions no code is running if this one thing is hogging all the resources. So Ethereum has a solution to that called gas.
So gas is the internal pricing mechanism for running a transaction on the EVM. And gas exists to limit transactions from overusing the resources of the virtual machine.
Yeah.
Be it intentional or unintentional, you need to have a way that prevents any one user, any one transaction from taking up too much compute or too much memory.
Yeah, basically when you send the transaction and it has some message or some code along with it, you pay some price to get that code to run. And we'll talk more about the details, but first I want to just show you, here's a very small selection of operations and their associated gas cost. So everything that you could do in an application, whether you're adding two numbers or multiplying, for example, has an associated cost. So it's pretty cheap to add two numbers, 3 gas. We'll talk about the actual value, what that means, but 3 units of some gas. To multiply, it's 5.
A little bit more.
To balance, which means to get the balance of an account, to figure out how much ether is in X address. That's 400 gas.
Then if you want to store data, this one at the bottom, S store, is 20,000. And why is that? That's because for these machines, memory is much more valuable than just an individual operation. So if you want to actually store data in the EVM, which you can do, like in our example contract, we stored a number, you have to pay to store that new memory. And this is one of the reasons that the EVM is not a perfect place for every single type of application.
Yeah.
It's to be a terrible place to run a distributed Netflix because it would cost thousands, hundreds of thousands of dollars just to store a video.
Yeah, you're basically paying. Think of all these thousands of computers. You're paying to store whatever piece of data you're storing across all of them at the same time. So it just doesn't make sense for that to be an easy thing to do.
So the gas price is the price in Ethereum per unit of gas, and you don't pay for actual operations. Those prices we showed you on the previous page were not calculated as a number of Ethereum, because the goal is that gas is decoupled from the price of Ethereum. As Ethereum goes up in price, the thinking is that the actual compute should still remain constant or low. If the price of Ethereum balloons 10x, you don't want the price of computation to balloon 10x. So gas prices fluctuate over time.
Yeah. So who sets this gas price?
So the gas price is set by the sender of a transaction. And in the same way that Bitcoin transaction fees are determined by a sender, the gas price is determined by a sender. And with a similar dynamic to Bitcoin, based on the gas price, you're more or less likely to be included in the current block. So if you bid very high, if you're willing to pay a lot for gas, then miners are incentivized to immediately include your transaction. Especially when the network is congested, a higher gas price is more likely to get your transaction into the current block.
Yeah. And if you pay a lower gas price, it's still likely that your transaction will get into a block. It just might have to wait until things have slowed down a lot. There's less traffic on the network. So as we kind of jumped ahead here, we have a slide on this. Bidding a higher gas price makes your transaction more likely to be included in the next block. It incentivizes miners to mine it. One last thing we have to talk about is that you actually don't know exactly how much gas the code that you are starting or triggering may end up incurring, the cost associated with it. Because maybe you think you're doing one thing and something else is actually happening behind the scenes, or there are side effects. There are other transactions that are sent off as a result of your transaction there could be ripples where all of a sudden there's more code that's running and there's a higher cost, and those could send off ripples. The point is, you don't know ahead of time. So what do?
You set a gas limit. So when you commit an Ether transaction, or before you produce an Ether transaction, what you need to do is you need to set an upper bound on how much gas you're willing to pay. So you might set a gas limit at 200,000, and if your transaction ends up using 250,000 gas, then what will actually happen is the Ethereum virtual machine, the Ethereum network, will reject your transaction. And that means that the operation does not have any effect, but the miners still keep the gas.
So now what we're going to do is take a look and actually show you some examples of gas and the gas price on real transactions. So I'm back on the Ethereum blockchain viewer, or one of them. Let's take a look at, how about this transaction right here? So this was sent from someone to a contract for almost 1 Ether. And if I click on the transaction here, all right, so we can see this was whatever the code was that was the function call. And if we scroll, we don't even need to scroll, but I'll zoom in. You can see that this person set a gas limit of, 110,000 gas. And they set a gas price, which, okay, we haven't talked about units of Ethereum, but this is 0.000, a ton of O for Ether, which
So,
the unit is what?
A gigaway. A
Yeah.
Wei, named after that person, Wei Dai, we mentioned in one of the first videos, is the smallest unit of Ether. I think it's 10 to the negative 18. So it's 1 with 17 zeros in front of it.
Okay. So anyway, this is a unit. So this was the gas price that this person selected. This was the limit. So the maximum amount of fees they would want is this number times this number of Ethereum. But the actual number that was used was right here, 80,000. So the limit was 110,000. The real usage was 80,000. And the total computed price is this many Ether, which is 22 cents.
As of the current exchange rate.
Yes. So you can poke around and take a look at other transactions and see the gas price. But this is not something that you have to stay up worrying about if you're trying to get into Ether, because most of the time you'll have an estimate of a gas cost for what you're trying to do. The other thing we didn't mention, the gas limit that was set here, whatever was not spent, you are refunded. So you're not just committing whatever, this number of gas times this gas price and just saying goodbye to it. Whatever's unused, you get back. Welcome back. In this video, we're going to demonstrate a real-life Ethereum transaction. And it's actually the first of 2 videos because, remember, Ethereum can be sent to people, to addresses like this, or to addresses that are owned by contracts. So in this video, we're going to do the former. I'm going to have Kevin send me some Ethereum. It's just an address, like peer-to-peer, person-to-person. And rather than doing 2 different phones, Kevin's phone and my phone, like we did for the wallet apps that we used in the Bitcoin transaction video, I'm going to have him use his phone and send it to a wallet that I'm going to use. It's actually in my browser on my computer. What I'm using is something called MetaMask. It's a very popular Chrome extension that allows you, it basically acts as an Ethereum wallet in your browser. So I've already installed it, but you go to the website, click Get Chrome Extension, and it sets up a wallet for you, and you can access it from this little icon here. So this is my MetaMask account. We set up a new one. He already sent me a little bit of Ethereum. We have a transaction pending. We can ignore this one. We recorded this video a couple times. So I'm going to just ignore that. I'm going to ask him to send me some Ethereum from his phone, which has been patiently waiting. What app are you using, Kevin?
I'm going to use Blockchain.
Okay, Blockchain, which I used for Bitcoin, the Bitcoin video when we did this. So the first thing I need to do is just give him an address. So I'm going to use a QR code, and he is going to open up his app, click on the to button, or no, there we go. Click on the QR code button, and he scans the address, and then he's going to type in, how much are you sending me?
How much am I going to send you? I'm going to send you 0.075, so we can have some left over. Oh no, 0.75. So we have some left over for the transaction fee.
Okay.
Continue.
All right. Okay, I don't know if you noticed, but this balance just went up. I'm going to view my account on Etherscan, which is like a blockchain viewer, a very commonly used one. You can see now that if we go to the in transactions, this was 49 seconds ago. Kevin sent me 0.0075 Ether. I have it now. Again, my wallet here, I'm using MetaMask. and it's an app that works in the browser. Why would you want a browser-based wallet?
So we use a browser-based wallet in this case for Ethereum because it's a little more useful because we're interacting with applications that have websites.
Yeah.
In the case of Bitcoin, typically it's just person-to-person transactions, so we don't really need anything else beyond just 2 wallet apps. In the case of Ethereum, what we're doing is we're about to buy CryptoKitties, which is much easier if you actually look at the web interface. So having a browser app or having a browser extension allows you to actually interact with a website using your wallet.
But we didn't do that in this video. We could have done this with any wallet app on the phone. It doesn't have to be in the browser. But next up, we're going to take advantage. I'm going to use this money that Kevin just sent me to buy something with Ethereum. You'll see I'm actually going to send some code in my transaction. So that's coming up next. Welcome back. Just when you thought Ethereum was complicated enough, we have another fun twist for you, something called Ethereum tokens. So tokens are a really powerful feature in Ethereum, but it takes a little bit to explain what they are. We're going to do that now. So get ready. Basically, tokens are a way of implementing your own digital currency on top of Ethereum, which itself is a digital currency. So if you wanted to make a coin, let's say I'm in college and we have a dining hall system, and I'm going to make a currency that we can use, a cryptocurrency, so students can use to buy meal credits or something.
It's going to be called Lunch Coin.
Sure, Lunch Coin. And I want to implement it. I want it to be a cryptocurrency. I want a blockchain. It doesn't really make sense, but let's just say that's what I want. I have a couple of options for doing that.
So the first option is to just build it from scratch. That means write the source code from the beginning.
Yeah, reinvent the wheel, basically.
And that's very difficult to do. It took the person or the people, Satoshi Nakamoto, who did this, were exceptional engineers. And to do this right on the first try is unheard of.
Okay.
The likelihood that you would do it right is virtually next to
So that's a
none.
no-go.
So the second way would be just to copy Bitcoin's source code. So you would copy their source code, you would change the word BTC to LUNCH, and then you would just put it on your own miners. You would tell all the students at your school, hey, run mining nodes and then install Lunchcoin software, and then you would have created your own blockchain network.
Okay.
The problem there is you don't have much hash power. So if some evildoer comes in and wants to cripple the network, wants to shut it down, wants to initiate false transactions, they can do it by just eclipsing your miners with a more powerful set of miners, which you can rent.
So basically the problem is you have to recruit your own miners. Bitcoin has thousands and thousands of them across the globe. If you try and recruit your own, it's not very easy to do, and it takes a while to build up a large network.
Yeah, and that's what makes Bitcoin secure. If you were to copy Bitcoin's code but not take all of their miners, you wouldn't have the inherent security of that large of a network, that much hashing power.
Okay, so then the third option.
The third option and the best option, which a lot of people have started to do, is to build a currency on top of Ethereum. Ethereum allows general purpose computation on top of its blockchain. And what you can do with that is you can just say, I'm going to implement my own token in the Ethereum blockchain.
All that you really have to do is say, hey, Ethereum, I'm going to make a token, my own currency. I'm going to call it Lunchcoin. And I want to use your miners. I want to use your network. I want to follow all your rules, but I'm going to add in some special behavior for Lunchcoin. Or I'm just going to have my own logo or whatever it is, but it runs on the existing network. And we can actually see a bunch of examples of this already. Here is a website called Etherscan. There's a couple of these out there to view tokens. And these are all existing tokens. I'm not sure how they're ranked. Is it by
Probably
volume?
market cap. It looks like market cap on the right.
Yeah, so there are a bunch of tokens. We're not really going to go into any right now, but in a little bit, I'm going to show one in particular. Most of these that are listed here actually do something novel, or they have a use, but you could just make a random token called Catcoin, and you could build it on top of Ethereum, and it would all work. And you could do it in a matter of like minutes or hours compared to writing source code for days or weeks.
And then you inherit the security of the Ethereum network. The amount of miners who are applying their hash power to mining Ethereum blocks, that hash power is protecting your contract.
So one example of an actual use of a token that isn't just a nice logo or a different name is something called Golem. We're not really trying to endorse this, by the way, but this is it was already on that webpage that we showed you, and it's easy enough to explain. So Golem is an application that runs on Ethereum that allows people who have idle computer power. So say I have this computer on the network, I'm not using it, well, other people could run code or could do things on this computer. Like the example they give down here somewhere is rendering 3D animations. It takes a lot of time. I could send that and distribute it to someone else's computer and have them do it for me. So that's what Golem is. But they have a token that they use within the app in order to purchase those compute hours, or basically the computing power. So I don't just use pure Ethereum, I use their token internally called, I think it's just called Golem, and I use that to buy computing time.
So this is useful because if you use a token, you don't need an intermediary. You don't need to sign up for a service or a separate website that manages the actual transfer and manages the rental. This is all mediated through the Ethereum blockchain and the contract that was written when this was released.
Yeah, think of it as if you go to a water park or like an arcade or something, maybe a fair. You go to a fair, and if you want to ride the rides, you're not giving dollar bills to the ride attendants. You go and you exchange your dollars for tokens or tickets or something that you hand out, and each ride costs one ticket. And you use those throughout the theme park.
So Ethereum tokens implement something called ERC20. And this is because this is a standard that was created because early on in the Ethereum blockchain and in the existence of Ethereum, people started making these tokens. And in order to standardize them, someone filed something called an ERC. And an ERC stands for an Ethereum request for comment. You might have heard us mention the word BIP in the earlier videos. Those are called Bitcoin improvement proposals. In this case, this is the analog in Ethereum. Now, ERC20 specified a set of methods, specified an interface that any token ought to implement. So if you follow these rules, if you expose a way to get the total supply of the tokens, the balance of an address, to transfer if you are the owner of some tokens, then you adhere to ERC20. And that means that what's useful there is that you can now interact with token wallets. Now, Ethereum wallets will very often have a section inside of them for ERC20 tokens. And that's cool because now if you have some Golem token, if you have some lunch coin, then all of them appear in your wallet as if they were first-class citizens of the Ethereum network. It's important to note that this is not an enforced rule. You can break these rules if you're creating a token, and you can trick wallets into believing them. So it's very important to do your due diligence if you're investing in any of these tokens, very often called ICOs, initial coin offerings, to make sure that you're not part of a scam. Many of these can be scams, but many of them are safe and have demonstrated themselves to be useful.
Welcome back. We're continuing on with Ethereum tokens. We're going to show sort of a walkthrough of how they work, or at least a part of how they work.
Pictured here is a contract, pictured as gears. And in this case, what's happening is Watermelon Person, pictured on the left, with that, I think that's watermelon green. It's such a perfect color.
Okay, enough of the color.
Watermelon Person is going to deploy this contract, is going to create this ICO, this token, and deploy it to the Ethereum network. And how does she do that?
So again, what that means is this person has written code. They've written, in this case, we're talking about a token, right?
A contract that implements ERC20.
Right. So they've written this contract for, let's just say it's Lunchcoin, and they want to deploy it. They want Lunchcoin to become a token and to get it up and running so people can buy and sell Lunchcoin. So the code is written and it's deployed, what does that mean?
So that just means that Watermelon Person just writes the code and includes it as the data for a transaction and sends it to a special address. And that special address is 0. If you send a transaction to 0, then the Ethereum network will interpret that transaction as a contract.
Okay. So all that means is that Ethereum in the network basically makes an address, a space for this contract, for our Lunchcoin contract that establishes the token. And we're visualizing that here as this orange little rounded rectangle. We already saw something similar with CryptoKitties among other addresses we took a look at, where that contract established its own address. It gets this address. So we have people who have addresses and we have contracts that have addresses. So this, whatever this address over here is the Lunchcoin address.
Now we're going to pretend that the initial distribution of Lunchcoin was 1,000 units. and all of them point at the contract creator. So in this case, pretend that Watermelon Person is the dean of the school, and she created the contract, and she initially has all of the tokens.
Okay.
Now, how does she distribute the tokens? Well, pictured here is Tree Man, and Tree Man is a student and needs some lunch tokens, or maybe he's a teacher because he's about to get 500 of them. Now, how would Watermelon Person transfer tokens to Tree Man? I'm just going to call them by their color. How would Green transfer them to Blue? Well, Green would then just create a transaction that just says transfer and the address of Tree and the amount, 500. Then the Watermelon Person, the Green person, would send it to the contract. In it goes, off to the blockchain, and then once it's hashed in, once it's confirmed, then the contract's internal data will have updated to point at Tree Man. So now the tree address has 500 tokens. And this is really the mechanics of a token. This is just extended out. Now when people are actually using it to buy lunch, they're going to say transfer to the lunch person and give 2 tokens and get a soda. And once it's confirmed, then the soda will be handed over.
And just returning to this slide, this idea, this transfer, so this has to be implemented behind the scenes. You still have to write code to make this sort of thing work and to figure out what the transfer means and all of that. But the key idea is that all that a token is a contract, a special type of contract that has code, that it has its own address like any other contract in Ethereum, and people send transactions to that contract with instructions about what to do with Lunch Coin or Golem Coin or whatever. Not Golem Coin, just Golem is what it's called, right?
I think Golem, yeah.
But they send instructions. Just like we saw with Simple Turtle, you could send a move right piece of code to the Simple Turtle contract. You can send a transfer Lunch Coin, or you could even have a destroy Lunch Coin if you wanted to, and send that to the Lunch Coin contract, which is just an address. And then code takes care of that. And Ethereum is backing all of this. All the mining power, the stability of the network is coming from Ethereum. Welcome back. In this video, we're going to talk about a famous hack that took place, a big moment in the history of Ethereum. It was not a hack of or on Ethereum or on the blockchain. It was of a smart contract, but it was a very, very big, well, I shouldn't say big smart contract. It involved a lot of money. This contract was basically dealing with a ton of transactions, and we'll explain why. It was called the DAO, the Decentralized Autonomous Organization. And let's start by just explaining what the DAO was, what its goal was pre-hack. What was it supposed to do?
So the DAO was a little bit like an Ethereum-based Kickstarter. So it was a smart contract that allowed members to bring up proposals, and other members could then vote on whether or not that proposal should be funded.
It's sort of like Shark Tank or like
It's
a
a
venture
Ethereum
capital.
Shark Tank, yeah.
Like a VC firm where, I don't actually know exactly what the projects were, what most of the proposals looked like, but imagine in simple terms, if you had an idea for some sort of Ethereum involved company or project or token, you could propose it and then people would vote and designate funds for you. So the important thing was that there was a pool of money to draw from, just like a VC, a venture capital firm, has a bunch of money, or the sharks on Shark Tank put their money in and you can draw from that. Although in this case, unlike Shark Tank where individual investors are investing, this is the entire organization where you would delegate a certain amount of the pool of the ether. And there was 11,500,000 Ethereum at one point.
At the time, I think Ethereum was about $20 per at its peak before the DAO was actually hacked. So what is that? That's about $250 million.
Yeah.
So what ended up happening?
So without going into the actual code and how it works, this is very, very simplified. It was a very long contract. But there was this one thing called split. And that's all that we'll say. This was the cause of all the headaches and all the problems. This little thing called split.
And there was a bug in it. And in that bug, if you specifically crafted a message appropriately while a certain proposal was up, you could actually siphon funds out of the DAO into whatever address you wanted. Now, someone discovered this and then sent the message over and over and over and effectively siphoned off a great deal of the DAO's funds.
I think the exact amount was 3.6 million Ethereum.
Yeah, which would have been, what, $70 million?
Well, yeah, and in today's prices, it's way more.
Way more than that. But at the time, it was still a massive heist.
But the crazy thing is that it was all transparent and public that it was happening, because remember that we're just talking about addresses. And so the person or the group who was behind this were sending these messages basically saying, basically taking advantage of this problem in the DAO and siphoning the money off to an address. And this address people could see, and they could see this money sitting there, this 3.6 million Ethereum, and people had to decide, what do we do? How do we fix this? Is there something worth fixing, or is this just totally, maybe a little unethical, or more than a little unethical, but it's legal? Do we change the history of the blockchain to remove this, to undo this? It was really a pivotal moment, and there was a lot of debate over it.
So what they ended up doing is a proposal was brought about to actually return the funds to the investors. And they were going to make a hand modification to the code that would allow investors in the DAO to get their funds back.
And this was very controversial, because what they did, the fix, was basically to write some special code, add it in to Ethereum to freeze this one address and freeze the funds in there and prevent them from being spent. And this sort of, even though they didn't really revise the history of the blockchain, this sort of like patchwork, like special, what would you call that?
It's a modification.
A modification that was made is something that a lot of people were uncomfortable with, because yes, it's easy to, I think most people would agree, this person did something unethical, that money should not be spent, but at the same time, where do you draw the line? It becomes this is my least favorite phrase ever in politics, it's a slippery slope. But that's what a lot of people said.
So what did they end up doing? They actually added the switch, and they implemented something called a soft fork. So on July 20, 2016, the blockchain actually forked. On the bottom here, this is block 1,920,000, actually created a separate chain because some miners were not interested in installing the actual patch and refused to be part of this rewrite of history. It wasn't really a rewrite, but a modification to the source code of Ethereum in order to refund people.
Yeah, some people are they're strong advocates for complete, laissez-faire attitudes about the blockchain. It is what it is. You've written the code, now leave it and don't meddle in it.
Yeah, and both sides have their merit, but what ultimately happened is most users went with Ethereum, and it was named Ethereum as opposed to a different name. They took the name Ethereum because the majority went with the copy that invalidated all of the theft transactions.
Yep.
And the other chain that persisted, that continued, wherein the transactions were, the DAO had still been funneled off and there had been no remedy for it, is now called Ethereum Classic. It's still a currency, and I believe it's about, what is that? It's $20 compared to the $700 or so that we're looking at for Ethereum now. Yep. So it's 1/35th of the price and approximate market cap. Of Ethereum's main chain.
So the reason we brought this all up and talked about this hack is, one, to illustrate the fact that there are vulnerabilities when you're talking about smart contracts. You could write bad code because the code just runs as it is in a contract. There was no problem with Ethereum itself here. This was just a really, really large organization, a smart contract that was managing 250 million US dollars at one point. And somebody found a bug in the code and was able to exploit that. That doesn't mean there was a problem with Ethereum itself. The second reason we brought it up is to talk about the repercussions and the split that resulted in Ethereum and Ethereum Classic. And yeah, as we already mentioned, you can buy Ethereum Classic today. It's worth much less, but you can go and see that I think actually those funds have been moved a little bit in Ethereum Classic. Mm-hmm. They're not worth anywhere near what they would be worth in Ethereum, but the person of the group who stole the money from the DAO, I think, moved some of them around, cashed a little bit of it out, and you can see it on the blockchain. Anyway, we'll wrap up there. Welcome back. So in this video, we're going to address a pretty common question or a concern that comes up that you may have been wondering about so far. If addresses are just random numbers, is it possible? Well, technically they're not random numbers again. They're the result of a hard math problem. But even if we just consider them totally random numbers, could you have an address collision? Could my wallet app generate one address and someone across the world at the same time, or in the past, most likely, in the history of however many million transactions there have been, is it possible that someone else had the same exact address? And the answer is Yes, it is possible. It's just really, really, really unlikely.
So this is the likelihood right here. It's 1 over 2 to the 160th power. An address has 160 bits of entropy, which means that if you generate two side by side, the likelihood that they are the same or that they collide is this number. And this may not look big at face value if you don't understand or intuitively understand what 2 to the 160th power, like I don't either. So let's expand it into the number that it is.
Yeah, I think us humans have a hard time really comprehending large numbers, but this is what it expands to.
So this is the likelihood that two wallets side by side will generate the same address. And this is repeated over and over and over and over, but still, even if you have a billion, trillion, quadrillion addresses, it's still completely dwarfed by the likelihood that they'll never hit one another, or that they will hit one another.
Yeah, it's like, it's possible just in the same way that I could buy a lottery ticket every day for a month, and it's possible that I could win every single time. It's just really, really, really unlikely, and nothing like that has ever happened before.
So what would it mean if addresses collided? How would that look? There are two ways that addresses collide. The first is that the private keys could correspond, two private keys could correspond to one public key. So private keys are not necessarily one-to-one on public keys. You can have multiple private keys that correspond to the same public key, just because mathematically the space of private keys is much more sparse, much larger. That would be the first way. Two people have two separate private keys, the same public key, and by having the same public key, they have the same address. The second way would be you have two different public keys that correspond to the same address. When hashed into the base 58 form, they look the same. And in both of these scenarios, what would happen is it would then become a question of who tries to withdraw the coin first. So if there's one Bitcoin associated with an address that has been generated twice, whoever spends that Bitcoin first will then have extracted the Bitcoin. So in terms of our analogy, this is as if two locksmiths on different sides of the world built different copies of the same lockbox. However, each copy takes the same key. Both users, both owners of that lockbox would then see the other lockbox, and by the way this math works and the way the Bitcoin network works, they would see, hey, my key is going to work with that lockbox. I'm going to open it up. Then it just becomes that question of who spends it first. If you're concerned about this happening to you, which you shouldn't be, but in the event that you're transferring $1 billion, you can in a huge way protect yourself by just breaking it up into a few transactions.
Right. Okay. So in conclusion, it is possible. It's just really, really, really unlikely. And I would love to see someone in the comments pronounce this number. What is this actually?
Do they even have names for the numbers once you're 30 out? Probably. Somebody's done that.
Anyway, all right, we're done. Welcome back. So let's start with a hypothetical situation here. Let's say that I have an iPhone with a wallet app on it, whichever one I chose, and that for my work, I get paid in Bitcoin. Let's say every week I get X amount of Bitcoin. So over the years, I've accumulated a lot of Bitcoin in my wallet app. And I never wrote down any sort of like private keys or anything. I have this app on my phone, and that's in charge of everything. But then one day, my phone is stolen or it explodes because the battery overheats or something happens. Is my Bitcoin lost? And the answer is, well, no, it's technically Bitcoin is never lost because it's always on the blockchain, but is my access to it lost? If I don't have the private keys, can I ever get it? And the answer is no, you can't just magically find private keys or make them up or guess them. But there is a system in place nowadays with wallets and wallet applications that makes it much, much easier to export a wallet. And when I say export, what we're talking about are something called mnemonic seeds.
Mnemonic?
Yeah, the M is silent. Mnemonic. And what this does is it allows you to take your entire wallet and export it as 12 English words.
Or it's not just English words. They have a Japanese version. I think they have a Korean version.
Okay.
Yeah.
I'm sorry. That was very Anglo-centric of me. So there are 12 words that are exported. So you don't pick these. These aren't things. It's not like a password that you're choosing. Your wallet actually, when you created or when you installed the wallet app and you created your first address, at some point along the way, the application chose these 12 numbers and these 12 words, and they're not totally random. There are some rules around it. It's not just any valid word. I think there's about 2,000 words that are valid.
2,000 total.
You can't do that.
I think it's 2,000 choices,
Yeah.
2,048 maybe, yeah.
So there's a ton of options overall for the number of possibilities here. But these 12 words, it's pretty crazy to try and explain how this works. But if you write this down, you could throw away your phone, throw away your wallet app. I could go to an entirely different phone and install a different wallet app, not the same company, totally different. And if I input these words, I could import the entire contents of my previous wallet app. So the addresses and the corresponding private keys. So you'll see our little balance here now reflects what I had before. I guess I didn't really hit that point earlier, but you can see here, 1.5 Bitcoin. On a totally different phone, I import these words and I end up with my wallet. So this is pretty miraculous. And what it means is that you only have to write down these 12 words, keep them safe instead of trying to keep a bunch of numbers and addresses and private keys safe. You just write these down and this will grant you access to your wallet anywhere.
So this is accomplished using a technology called hierarchical deterministic wallets. And you don't really need to understand the underlying implementation details, just know that it's deterministic. Now, that means that given the same 12 seed words, you will generate the same sequence of addresses. So pictured here is an HD wallet, and an HD wallet is just a name for a wallet that's exportable as these 12 words, and most wallets these days will be that. So when you plug in this sequence of 12 words, your wallet is then seeded with a sequence of Bitcoin addresses and keys. And regardless of where you run this or when you run it, it will generate the same sequence.
Yeah, it's really crazy. So these are 3 unique addresses. We have different colors, but basically when we say deterministic, it means that anytime, like if you were to take these 12 words today and enter them into your app, the first address that was generated, which we've kind of been talking about as if they're totally random. And this is actually the opposite of random, meaning that if you generated the first address, it's always going to be this address here. Versus if you were somewhere else on a different application, on a different phone across the world, you did the same thing at a different time of the day, and it was your first address that you generated after you input these, or after your wallet was created with these 12 seed words, you would end up with this address. And the second address would be this one. And again, we're showing them as colors, but they're different addresses with different private keys.
So suppose Colt lost his phone, it exploded, and now he doesn't have the actual contents of his wallet. He just knows his backup phrase. He doesn't remember his addresses. He doesn't remember his keys. All he would have to do is plug in this sequence of 12 words into any compliant wallet application, and out would come the same sequence of addresses. And that would be useful for him to actually retrieve. He would generate maybe the first 256 and see which ones actually have Bitcoin associated with them.
Yeah, it's pretty crazy, the math behind how this works. And it seems like it's completely at odds with this idea of how private keys should work. But it's not. And there's some really insane math that we're not going to go into because we can't really explain it. But basically, these 12 words, you input those 12 words, or they're chosen, and they set you down a path. They set the wallet down a path that every address that then is chosen basically is derived from those initial 12 words. And so anytime you use those 12 words, you set the same initial start conditions. And there are so many combinations that it doesn't matter as far as how many people are across the world, how many different wallets there are. Everybody gets their own 12 words.
Yeah, these are definitely secure. It's the amount of information here is 2,000 approximately to the 12th power, which is an enormous number.
So you write these down and you can restore a wallet. So it's a good idea to do this, and we're actually going to demonstrate how this works. Okay, so now we're going to demonstrate how these mnemonic seeds work. So we're going to simulate, I'm going to back up my wallet by literally writing down the 12 words and then pretend that I lost my phone. And we're going to show that on Kevin's phone or any other phone with any of these wallet apps, we can restore my wallet. So I'm going to go over to, backup funds on this phone. And it says backup needed. The following 12-word recovery phrase will give you access to your funds in case you lose your password. Be sure to write your phrase down on a piece of paper and keep it somewhere safe and secure. And also I should mention that we're going to clear this wallet out before this course goes live, but you're welcome to try this yourself if you'd like. So first of all, first word is space. So Kevin's going to write them down. I'll edit most of this out, but space, glad, arena, menu, make, sale, slice, question, maze, food, category, green. Okay, so that's 12 words.
So now they're going to actually ask us to make sure that we did write it down correctly. What the third word is, arena. What the 8th word is question. And the 10th word is food. And that's just a simple way to make sure that the people actually using this interface are taking it seriously.
So let's see if it worked.
Wallet.
All right, backup complete.
Perfect.
Okay, so now I'm going to pretend that my phone is destroyed. So
now
this is gone.
Kaboom. So on the right, I'm going to create a wallet using that recovery phrase. I'm going to name it Colt's Old Wallet. It's going to be Bitcoin. And then I'm going to type in the recovery phrase.
Chase, quiet, arena, menu, make, sale, slice, question, maze, food, category, green.
Okay, so I've typed it in. And now I'm going to create a wallet. Creating wallet. Would you like to protect this wallet with a password? No, because our students are probably going to steal what's in here. Without encryption, I'm sure that's fine. Now we have Colt's Old Wallet. What we need to do before we actually see the balance on Colt's Wallet is actually generate the sequence of addresses ahead of time. So we imported the seed, and now we need to extrapolate outward. Basically, traverse the trail of addresses that correspond to this mnemonic seed. So what I do is I go into the settings. Right now it shows 0 Bitcoin because it hasn't pre-generated the addresses. I go down to Colt's Old Wallet, and then I scroll down to more options.
Yeah, they make this kind of hard. We go to addresses.
Wallet addresses. We click scan addresses, and now it is generating the addresses and scanning the blockchain to see if there's any Bitcoin that corresponds to them. There we go. Now I have Colt's Bitcoin, 0.00302 Bitcoin.
And now you can see the transactions that are now, these are all on Kevin's phone. He can spend this if he wanted to. He's not going to though, are you?
No.
Although actually
never.
all of that is yours in the first place because you just sent it to me for this course.
Oh, I guess so. Well,
Yeah.
Colt has my passwords. I have his Bitcoin wallet.
Yes. Well, the course Bitcoin wallet. So yeah, that's pretty much it. It's definitely not the most straightforward process ever because there's a lot of room for, typing something incorrectly or for capitalizing something or, I don't know, writing something down wrong. It's not that likely, but it definitely, if there was like $1 million in this wallet, I would be very stressed out about this whole process.
Yeah, if you want to make sure that you do this safely, try this, practice this once before you actually hand around $1 million or back up 10 Bitcoin, something
and also
like that.
remember these 12 words are really important to keep safe because anybody gets these 12 words, it's super easy for you to back your wallet up, but if somebody found them, they have access to all of your Bitcoin and can spend it all immediately. So you want to write the 12 words down, keep it in a safe or somewhere. Definitely don't keep it like on your phone as a text, as a note or something like that. Keep it somewhere else.
That's a bad call. Yeah.
Okay. Welcome back. In this video, we want to talk about privacy and Bitcoin. This is something that I think it's one of the largest misconceptions about Bitcoin is that it's completely private or anonymous or untraceable. And we've kind of talked a little bit about this, but we want to demonstrate now, first of all, how it is not private. But second of all, steps that you can take to stay anonymous. So I have a wallet app on my phone, and let's just say that I don't know, I laundered a bunch of money or I got paid in Bitcoin for killing somebody. So I want to make sure that transaction went through. Isn't like if potentially I was hacked somehow or the authorities got my phone or somebody was listening to my network. Yeah, exactly. If someone was monitoring my internet traffic, couldn't they tell that my wallet app was looking at a particular address or that I was checking to see if a certain transaction was added to the blockchain?
Yeah, it could. So one way to prevent that from happening, most of you probably will not need to do this, but if you absolutely need to maintain anonymity at the level of your IP address or of your internet traffic, then what you can do is you can download the entire blockchain. It's freely available. It's public information. And then you can locally on your computer grab the actual addresses that you're concerned about.
So here's the big misconception that people have about Bitcoin, or this is clearing up the misconception, which is that Bitcoin transactions are not private. They are public, they're traceable, and they're permanently stored in the blockchain. So you can't hide them, you can't change them. I mean, that's the whole point. That's how things work, is that they are public, that everyone can see them. So for example, if this is what the history of a couple of addresses look like. Let's focus on this blue address or this transaction here. This was, I don't know, this was sent to me, right? This is my payment for some crime that I did. I got 100 Bitcoin for killing someone. Let's say that I picked Bitcoin. That's why I wanted to be paid in Bitcoin, because I assumed it was untraceable, right? It wouldn't raise any red flags like a $1 million payment to my bank account would. But along the way, this is the series of transactions that led to this transaction, because remember how Bitcoin works. It's just a bunch of these transactions from one address to another address, or from more than one to more than one address. But either way, it's just an address to another address plus a quantity. And if I were to send this on to someone else, there'd be another address or another transaction after this.
So the FBI is looking for Colt, and they see this sequence of transactions back from his blue address. But then they also have, for example, a database of known owners of Bitcoin addresses, maybe because they've already been surveilling exchanges, and maybe because they've already arrested somebody and they've surrendered their addresses. And suppose they found the person who owned this pink address, this lavender address. Now, what could they do with that? Well, they could apply pressure, be it judicial or personal or social or physical pressure, as the FBI is known for, and determine who the owner of the account, why they chose to send Bitcoin to the teal address, to the cyan address, between Colt, the known recipient of a payment for example, killing somebody, and this person who they have the identity of. And they can actually work towards the owner of an address because they see the sequence, and then they can just insist, you're going to jail if you don't tell us what you sent this cyan Bitcoin for.
So in that way, it's way, way, way more traceable than just traditional currency. Because once money, a dollar bill, changes hands a couple of times, at that point, it's pretty much impossible to figure out where it was unless you have it was scanned at some point, or you have like fingerprints or something. It's a lot harder to trace back the history of money, of traditional money. Cryptocurrencies, though, the whole point is that you can see every single point along the way where it was sent from and who it was sent to, but you don't know the identities necessarily of those addresses. You just know the addresses themselves.
And it's not super easy to determine who owns an individual address, but a sufficiently determined law enforcement agency could probably do it. So if you're planning on committing any crimes, I would suggest that you don't use Bitcoin for this. This picture is more accurate, that Bitcoin can be anonymous. They're not private, but if you take certain countermeasures or if you take certain steps, you can make sure that your address is not associatable with you. So Colt and I have assassinated somebody, and we need to be paid. We didn't take the money up front. We were good criminals, and we want to make sure that there's absolutely no paper trail. So how would we go about doing that?
So what we could do is use a wallet app, but keep our phone offline. So turn on, airplane mode on an iPhone, or just disconnect it from the internet entirely. Remember that we can generate a wallet, we can generate addresses just using math. We don't need the internet. So on my phone, I have a wallet app disconnected from the internet entirely so that I know there's no outside communication, nothing's happening. Then I generate the wallet and I generate an address, or as many addresses as I want, depending on how many transactions I'm trying to receive. Then I basically throw it all away. And the way that I do that without losing my wallet is by exporting it, as we've already covered this in a previous video. You can export it to a paper wallet. You write down those 12 seed words, keep it secret somehow. So I've created my address. I've exported every trace of this wallet from my phone, and I can throw it away. I can burn it, put it in the trash can.
Into this special effects.
That's very nice.
That's good.
Okay.
So that address and that mnemonic seed, God, that's hard to say, have never been exposed to the internet. We immediately destroyed our phone right after creating the address. Now, what that means is the only connection between us and this address is the piece of paper, which we're going to do our best to hide.
Yep.
And that means if the FBI ever wants to determine who got paid, the only connection between us and the money that we have received at this address is the actual seed, which we're going to do a good job of hiding.
Yeah. And so I would write down this address or somehow get the address to my mafia boss or something.
Whoever paid us to kill Tybalt.
But there's actually no connection other than that. And so I can go hide on the other side of the world. and assume that they sent money to that address, and then years later resurface with my piece of paper and verify it, or download the blockchain, the entire thing, the entire history, the ledger on some computer at a public library, and then verify that my transaction's on there.
But then you're going to want to spend it, and as soon as you spend it, then the FBI is going to come for you.
Yeah.
So, again, not the best tool for a truly anonymous transaction or a truly private transaction.
Welcome back. We've spent a lot of time talking about how Bitcoin and the blockchain is very, very difficult to hack or to reverse in any way or to deceive. And that's by design. But that doesn't mean that as a user or somebody who buys or sells or just sits on Bitcoin, that doesn't mean that you aren't vulnerable to being attacked in other ways. So in this video, we're just going to mention a couple of prominent examples, things that have occurred or are ongoing to this day as far as scams, and most of them have to do with exploiting weaknesses in people. So the first one is called phishing, and this is a big problem just in the world of the internet in general.
Phishing is a deliberate attempt to impersonate an existing website, probably one that you are already registered with. And the aim here is usually to get your login credentials, but it can also be to sign you up for something like a fraudulent wallet. And phishing very often takes the form of you'll receive an email from a website that looks similar to a website that you're actually a member on, and that website will in some way try to gain some information from you. So we're going to show you some examples.
So this scam, this happened, I guess, for about 3 years, and it was only recently discovered. This group, I think they're based out of Ukraine, made $50 million that we know of, possibly more, just by placing ads on Google. They were trying to get people to confuse this website, which is blockchain.info, with these websites that they registered. Blockchain.info, Blockchain, and so just slightly altered websites that maybe a lot of people would probably catch this, but they were able to make $50 million over 3 years by basically doing nothing. They just make this website, they place these ads. I mean, you can do these just recurringly. You just give Google your info, you tell them how often you want the ads, where you want them to show up, what keywords, and then you just sit back and people log in to this website, which most likely looked identical to this page. So these were people who already had accounts, who had money in their Bitcoin in their wallets, and they thought they were signing into the correct website. Instead, they were just directly handing their information and their passwords over to these hackers, who then could go log in later and siphon off all the money. So the moral of this whole thing is basically just do your due diligence, pay attention to the websites you're going on. I think a lot of people think they're above falling for like an email scam or something. And I would say that that might be true, but it doesn't hurt to just be vigilant. And then also keep in mind that there are all sorts of scams that don't just depend on, email or getting a phone call and somebody impersonating somebody else. There are many ways of deceiving you. And I think a lot of people put trust in something like Google, where people might assume if I click this from a Google link, it's not going to take me directly to a scam. But that was not the case.
One of the best ways to protect yourself from a phishing scam, not just in digital currency world, but all over the place, is to enable something called two-factor authentication. Two-factor authentication is an extra layer of security for online logins. So to get into a website, for example, your bank, not only will you need your username and your password, but you'll also need proof that you have your phone on you. Or, for example, you have access to your email address.
Right.
This really helps in that it's much harder to impersonate a site when you actually have to simulate two-factor authentication. And if a malicious actor does obtain your login credentials, they typically will not also have access to your phone. And in that case, they won't be able to get into, for example, your bank.
Yeah. If they do have access to your phone and your login credentials,
then you are SOL.
Yeah, you have bigger problems.
Yeah.
Almost all of the big exchanges out there offer some form of two-factor. I mean, almost every bank these days, email, Facebook, it's all over the place, so you're probably familiar with it.
And the other thing you should keep an eye on is always watch for the green lock in your browser URL bar. And the green lock is proof that you have something called a TLS secure connection with the actual website. It's not only that the line is secure, but also that you're speaking to in this case, the real blockchain Luxembourg. It's important to actually look at the name of that entity because a good phishing scam will also have a green lock, just it'll be blockchain Denmark. That would be quite difficult to detect. But it's important if you're doing anything big, when the risks are high, it's also important to take these countermeasures. So I would personally look up, should blockchain.info have a blockchain Luxembourg extended TLS certificate? So if you use two-factor authentication and you keep an eye on the URL and the TLS security of the websites that you navigate to, you're probably going to be pretty safe.
So there's also a lot of malware that can target cryptocurrencies or users of cryptocurrencies. We're going to go into one sort of infamous example called Crypto Shuffler. So malware basically is a virus traditionally that sits on your computer or on your phone these days, some phones, and it's going to do something bad. It's going to interfere with your transactions, or siphon money. So what this one does, Crypto Shuffler, it preys on the fact that addresses are very hard for humans to read or to tell apart from one another.
As you can see, we haven't copied and pasted. We haven't handwritten a Bitcoin address in the entire duration of this course.
Right. And so they take advantage of the fact that this particular piece of malware takes advantage of the fact that almost everybody or a lot of people copy and paste addresses rather than hand typing them. So if you have a QR code, that's one thing. But if you do put it on your clipboard and you paste, the Command C and Command V or Control C, Control V are basically commands that can be overwritten or the clipboard can be altered. So this is sitting in the background, and when you go to paste it, it alters it, and it puts in an address of a scammer. So you will end up sending money. So even if you go in your browser, you copy the exact address that someone tells you to send it to, you paste it in to your wallet app or some place where you're going to send money to, and you hit send on that transaction. If you don't pay attention and you don't double check the address, it's possible. And as far as I know, this scam hasn't made a huge amount of money, but it still is notable because of how devious it is and how difficult it is to spot, because a lot of people just assume I copy something and I paste it, like I'm safe. Most people just aren't aware of the fact that you can override that. So that's Crypto Shuffler, and really my advice here would be just pay very close attention. You could say the same thing, honestly, for QR code scanners. You could easily write malware that as you scan a QR code, it replaces the result with a malicious address. The only thing that's going to save you is just double checking the address. So scan something or copy and paste it, and then check the first few characters and the last few characters against what it's supposed to be. And if it looks good, then you're good to go.
So one thing you can do to protect yourself from any and all malware is, if you're going to be interacting with large amounts of digital currency, make sure that you're using a device, a phone or a computer, that doesn't have anything odd on it. It's important.
Okay, that's
beating around the bush, but use a clean device to actually interact with your digital currency.
All right, welcome back. So throughout the entire course, we've mentioned that addresses are not the same thing as a public key, but we haven't actually explained how they're related. How is an address derived from the public key? So we've mentioned that they're related. So what we're going to do now is explain the connection. So when we see an address like this one, a QR code, or just a bunch of numbers and letters, that is not a public key. Instead, it's this, which is a little more crazy. So you get the public key. Remember that RSA is not actually what Bitcoin uses, even though we've been talking about it a lot. It uses ECDSA, which is elliptical curve
digital signature algorithm.
It's public key cryptography algorithm. It generates public key and a private key. We take the public key, and to get it into the form that we want for an address, and we'll talk about why this is done in just a little bit, we run it through SHA-256, fingerprint function we've talked a lot about. And then we take that result and we actually hash it again with a second algorithm, a second hashing function, which works like SHA-256, but it's not related to it. The math is very different. They are kind of two different families of hashing algorithms. So it's a hash of a public key.
And we'll describe why we do that in a couple of slides. But before we do, we need to update you on what the actual generation process is. So ECDSA, you generate a public and a private key. And then you take that public key, you run it through SHA-256. You take the result of that, you run it through RIPE-MD, and then you get your address. So in our explanation of how an address is not a public key, what does that mean in terms of actually forming a transaction? So a transaction from address A to address B requires two things, not just a digital signature. So when I'm sending, for example, from cyan to blue, left to right, I would, one, produce a signature generated with the private key associated with that address. And two, I would produce a public key corresponding to that address. Because remember, this is a one-way function. You can't guess backwards, but if I produce a public key, they'll be able to really quickly SHA-256, RIPE-MD, and then see, oh, this must be the public key that corresponds to this address.
So if miners only have addresses as the public information, if that was it, an address plus a private key won't work. You can't use the private key to figure out, or you can't use it to verify anything about the address. You need the original public key. And the public key is not part of the address. I think we have a slide on that. Yeah, you can't work backwards from the address. If this whole thing is the address, you can't get the public key. So when you want to spend money in an address that you have, you produce the public key to say, all right, here's the public key that gave me this address. You can use this public key to verify, and here's my signature. Use that public key to verify the signature. Why do this? Why not just put the public key as the address itself?
One of the two reasons that we use an address instead of a public key is the idea that ECDSA could be broken someday. So if ECDSA were ever broken, and that means the elliptic curve that's used to generate the pair of numbers, the key pair, were ever proved to be faulty, then someone might be able to generate an exploit that takes a public key and works backwards to a private key. It's possible. To prevent that from completely undoing all of the security of Bitcoin, in which if the ECDSA curve was broken, somebody could just go address by address, work backwards from public key to private key, public key to private key. What we instead do is we hash the actual public key and use that as an address. So if you're looking at the blockchain, there's nothing to work backwards from, or it's just more difficult because you'd have to work backwards from an address through a RIPE-MD, through a SHA-256 to a public key. And then only at that point would the fact that ECDSA is broken, or could hypothetically be broken, be useful to somebody trying to steal Bitcoin.
Right. Yeah. So it's just an added layer of security. Remember, currently, and it looks like no time soon, is ECDSA going to be compromised.
No, some people say that the NSA has like a secret backdoor into the math problem that means that it's backwards, but it doesn't look like at this point anybody has stolen Bitcoin.
The other benefit that Satoshi himself or herself or themselves has mentioned publicly before has to do with the size of the public key. It's a really, really large number. And if we use SHA-256 and also RIPE-MD one after another, we can compress it down to a much smaller, easier to store format. Welcome back. In this video, we're going to talk about sort of an infamous vulnerability of Bitcoin, which we'll see it's really hard to do, but it is something that is out there and a well-known issue or potential shortcoming with Bitcoin. It's called the 51% attack.
Or more accurately, a more than 50% attack,
Yeah.
or a majority attack.
Yeah, just 50.0000001% is still valid.
Technically, yeah. We'll describe it here.
Yeah.
So here's our network, and we have 5 miners. A 51% attack is when somebody, a malicious actor, takes over more than 50% of them. In this case, they took over 3. They could also, for example, add 6 new miners. Like, let's say these 5 continue to run, but then the 51% bad actor just shows up and has 6 running. That is another way of making 51% of a network. But in this case, we're just showing 5, they take over 3. Now, what is a 51% attack? A 51% attack is when a bad actor, an attacker, controls more than 50% of the hash rate.
Yeah, so actually that's important. It's not just the number of miners, it's the hash rate.
Yeah, if you had super fast miners, if you had a quantum computer that was doing this, you might be able to more effectively and more efficiently mount a 51% attack.
But it also means that you can't just go and buy, set up like a crappy laptop in 1,000 places or 20,000 places across the globe and just assume that that's going to help you out.
Yeah, the existing miners really have a strong foothold on the hash rate. So what can you do if you actually mount a majority attack? You can't actually go back and change transactions. You can't, for example, take Bitcoin out of an address that Colt owns. The public key cryptography that backs it is still bulletproof. What this is taking advantage of is the actual distributed network of Bitcoin. And that would allow an attacker to first and more easily prevent transactions. So you could just, let's say you wanted to just shut the network down. If you had 51% of the network under your control, you could just start mining blocks that were empty, or maybe only had one transaction at a time, and you would bring the network to a standstill. The second thing, which is a little more complicated, is you would be able to implement a double spend, and that's what we're going to describe here. This is the more terrifying of the eventualities of a 51% attack. So suppose we have our blockchain here, and then we've highlighted one of our transactions in rainbow. So in this case, say that I just bought a car from Colt. In that transaction, I gave him 2 Bitcoin, so that transaction is destined for Colt. As of right now, it has 2 confirmations. It was confirmed once in the actual block that it was mined in, and then it was confirmed a second time with this cool dude sunglasses block. And now the entire network is working on a third block. So what I actually did is when we were conducting this transaction, I started up my miners in the background and said, start mining this block, the current one, but ignore this one transaction that I just sent. And I sort of invalidated my own transaction, but I'm doing this in secret. I'm doing it on my 51% of the network, which I somehow have taken control of. And what that means is I've secretly, because my miners are able to hash faster, once I drive away, I can reveal the progress that I've made, which in this case is a longer blockchain than the one that has the transaction that Colt expected. So although Colt saw 2 confirmations, because I owned more of the network, I was able to create a longer blockchain, and a longer blockchain is always considered more valuable. It's seen as more secure, and thus the miners, as soon as they see my new revealed blockchain that is longer than the actual main chain was a few minutes ago, and no longer has Colt's transaction, they're immediately going to switch over. They're going to say, let's hop onto this one. It must have just been a network glitch. There must have, for some reason, we didn't see it continuing. We missed a few blocks. We immediately have to hop on the bandwagon. This would be the way that I would go about creating a transaction and making sure that Colt never gets the Bitcoin.
So as you can see as you can imagine at least, this is really hard to do because if, first of all, getting 51% of the network or the hash power, it's not the number of nodes on the network, it's the hash power, is really difficult. It would be expensive, or I don't even know how you'd go about doing that.
You'd probably make a virus that took over all the miners.
Yeah.
That'd probably be the best way to do it.
But then if you have 51% of the hash power already, I mean, you're going to be making a crazy amount of money every day from mining.
Yeah, so who cares about 2 Bitcoin?
Yeah, it's not like this doesn't allow you to falsify old transactions or just make up new ones. You can't just say, oh, I'm sending 1 million Bitcoin to me from this one address. So it's not that powerful, but still it is something that is very easy conceptually to do.
Yeah.
Right? It doesn't take much work. You just need 51% of the network and you can decide what happens from there on out. It's just not easy to actually get there in the real world.
Yeah. So the security here is really inherited from the number of miners on the network, which as we discussed earlier in creating your own chain, the part of why it's a bad idea is because if you just have a few miners, it's much easier to get a majority of them. It's much easier to create, for example, in our picture, 3 miners when there's only 5 on the picture. When there's 10,000, the act of taking a majority would require much more effort.
Welcome back. So in this video, we're going to quickly talk about an important historic event in the history of Bitcoin, which had to do with something called SegWit 2x. So this all comes down to basically a change that was proposed to the Bitcoin network. Some changes that miners would have to install on their machine. Think of it as like a software update, basically for Bitcoin, that miners would elect to add in, and it would change some of the functionality.
It's important to note that Colt used the word elect because this is optional. Because Bitcoin is based on distributed consensus, there's no one central authority that will tell you you have to upgrade. This was something that the community proposed, and many of the miners said, okay, we're willing to do that. Now there are 2 stages to it, and we'll describe them both. So SegWit 2x was an upgrade to the Bitcoin protocol that would take place in 2 stages. The first stage, listed actually at the bottom row here, is to remove something called the witness data from the block. Now, this detail isn't that important unless you're actually really interested in the inner workings of Bitcoin, but what it means is this upgrade would make the actual size of a transaction in that 1 megabyte block smaller by moving some of the irrelevant or unnecessary data out. That upgrade would mean that you can fit more transactions into every block. The second upgrade was a doubling of the block size. So instead of just limiting blocks to 1 megabyte, SegWit 2x would tell miners, from now on, if we actually initiate this update, we're going to accept blocks that are 2 megabytes, doubling the size and therefore doubling the capacity. So in August 2017, the first half of the change went through without a snag. Most of the network upgraded and the change was actually applied. So from August onwards, Bitcoin blocks had witness data outside of what they considered their 1 megabyte of storage, and that boosted the capacity. The second half of the upgrade was a proposed something called a hard fork, which would have meant that everybody has to upgrade, and if you don't upgrade, you can no longer participate, you can no longer interact with the rest of the network. And that would look a little bit like this.
Although technically this down here should be showing double the transactions that we see up here, but that didn't fit on the screen.
Yeah.
So this is what would have happened, where you had to update, you had to migrate over to SegWit 2x if you were a miner and you wanted to participate in the network.
And the expectation was that some of the miners were not going to upgrade. And from that point forward, it would have been the case that there are two separate factions of Bitcoin, one called SegWit 2x and one called Bitcoin. And what would have happened, hypothetically, would have been whichever one was more popular, the less popular one would have been abandoned and would have lost enough popularity that ultimately everybody would have switched over just by the process of majority rule. Now, what ended up happening is SegWit 2x was never executed. The second half, which would have required this doubling of the block size, was that opportunity was abandoned because many of the miners were not interested in adopting the fork. And this goes deep into the politics of the Bitcoin network. But one important thing, I guess the important takeaway here, is that miners have a lot of hardware, a lot of existing hardware that they've spent a lot of money on. This upgrade right here would have required them to upgrade their hardware to take 2 megabyte blocks instead of 1. And this is one of the big problems with how mining has become specialized in Bitcoin. Now we have miners with a lot of power who are not interested in upgrading the protocol because it will mean a financial hit to them. So SegWit 2x was never executed.
And next, we're actually going to talk about another sort of disagreement where the network split again, but this time it actually continued on both sides. There was a hard fork, and things continued still to this day, where it would look something more like this, although it's not SegWit 2x, something called Bitcoin Cash. So that's coming up next. All right, welcome back. Next, we're going to discuss another important moment in the history of Bitcoin, something called Bitcoin Cash. So we talked about the idea of SegWit 2x. The motivation behind it was to lower transaction fees by increasing the block size, make it so that you could have twice the number of transactions in a given block compared to Bitcoin. But that fell apart. Roughly at the same time as that, all the drama was happening with SegWit and its attempts at increasing the size of blocks, there was a group of people working on basically an alternate version of Bitcoin. Rather than taking the approach of upgrading miners and bringing everyone up to speed in what's called a soft fork, making it backwards compatible, the idea behind Bitcoin Cash was to just split off from the Bitcoin network and make an entirely separate cryptocurrency, basically the same except for a couple pieces.
So Bitcoin Cash would have 8 megabyte blocks, and that would 8x increase the actual capacity of a block. And that would, by a factor of 8, increase the capacity of the network in terms of how many transactions per second it can handle. And that would also have the added effect of lowering transaction fees, just because there would be greater supply for the same given demand. And it's important to note that this wasn't just this, the people who were developing Bitcoin Cash thought that this could entirely replace Bitcoin. As they were scheming it, they weren't certain whether or not it would be fully adopted by the whole network, or maybe 99% of it, or whether it would be a 30-70 split.
And the other interesting thing Because this is a hard fork, Bitcoin Cash was a hard fork, which means, again, that it just split off from the Bitcoin. You can actually see the moment. It was block 478,558 was the last block before Bitcoin Cash. And at that moment, it split. So then there was one side, which was Bitcoin Core, Bitcoin, and then the other half, or it's not fair to call it a half, but this other chain, which is Bitcoin Cash, which we're not actually showing here that the block should be 8 times larger, but that would be hard to display. So we don't have that here. But this is an entirely separate cryptocurrency, and now they both still exist. They have totally different trajectories, and we'll show you a chart in just a little bit. But an interesting note, if you had a transaction, let's say that you had, I don't know, a year before this happened, or even the day before it happened, I had a transaction, somebody sent me 10 Bitcoin. After the split, I have 10 Bitcoin still, but then the Bitcoin Cash blockchain still says that I have 10 Bitcoin Cash. So everybody who had Bitcoin prior to the split still had Bitcoin, but they also got the same amount of Bitcoin Cash.
So if you went and spent that 10 Bitcoin in the normal Bitcoin chain, you wouldn't have actually impacted the state of the Bitcoin Cash chain.
So what we have here is a chart that is comparing the price of Bitcoin Cash and Bitcoin. Bitcoin Cash is in red here. You can see that Bitcoin existed for a lot longer, but around, I think it's August of 2017. Yeah, August of 2017, Bitcoin Cash split off. That was the hard fork. You can see that it's always been worth less than Bitcoin, but it's also kind of followed a similar trajectory. But again, they are not at all related to one another at this point. It just happens that most of the crypto market at this point kind of followed this general trend. But if somebody buys Bitcoin, there's nothing that is added to the Bitcoin Cash ledger to reflect that. Or someone buys Bitcoin Cash, nothing is added to the Bitcoin blockchain. They're completely separate entities.
And now we're in the realm of politics, because any website, any exchange that supports Bitcoin Cash has been removed from the bitcoin.org list of exchanges. So this is important to understand that there is no central authority that decides the course of Bitcoin. It really is just social consensus. And a lot of these ideas and problems are hashed out on Reddit and in message boards and in conversations between the people who have a lot of hash power. So in order to quantify the acceptance, the fork, how many people accepted Bitcoin Cash, what we can look at is something
how many
called
miners?
Yeah, how many miners? We can look at the actual hash rate, and the hash rate is the amount of effort, the amount of energy put forth towards mining these blocks.
So I'm going to click down here to switch over.
So this chart is of hash rate, and hash rate is determined based on the expected rate at which miners should be guessing proof of work versus the actual rate. So we can use this chart as a rough estimate of how many miners are mining Bitcoin Cash as opposed to Bitcoin. It's important to note that the actual mining hardware is different between the two, because Bitcoin Cash uses an 8 megabyte block, and you need new hardware, not the existing ASICs, to mine these. So what we have here is if we look at the proportion of the blue to the red, that is approximately the proportion of the network that is still mining Bitcoin versus mining Bitcoin Cash. So it's much smaller, but it's significant.
And one other interesting comparison to look at, the whole point of Bitcoin Cash, one of the main motivations was to increase the block size. So there are 8 times the number of transactions that can fit in a single block. And if we look at block size, you'll actually see that for most of the time, Bitcoin Cash is in the red. It's been less than the size of the blocks in Bitcoin, meaning that the full potential of it hasn't been realized. The network hasn't been trafficked enough. It hasn't been busy enough for there to fill up 8 times the number of transactions. But there have been a couple spikes, and I think is this probably when Coinbase listed Bitcoin Cash?
Almost certainly, yeah.
I can't quite get the mouse to go over there.
It looks like the block size got up to about 5 megabytes, but still not at the complete 8.
Right.
And if you look at the upper bound of the blue chart, that caps out at 1 megabyte. So the blocks are never going to exceed 1 megabyte because SegWit2x, what we discussed in the last video, was never executed.
Welcome back. In this video, we're going to talk about something called a base 58 address.
So base 58 addresses are a way of representing a Bitcoin address in a way that is error resistant. So here's a base 58 address, and it contains letters, numbers, uppercase and lower. And it actually does not allow uppercase I, lowercase l, capital O, or a 0, because those written down on paper or those just glanced at can be mistaken for one another. And the thinking is we want to protect people from their own mistakes. If you handwrite this, you don't want to irretrievably lose your public key, or sorry, your address. It also goes to add redundant characters to prevent people from making an error. And how does that work? When you use a credit card, there are actually some extra numbers out of the 16 that aren't really your credit card number. They're just there to make sure that you're actually typing your credit card number correctly. And these are called check bits. In Bitcoin addresses, what this means is that if you type your address subtly wrong, the Bitcoin client that you're using, the wallet app that you're using, can immediately reject that address as being incorrect. And that will spare you, hopefully, from inadvertently sending Bitcoin to an address that you don't have control over. So now we're going to show you a demo.
So we're on a website now. I think the creator of this, what's his name? Len Schultz?
Len Schultz. Thank you, Len.
Len Schultz.
Len Schultz. Thank you, Len.
Anyway, this is something that is just a little tool, an interactive demo, really. But what we're going to show you, wallet apps implement basically underneath. So you try and type in an address. Most wallet apps are going to use this base 58 check encoding to just validate it, to make sure it's a real address. And so we can visualize it here. This is a valid address here, as far as I know.
Yeah, don't send anything to this. This is from the Bitcoin website. So that shows up as valid.
Wait, it's not our job to stop you from doing that. If you want to, you can.
Yeah.
So it's not our address.
It's not ours.
So here it tells us it's valid. And if we change something in this, like let's say we accidentally...
Let's say we're copying it and then we accidentally, we replace...
Let's say 5 with an S.
Okay.
Because they can look similar in certain people's handwriting. So that was a 5, now it's a capital S. And it tells us immediately, invalid Bitcoin address, bad SHA-256 checksum. We're not going to go into the math, but what happens is that it's not just checking to see if this follows a particular format, it's actually doing some math. So obviously, if we were missing characters like this and we tried, it would tell us address is not even the right size. So that's a different problem. But here we have something that follows the pattern correctly. At least it looks like it does. It's the right number of characters, but it's still invalid because there's some math problem that it's doing to validate it. It's more complex than just counting the number of characters or, making sure that there's no zeros in there, for example. If I add the 0, it tells me bad character. So this is a different type of validation, and it's really useful because this looks to us like it could be valid.
Yeah, and just to scroll down a tiny bit, that's the actual address right there in hex, and that would be way harder to write down correctly and to insert correctly. If you did insert that directly into a Bitcoin client and it allowed you to use non-base 58 addresses, and let's say you accidentally did an A instead of a B. When you actually hit send, the Bitcoin would be irretrievably lost. You would not be able to get to that address to unlock the box that you had just locked it in. So base 58 is in common use, although you're most of the time going to end up just using a QR code because I don't think many people want to write down, was that 30 characters? Can't be bothered.
Welcome back. So this video is going to be a quick little note on RSA, the public key encryption algorithm that we talked about earlier. You may have noticed that we put a little note in there saying that technically what we were showing you is slightly incorrect. In particular, the way the public key is determined. So this is what we showed you. We have a very hard math problem that results in 3 different things: a public key, a private key, and then this number n, which we use as the modulo number. So here's an example of a key pair that could be generated, a very, very, very small one. 7 would be your public key, 23 is the private key, and then 55 is the modulo. And we've given them, or the standard names are E and D and N. But the reality of what is the public, or what's used as a public key in practice is slightly different, but the relationship between these 3 things is the same. If you raise something to the 7th power, mod 55, to get it back to the original message, you can raise it to 23, mod 55. So the relationship's the same, but what we actually use as a public key is different.
So in practice, when you're actually using this on a computer, what you're going to see as the public key is actually probably going to be n, the modulus. And the relationship still holds here. The creator of the key pair creates all 3, keeps D, the private key, to themselves, but then distributes N. And why is that possible? Because E, what we consider the public key in our earlier explanation, is actually always held at 65,537, which is a Fermat number. What a Fermat number is isn't terribly important for this course, but just know that it's a special type of number. It has a special property, and that makes it useful in this encryption scheme. Now, setting E to 65,537 has an added benefit of it's a relatively small exponent, which means encryption is faster. With our earlier scheme, the actual E value could have been enormous. Instead, we just use our already enormous modulo and lock E at this relatively small number, 65,537. So the reason we're showing you this is because when you actually use RSA day to day on a computer, you're going to see the public key, and it's not actually going to be the exponent, it's going to be the N.
Yeah, and again, it doesn't really matter at all for this course and for understanding how things work, but if you just are curious exactly how RSA is implemented and what the public key is actually, this is a more accurate picture than what we were showing you earlier. Just it's mathematically a little harder to explain, so we just simplified it and just said public and private key and then this number N for modulo. All right, welcome back. So this section is a bit of a departure where we're just getting down to the nitty-gritty details of actually acquiring Bitcoin or Ethereum or any of the other cryptocurrencies. So we've spent a lot of time expanding on the inner workings of these things. Now it's just a quick little, I won't say step-by-step guide because we're not going to endorse any particular software or exchange or anything, but we're going to just go over the basic steps that we recommend taking if you do want to buy it. And again, we're not giving investment advice. We're not telling you to buy Bitcoin or sell it or buy Ether or anything. It's just totally up to you if you want to. So way back, way early in the course, we talked about 3 different ways of acquiring Bitcoin. What were they, Kevin?
So first way was using an exchange. You use your local currency to just buy it as if it were at a Forex. Then the second way would be exchanging it for goods or services, wherein you trade it for example, a cup of coffee.
Like when Kevin sent me 0.0001 Bitcoin.
Yeah. And then the third way would be mining.
Okay, so we're not going to talk about mining because, well, we've talked a lot about it, but we're not recommending that you get into mining at this point. Although we're not recommending you don't either.
No advice.
Yeah. So we're going to talk about getting an exchange or choosing an exchange at this point. And the reason we're going to do that is that it's the easiest way to get Bitcoin or any of the cryptocurrencies, or most of them at least, because you may not, like you might have someone that you know who can send you Bitcoin, for example, and you have some sort of service you could trade them, or maybe you could give them dollar bills or currency in your local currency, but most likely you're going to want to use an exchange to just get Bitcoin. We're just going to focus on Bitcoin for now. So just get Bitcoin through an exchange. It's the easiest way. And there are dozens, well, probably hundreds of exchanges at this point, and all over the world, all headquartered in different countries. Some of them are in the browser, most of them are browser-based, but some of them have iPhone apps or other applications for different devices. Picking one can be a bit tricky. This is a bit of review. If you watched the earlier video, we talked about how we're not going to endorse one in particular, but all of them work in the same way. You create an account, you enter information, you connect it somehow to a credit card or to a bank account, and then you use that payment method to buy Bitcoin. So on bitcoin.org, this is just a relatively frequently updated web page.
Yeah.
It's not official.
This is community maintained, and that means because Satoshi Nakamoto, whoever they were, really removed themselves from the project, there is no single voice of the Bitcoin community, which in its own way is a good thing. What we're looking at here is the website that Satoshi Nakamoto actually registered in, I think, 2009. And the current controllers of this website are not the only voice in Bitcoin.
I like this explanation down here. Bitcoin.org is not Bitcoin's official website. Just like nobody owns the email technology, nobody owns the Bitcoin network. As such, nobody can speak with authority in the name of Bitcoin. So we go to resources up top and go to exchanges. So this is a web page that lists some of the exchanges out there. There are way more, but they're not all listed here for various reasons. They list safety and security and privacy as reasons that some of these are listed here, but they also implore you to do your own research and not to just trust that any of these are, foolproof. Because remember, at the end of the day, an exchange is a centralized location and it's relatively weak compared to the strength of Bitcoin on its own. So our recommendation in general, ignoring which exchange you even choose. Once you choose one, you do some research and you find one that works for you. Buy whatever you'd like to buy on there, but then move it out of that exchange into a wallet. One of the apps that in the next video we'll talk about as soon as possible, just so that you have control over it. You can back it up, write down the paper seed for the wallet, and just have control over it and sleep better, hopefully, depending on what the price of Bitcoin does. So just to show you though, we're not endorsing these, but if we look at one like Kraken or Bitstamp, let's see, what's another one? Let's look at Gemini. All of them kind of follow, they have different UIs, so all of them ask you to sign up. So you create an account. We're not going to do that because it is kind of an annoying process compared to your typical sign up.
And usually you'll need to connect a bank account with these American ones at least.
Yeah. So, but all of them ask you to create an account. And you can see, so this is Bitstamp. And up top, we can take a look at the various cryptocurrencies that they offer. So here's Bitcoin, and you can see the current price in Bitcoin in US dollars or in euros. Same thing over here with Ethereum, for example, and a couple others that we're not going to talk about. But you would go on here, register, create your account, and you just start buying Ethereum or buying Bitcoin. Same thing holds true over on Gemini. You can see down here, you can buy using US dollars buy Bitcoin, Ethereum, and they also will allow you to buy Ethereum with Bitcoin, or you can buy Bitcoin with Ethereum. So either way, you got to create an account. We're not endorsing any of these in particular. And we're not even saying that you should necessarily pick one on this list. I know that's the most wishy-washy thing ever. And one more note, this link down here, this is a website that allows people to post reviews about exchanges.
Oh, that's
so
nice.
If we go down to, I don't know, let's just say we're in France. If I can find France, there we go. And I want to use a bank transfer.
Yeah.
Here are some of the ones that are popular.
Voila.
And we can read reviews about them. We can get a general reputation, talk about their average speed, how
fees,
their
that's
privacy ranking. So I would recommend taking a look here. Just like, well, I don't know. I think most people, when they're picking a bank, just go to whatever's nearest to them.
Yeah, I think they just pick what their family, their friends.
Yeah, everybody expects banks to be so terrible that they don't even compare them.
Yeah,
these
the
days.
bar is so low.
Whatever has the closest ATM. But with something like this, we definitely recommend you do your research. But our sort of recipe, which we won't say recipe for success, but our recipe is if you want to buy something, use an exchange and then get it out of the exchange as soon as possible into your control. So we'll talk about that in the next video. All right, welcome back. So continuing on, this is the second video in this little section about the bare minimum you need to know to just get up and running with Bitcoin or Ethereum. But we're going to just focus on Bitcoin for now. So in the last video, we talked about choosing an exchange. Now we're going to talk about choosing a wallet. So whether you want to migrate or send your Bitcoin from an exchange to a wallet, which we recommend doing, if you do use an exchange, get it out of there, or you're just trying to accept Bitcoin, maybe you have a business or you want to sell a car or something and you want to accept Bitcoin, you're going to need a wallet. Surprise, surprise, just like the last video and pretty much everyone before it, we're not trying to endorse any of these particular wallet apps. There's many of them out there. And they all range, well, first of all, they range across the platforms that they work on, whether it's iOS or Android. I think there's plenty of desktop applications. There's web apps. I think even like BlackBerry and probably people have written them for like jailbroken PS4s and Nintendo Wiis and crazy things.
Yeah, they're quite easy to write actually.
So they all range in platform, but also in quality. So we're not going to endorse one in particular, but our general recommendation, go to bitcoin.org. As a starter, go to resources, and then under directories, we can look at wallets. So there's a list of them here. You could click on any of them. In general, I personally like to use mobile wallets because I just think it's easiest.
Yeah, for a lot of people, your mobile device is going to be a bit more sandboxed than your desktop or your browser.
So actually, I've actually never used any of these, and I have only heard of like two of them on this list. These are iOS ones. Oh, yeah, they do have BlackBerry on here.
Yeah, they don't even mention the two that we were using.
Yeah.
There's probably some politics at play.
But not to say that you shouldn't use these. Any of them will work. So if we just take a look at one of them, I think this link will go to, just go to the install. Right. So here we are on the App Store. You can install it. You can read reviews. Almost all of them are free. Because
yeah, I wouldn't pay for one of these.
Yeah. And they all do the same thing roughly. If we zoom in, you can generate an address. You can use that. You can show that to someone so they can send you Bitcoin, or you can create a new transaction and scan somebody's QR code, as you can see here, scan, and set the amount. You set the fee that you want to pay, and you hit send. And that's pretty much it. They all kind of follow the same pattern. Let's also take a look at an Android one. Let's pick something different. How about Bread Wallet?
Bread Wallet. I like this one.
So if we go to install, it takes us to the Google Play Store. Ooh, this is kind of a nicer looking interface.
Ooh, look at those colors.
But it's the
It's
same
like
idea,
grapefruit.
right? So we have a list of transactions. We can click send or receive, and whoops, this isn't scrolling. There we go. That's FAQs. I guess they don't really have screenshots of the actual sending process, but we promise it's the same idea.
And like all good apps, it looks like they have a 1-star review at the first one. Someone's angry.
Yeah. Yeah. Okay, so we recommend that you do your own due diligence, blah, 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 disclaimer, don't sue us, over and over. I'm getting real tired of saying that. In general, I wouldn't say that you should just pick the most popular one, which that would be an easy way to pick one. You could just go on the App Store, look at some of these similar ones, which one has the most reviews, for example, and if they all have the same, if they're all 4 stars or 5 stars, I personally might pick the one that has the most reviews, but I would also do some research and Google the name of that wallet app, see if anything was in the news recently. Was there anything that came up? Because occasionally things do happen, whether it's a hack or connectivity issues where like their servers go down and people can't get their money out when they want it. There are things that could happen. But really at the end of the day, the choice doesn't matter that much, because assuming that you pick one that's safe and that works and that people are using, let's say you don't like the interface, or you switch over from an Android phone to an iOS phone, or you go old school back to a BlackBerry, you can use any of the apps. You can import, you can export, and then import your wallet. So you have all your transaction history, all your Bitcoin accessible to you. It doesn't really matter. It's like using an email app. You can use the built-in one on your phone, but you can also check your email on your computer or on your Nintendo Wii if you wanted to. It's the same sort of idea. They all work. They all do the same thing. It's just a matter of which one you like, how it looks, and then security is a consideration, probably more than aesthetics. But at the end of the day, they all work similarly.
Can you check your email on a Nintendo?
Yeah, I'm pretty sure. They have like a web browser, so you could just sign in. Anyway.
The end.